Hello, my dear students. Hope you guys are all doing good. Hope you guys are all perfectly fine. I do wish and hope that you guys are preparing for your upcoming examinations in a great manner. And you guys are all aware that for the upcoming Jan 26 examination, we have very little amount of time left. And time is very crucial, my dear students. The factor which is going to decide whether you will clear the examination or not, that is going to be decided by how well you spend your time which is available. So still you have a good amount of time. Please divert all your efforts into preparation. Don't waste any minute, any hour of your time which is left out. Please make the proper utilization of it. Don't waste it here and there. So please divert all your focus, all your energy, all your strength towards clearing the upcoming examination. So I do wish that you all will do it. You will not waste any of your precious and very valuable and crucial time, and you all will make a proper utilization of it. And I wish you all the very success for your upcoming examination. And this video is all about a value addition for your upcoming examination, a helping hand in your preparation for your CA final audit. Yes, you heard me right. So this video is all about CA final audit marathon for Jan 26 attempt. So if you are a frequent visitor to our channel, you all know the quality of the resources we are creating for our students, especially for all the students whoever is preparing for the CA exam. For all of you, we have excellent qualitative resources on my YouTube channel. So if you are a frequent visitor, you better know it, the level of conceptual clarity we offer, the quality of the resources which we provide. If you are a visitor for the first time, if you're watching this video, if this is the first video, if you're watching on my channel, then also you will realize it once you go through this video. So that I can assure you from my side. So this marathon is definitely going to be 100% value addition in your preparation. And as with any video, as with any lecture, even if you follow my regular lectures, EOB lectures, whatever it is, or even if you have watched any of the previous videos on this YouTube channel, you all are aware our prime focus is on delivering the conceptual clarity. Conceptual clarity, which is going to be the most crucial thing which is required for you to get through the examination for a subject like audit. I know audit is nightmare for many of the CFNL students, but guys, you are lacking on the approach. If you are feeling audit as a trouble, that means you are not following a proper approach. You have a wrong approach for this subject. So the most crucial thing which is helpful for you to clear the auditing paper is having the strong conceptual clarity and also getting adopted to the language of the subject of the audit. That's what our entire classes will revolve around. Even in this marathon also, I have put all the effort to give you the required level of conceptual clarity, and I have put all the effort to make you used to the language which is used in the subject of the audit. That's what the key factor for us to qualify in the examination. So all that has been taken care of, conceptual clarity and getting adopted to the language of the standards. And also the keywords which you have to get used to, the keywords which you have to write it in the exam in order to get the marks. So all that has been taken care in this marathon. And I have put all my efforts to make this as best as it could. Okay. So I hope you all will love this marathon. You all will learn from it. You all will enjoy from it. I do wish and hope for that. And before I go into the discussion and all, before I go into the marathon discussion and all, I would like to share with you a few things which will make your marathon experience even much more better. See, throughout this marathon, I will be making use of various resources. So you will find me using the material. You will find me using the concept notes throughout this marathon. And also at various places, I will be taking help of the charts, especially for standards, for 500 series, 200 series of the standards. For various standards, I'm going to take the help of the charts and all. Sir, where we can get all that resources from? Where we can get all that resources from. So here I'm sharing with you where you can get all the resources. See, soft copies of all the resources, whatever I'm going to share with you over this marathon, that is going to be completely free of cost. You need not pay me anything for that. Sir, where can I get all that resources from? So just you have to visit our website www.fingainsacademy.com. That link also I will give it in the description. So you can check out the description there. Also you can get the directly link of the website. So if you visit this website, yeah, this is what our website is going to look like. So in that website, if you have to go to free resources section, at the top you will be able to find it. There is something called free resources. Just go and click there in the free resources section and select the course here, CA final. And in the CA final, you will be able to find two folders. So where you will find various resources. So here you will have main resources. If you come to the first folder, you will get the main resources like concept notes, question bank, and also recently I have shared with you one strategy, targeted chapter preparation strategy I have uploaded. That also you can take the help of. And apart from that, you also have one more folder under CA final. So where you will find various summaries, like for a few standards, we have a handwritten summary. For 240, we have summary. 250, we have summary. 402, we have summary. And for professional ethics, we have a summary. And not just that, for professional ethics, for question bank, we had a summary. Yes, for the question bank also I have a summary. So for the professional ethics, the learning of the concepts is very important, but solving the number of questions is going to be even damn important for professional ethics. So what I have done is, for that entire professional ethics question bank itself, I have prepared one summary. So that you can access, and even audit of banks, audit of NBFC summaries. So all the summaries are there. For that also we have a dedicated folder. So you can simply come to this website, log in here, and get access to all these resources. If at all you are looking for books, if you want hard copy of the books, yes, you can order it from here. So CA final audit hard copy of the books, colored version of the concept notes, you are going to get it here. So if you want to get the hard copy of the books, just you can come here, you can place your order. We are putting all the effort, so even you can choose it, whether you want only concept notes, you want only question bank, or you want a combination of both. You can accordingly choose your option. And my team is working very rapidly these days, because exams are closer, so they are doing the dispatches as quickly as possible, and within a short span of some 3 to 5 working days, we'll be able to deliver the books to your addresses. If at all you want hard copies, if you're comfortable with the soft copies, you can freely download that soft copies from our free resources section. Okay, so these resources will make your learning even more better, even more comfortable. That's what the whole purpose of this resources, my dear students. And having said that, I will proceed further with the marathon discussion, and I do wish and hope that you guys will love it, you guys will learn from it, you guys will enjoy a lot. If you're finding this marathon to be beneficial, please kindly do share it with your friends so that they also can get benefited out of it. Please leave your comments, try to share this video so that it can reach more people, and I can contribute for all the students in their success for the examination. Okay, so thank you all, my dear students. Take care and be serious in your preparation. So without any delay further, let me directly jump into the concept. Right, perfect. Okay guys, so let us have one basic structure, what and all we are going to cover, what and all we are supposed to cover as a part of this marathon. Let us try to have a overall structure once. So first of all, what is the title of our subject, everyone? So what is the title of our subject? So title of our subject says here, Advanced Auditing, Assurance and Professional Ethics. So this subject, from the title of the subject itself, it is very clear that we are required to cover three aspects. I can divide the entire CA final advanced auditing syllabus into three parts. So one part is talking about advanced auditing. So mainly one major aspect which we are going to discuss at the CA final is relating to audit. Then we have a part of the discussion which is talking about assurance engagements. So we have some part which is discussing about assurance part. Then we have something related to professional ethics part. So three aspects are there, three perspectives are there for the CA final audit. So we have advanced auditing, then we have assurance related activities, then we have professional ethics. So like that, we have three parts at the CA final level. And the major discussion, I will say some 50 to 60% of the discussion, whatever we are going to have here, that will be concerned about auditing only. So mainly we are going to talk about audit. And see, also they did not just mention the term auditing. What they have mentioned is advanced auditing. So that means at the CA final level, you are supposed to learn the advanced concepts of the auditing. Sir, if we are supposed to learn the advanced concepts of the auditing, what about the basics, sir? Basics are something which you should have learned it at the CA inter level, but I know it's been a very long time since you have appeared for the CA inter examination. You might have lost touch with the concepts of the CA inter basics. That also we will bring it here. So touching upon the basics, we are going to tackle the advanced concepts of audit. Okay, so that is a significant part of the discussion which we are going to have. Then we have something called assurance. We will talk about what do you mean by assurance engagements. Assurance is a kind of engagement which we chartered accountants in practice will do in order to make a living in the society. There are various kinds of assurance engagements. Audit is also a kind of assurance engagement. Then we have something called review engagement. Then we have something called related services. And also we have something called assurance engagement or prospective financial information engagements, non-financial information engagements. So like that, we are going to have, apart from audit, various other assurance engagements. On that, we are going to speak about it. Then we have something called professional ethics, which is talking about being a professional, being a person who is accountable to the society, being a person you are doing some professional work. Depending on your work, many people are taking their decisions, not just their normal decisions. They are taking their economical and financial decisions on the basis of the work which you have done. So it is expected from you, it is bare minimum expected from you to follow some ethical values, moral values. You are supposed to be a person of integrity. So like that, there are some moral values and ethical values which we are required to follow, that we are going to discuss in the professional ethics part. Small part, important from the examination perspective, easy for the preparation, easy for remembrance, easy for even writing in the examination. So basically we will cover here Chartered Accountants Act. We have a Chartered Accountants Act governing we chartered accountants after our qualification. Even as a student also, Chartered Accountants Act will become applicable for us. But once we qualify our examination, so we will be called as either member in practice, member in service, but you are expected to follow some ethical values and the moral values when we are carrying out our profession in the real world. So that guidance is covered under Chartered Accountants Act, and also Chartered Accountant regulations are there, CA regulations are there. So that we are going to discuss in the professional ethics chapter, right? So first we will be first we will be hitting the area of advanced auditing. So advanced auditing we will try to hit upon. So mainly we will start with that discussion. Fine, right? See, before we can start about advanced auditing discussion, as I have told, at the CFNL level, we are required to learn the advanced concepts. But you all might be aware, we can become master in anything only when we have strong knowledge in the basics. Agree or not? Definitely, right? So if you want to become an advanced level professional, or if you want to master any subject area, you can become such a person only when you are strong with the basics. So here at the CFNL level, we are going to discuss various advanced auditing concepts. But in order to have all that advanced concepts settle at their proper places, we need to revisit our basics once again. So what we will try to do is, quickly we will try to go back to our basics, we'll spend very less amount of time on this basics. So we'll try to have a basic intro for the subject of audit. And once we have that basic intro, then the going forward discussion will remain very smooth here. Okay, right? So having said that, first I will start my revision, I will start my marathon with this introduction to the audit. Sir, what exactly is the meaning of the audit? So we are not going to spend much of a time. So just I'm having this discussion to ensure a smooth flow in our subsequent concepts. So in order to have smooth flow of discussion in the subsequent concepts, it is very much necessary for us to have a strong understanding of the basics. Clear, everyone? Right. So let us have a look at the introduction to the audit. Sir, what exactly is the meaning of audit? You are saying we are going to mainly discuss about advanced auditing, but first of all, what is the meaning of audit? It becomes necessary for us to understand the meaning of the audit. The term audit has been defined something like this. So they say that audit is a kind of service which we chartered accountants offer to the society. Like we are all putting all this effort, we are going through all this hard work, we are preparing for the examination, we are qualifying the examination to get that CA degree, right? So once you qualify your CA final examination, why are you putting all this effort? Definitely we are putting all this effort to make a living in this society. Yes or no? So how we can make a living of the society? By providing various services. Like we provide tax consultancy services, income tax services, accounting services. So like that, various services we provide. A bunch of portfolio of services is there which we chartered accountants will render. Out of that, one service which we render to the society is audit. Like various other services, audit is also one of the most important service which we chartered accountants render to the society. So what exactly we will do here, sir? When I say I'm providing audit services, what exactly I'm trying to do here? So if you look at the definitions here, so they have defined something like this. An audit is an independent examination. What is an audit, guys? So they are saying audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. How they have defined the term audit? So they have defined the term audit in such a manner that audit is a, when I say I'm doing audit, what exactly I'm trying to do there is I'm trying to independently examine in an independent manner. I'm going to do the examination of what financial information of an entity, whether that entity is profit oriented or not doesn't matter, what is the size of the entity doesn't matter, what is the legal form of the entity doesn't matter, and why I'm doing this audit is the ultimate objective is to express an opinion on the financial statements. So what do you mean by this? First of all, they say that first we have to address, sir, what exactly happens in the audit. So they say that in audit, what exactly is going to happen is independent examination is going to happen. So what exactly happens in the audit? When I say I'm doing audit, I'm doing examination. Sir, what is the meaning of the term examination? Examination means verification. What is the meaning of the term examination? Examination means verification or checking, you can call it, or even scrutinizing, you can call it. So basically, when I say I'm doing audit, I'm doing verification, I'm doing checking, I'm doing scrutinizing. And that examination is not an ordinary examination. That examination is going to be an independent examination. So you are verifying, and how you are going to do that verification process is in an independent manner. So in an unbiased manner, in an uninfluenced manner. So independence is one of the quality of a chartered accountants which we all must possess. That means whatever decisions we are forming, that decision should be completely based on our judgment. It should not be influenced. It should not be changed according to other person's wishes and directions. That quality of the person, we call it as independent, free from bias. So when I say audit, I'm doing verification or checking, and that examination, that verification or that checking is not an ordinary checking or verification. It is an independent examination. Sir, what exactly you are checking here? Okay, sir, understood. You are telling audit is an independent examination, but what exactly I'm going to examine, but what exactly I'm going to verify? So the definition says you are going to verify the financial information. Sir, what do you mean by financial information? All the financial related data of your client. So basically, if I have to put it in simple terms, the financial statements along with the books of accounts, this put together, we call it as financial information. So as we all are aware, every entity will prepare the financial statements, but that financial statements will be prepared on the basis of source data. The source data for the preparation of financial statements is books of accounts. So you take the financial statements, add that source data books of accounts, that collectively I call it as financial information. Right. So as an auditor, I'm going to verify the financial information. Now, whether profit oriented or not. See, the entity whose financial information you are verifying, whether that entity is a profit oriented or it is a non-profit oriented, that doesn't matter. The entity whose financial information you are verifying, that could be a profit oriented entity, that could be a non-profit oriented entity. That is not going to change altogether what I'm doing in the audit. It will remain the same. So it doesn't matter whether my entity whose financial information I am verifying, is it a profit making entity or is it a non-profit making entity? That is not going to matter at all. Then irrespective of its size or legal form, the size of my client also doesn't matter. Is the entity is a very big company or entity is a small entity, all that doesn't matter. Size of the entity doesn't have any impact on the audit. Similarly, legal form. What is the legal form of my client? Is my client is an individual, sole proprietor, or is it a partnership firm, or is it a LLP, or it is a company? Even this also does not change the scope of my audit altogether. Here and there, reporting requirements will change, but overall objective of the scope is going to remain the same. So audit is an independent examination of the financial information of an entity, whether profit oriented or not, irrespective of its size or legal form. Sir, if we are doing that independent examination, if we are doing that verification, if we are doing that inspection, if we are doing that checking, that too in an independent manner, there should be one ultimate outcome of it. No, every activity should contain one ultimate outcome. Sir, what is the ultimate outcome of the entire process of the audit? There should be one final product, right? So if I am teaching you these classes, if I am providing you the services, what is the final product? You getting qualified in the examination, right? Similarly, when I am providing, if I am a chartered accountant, if I am providing audit services, if I am doing independent examination of the financial information, sir, what is the final product of it? What is the ultimate outcome of it? The ultimate outcome of it is to express an opinion. So what they're trying to say here, what is my ultimate objective of doing all this? The ultimate objective of doing that independent examination is you have to express an opinion. You have to tell your opinion. Sir, on what I have to say my opinion? whatever you have examined, whatever you have verified. So what I am verifying, so you are independently verifying financial information. On that financial information only you are required to express your opinion. So that opinion which you are expressing, that is going to be the final product of the entire process of the audit. And this opinion is very, very important. Why? Because this opinion is the heart of the audit. This opinion is the heart of the audit. So like any opinion in this world, you take any opinion in this world, there will be only two broad categories of the opinion. One is a good opinion, other one is a bad opinion. Or even you can call it either it is a positive opinion or it is going to be a negative opinion. Even audit is not an exception. In audit also, once the auditor has completed his independent financial verification, then he will express his opinion. Here also, either he can give a favorable opinion or he can give a unfavorable opinion, or even you can call it as good opinion or bad opinion, or you can say positive opinion or negative opinion. But this is all a layman terminology. If I give technical names for these opinions to the audit, in the case of audit, I can broadly divide the opinion of the auditor on the financial information into two categories. Number one is unmodified opinion. Number one is unmodified opinion, and number two is modified opinion. So number two is modified opinion. So we are going to talk more about this modified and unmodified opinion in our subsequent chapter. Immediately once we are done with the intro, we will be taking up the audit reporting chapter. There we will talk more about it. So broadly, the opinions can be divided into two categories: unmodified opinion and modified opinion. So nothing but this unmodified opinion, if I have to put it in very simple language, this I will call it as a positive opinion. Unmodified opinion, if I have to put it in simple terms, that I call it as negative opinion. But being a professional, we should not be using that positive, negative layman terms. We should not be using it. We should be using the technical terminology, which is unmodified opinion or a modified opinion. Clear? Right. So that is the ultimate objective. And few more things here. So as an auditor, just now as I've told, the ultimate objective of the auditor is to express an opinion. And that opinion, if I talk in specific terms, that opinion is required to be expressed regarding two things. Number one, whether financial statements are free from material misstatements, and whether financial statements are prepared as per applicable financial reporting framework. So that's what you will be able to see here. So the main objective is to express an opinion, and that opinion is required to be expressed on two aspects. Number one, whether financial statements are free from material misstatements, and also whether financial statements are prepared as per applicable financial reporting framework. Guys, it becomes very, very necessary for us to understand the meaning of the terminology here. What do you mean by misstatement? What do you mean by applicable financial reporting framework? This is very, very important for us to have a smoother discussion going forward. So let us take some little amount of time to make us clear about this concept of applicable financial reporting framework and what is the meaning of the misstatement. Why? Because throughout the rest of the discussion, at various places, you will be able to find this terminology, and I don't want you to keep the blank faces when you come across these terms. So here itself, we will take some time, become familiar with the terminology, so that going forward, if at all you come across this terminology, you are not keeping the blank faces. Immediately things will start flowing to your mind. Right. So let us try to understand first with what is the meaning of applicable financial reporting framework. So first of all, sir, what is the meaning of financial reporting framework? We will try to understand. See, what is the meaning of the term framework? The meaning of the term framework is it is a set of rules and regulations. A set of rules and regulations which are required to be followed, that we call it as framework. Whereas, what do you mean by financial reporting? Financial reporting means it is a process of preparation and presentation of the financial statements. So at your CFNL level, you have something called financial reporting, right? The subject called financial reporting. So what exactly you are going to learn in that financial reporting subject? You are actually learning how to prepare the financial statements. What is the process of how to prepare financial statements, how to present the financial statements? That's what you are going to learn here. Simply accounting, advanced name for accounting. So financial reporting is the process for preparation and presentation of financial statements, and framework means rules and regulations. Sir, what do you mean by financial reporting framework? So if you combine these two, the set of rules and regulations which are required to be followed in the process of preparation and the presentation of the financial statements, that only I call it as financial reporting framework. So what do you mean by financial reporting framework? The set of rules and regulations which I am supposed to follow in the process of preparation and the presentation of financial statements, that I call it as applicable financial, that I call it as financial reporting framework. Like for example, if I have to follow Schedule 3 and accounting standards while preparing financial statements, Schedule 3 and accounting standards will become financial reporting framework. So if I have to follow Banking Regulation Act, that becomes an financial reporting framework. So whatever rules and regulations you are following in the process of preparation and the presentation of the financial statements, that I will call it as financial reporting framework. But they use the phrase here, applicable financial reporting framework. What is the phrase they are using? Applicable financial reporting framework. So in order to understand applicable financial reporting framework, I would like to ask you one simple question. Guys, you tell me, it is whose responsibility to prepare the financial statements? Preparation of financial statements is whose responsibility? Say for example, there is a company X Limited. You are a auditor, Mr. A, you are an auditor. You have been appointed to conduct audit of this client X Limited. Now, as a part of this audit, so as we have all seen, as an auditor, you are required to do the independent examination of financial information, which contains financial statements along with the books of accounts. You tell me, it is whose responsibility to prepare and present the financial statements and books of accounts? So as we all are aware, the primary responsibility, not the primary responsibility, the responsibility, overall responsibility for the preparation of the financial statements and the presentation of the financial statements is always and always resting with the management of the organization. Though in reality, we chartered accountants are doing it, but as per the norms, it is whose responsibility to prepare the financial statements. It is always and always the responsibility of the management. So preparation of financial statements, that responsibility is always with the management. Now, the management of every organization, while preparing their financial statements, pay attention to the terminology here. So the management of every company, while preparing the financial statements of their respective entity, so depending on nature of financial statements and also depending on purpose, depending on nature and depending on the purpose of the financial statements, the management of the organization itself will adopt what set of rules and regulations they have to follow, that rules and regulations which have been adopted by the management. So very carefully, you have to be very careful here. So who will adopt the financial reporting framework? Management. Depending on what nature of the financial statements and nature of the entity and the purpose of the financial statements, the management of the respective organization will adopt. They will decide, okay, our entity is this, our purpose of the financial statements is this, so that's why we will follow this set of rules and regulations, that they will select and adopt it. Who will select and adopt it? Management. That selected and adopted framework, I call it as applicable financial reporting framework. That selected and adopted framework, I call it as what? Applicable financial reporting framework. Like for example, the management of Reliance Industries Limited, while preparing the financial statements of the company, they decided that, okay, nature of Reliance is a company and the purpose of the financial statements is for everybody. So what they have thought is, let us do one thing, let us follow Schedule 3 and accounting standards. Who selected? Management itself has selected. So the management, depending on the nature of the entity and the purpose of the financial statements, they have chosen, they have adopted Schedule 3 and accounting standards they will follow in the preparation of the financial statements. Now this becomes applicable financial reporting framework. Similarly, bank, say for example, S Bank is there. The management of the S Bank is required to prepare financial statements. The management, keeping in mind the nature of the entity, keeping in mind the purpose of the financial statements, they have decided that they will follow the Banking Regulation Act in the preparation of the financial statements. Who has adopted it? Management has adopted it. Depending on what they have adopted, depending on the nature of the entity and purpose of the financial statements, they have adopted it. So this Banking Regulation Act will become applicable financial reporting framework for S Bank. So like that, depending on the nature of the entity, depending on the purpose of the financial statements, who will adopt? The management will adopt a set of rules and regulations which they will follow in the preparation of the financial statements. So that adopted framework, I am going to call it as applicable financial reporting framework. Okay. So here one important point you have to observe: as an auditor, your responsibility is not to adopt the applicable financial reporting framework. Adoption of the applicable financial reporting framework is the responsibility of the management. Then what is auditor's responsibility is checking whether really financial statements are prepared as per applicable financial reporting framework. Like if I am getting appointed as auditor of Reliance, my responsibility is to check whether really the financial statements of Reliance have been prepared as per Schedule 3 and accounting standards. If I am conducting audit of S Bank, my responsibility is to check whether really the financial statements of the S Bank are prepared as per the Banking Regulation Act. Clear everyone? So that is what my responsibility, whether financial statements are prepared as per applicable financial reporting framework. Now comes the most important discussion, most important discussion we are going to have. There are chapters built on the discussion which I am going to explain. There are various chapters which have been built on the basis of the discussion we are going to have now. Okay, so the most important discussion we are going to have now is there are various types of frameworks. So what are we going to discuss? There are various types of frameworks, there are various types of financial reporting frameworks that we are going to discuss now. Sir, what are the various types of framework? Now, on the basis of purpose, frameworks can be broadly divided into two categories. So if you come to the material here, so on the basis of the purpose, we can broadly divide the frameworks into two categories. First of all, we can broadly divide the financial statements into two categories on the basis of purpose. Number one is general purpose financial statements and number two is special purpose financial statements. Sir, what is general purpose financial statements? They simply say that general purpose financial statements are those which are prepared as per general purpose framework, whereas special purpose financial statements are those which are prepared as per special purpose framework. That's how they have simply defined. But that discussion will remain incomplete until and unless we understand what is the meaning of general purpose framework, what is the meaning of the special purpose framework, that we have to become very clear. So I could say here, on the basis of the purpose, frameworks are broadly divided into two categories, general purpose framework and the special purpose framework. Sir, what is general purpose framework? General purpose framework refers to such a framework which fulfills financial information needs of various users simultaneously. Guys, very important discussion. Why? Because as I have told, on the basis of this discussion, altogether some chapters are built. If you want to have thorough understanding of that chapters, you need to have a strong understanding of this basics, right? So what is a general purpose framework? They say that general purpose framework refers to such a framework which fulfills financial information needs of various users of the financial statements. So as we all are aware, management will prepare financial statements, but there will be various users of the financial statements. Sir, who could be that user? Management themselves will be one of the user. Shareholder could be user. Banker could be an user. Government could be an user. So like that, there are various users of the financial statements. If the management, while preparing the financial statements, if they have followed a set of rules and regulations, and by following that set of rules and regulations, they have prepared a financial statements, and that financial statements will fulfill simultaneously all the needs of the users. If the management follows a set of framework, a set of rules and regulations in the preparation of the financial statements, and if that financial statements are released, if that financial statements are prepared, that will fulfill information needs of various users. It will fulfill information needs of all the users. It is not specific for one user. That framework will fulfill information needs of all the users simultaneously. That kind of frameworks, we are going to call them as a general purpose framework. Let me give you one example. Say Reliance Industries Limited. Now Reliance Industries Limited is having various users. Like as I have told just now, management will be a user, shareholder will be a user, bankers will be a user, government will be a user, trade receivable, trade payable. So like that, multiple users are there. Now what Reliance have done is they have prepared their financial statements. Every year, listed company will prepare financial statements and upload it on their website and even submit to stock exchanges. So what management of Reliance Industries Limited have done is they have prepared the financial statements using Schedule 3 and accounting standards. On the basis of that, they have prepared the balance sheet in which they have explained what are the state of affairs, what is their financial position. They have prepared P&L depending on that, in which they have shown what is their profitability position. They have prepared a cash flow statement in which they have explained whether they had a net cash outflow or inflow. And also they have prepared statement of changes in equity, and they have prepared notes to accounts in which they have given all the disclosures. Okay, so now you tell me, these financial statements which are prepared by the management of the Reliance, that too prepared as per Schedule 3 and accounting standards, will that fulfill information needs of all the users? Yes, the requirements of such a framework are such that these financial statements prepared as per this framework will fulfill information needs of various users. Management can use it for decision making, shareholders can use it for their investment decisions, government can use it for the determining of tax liability, and bankers can use it for the purpose of giving of the loans, creditors can use it, everybody can use it. So here the management has prepared the financial statements as per one such rules and regulations that fulfilled information needs of various users simultaneously. So this I can call it as general purpose framework. So the best example of the general purpose framework is Schedule 3 and accounting standards. This is one of the best example for the general purpose framework because it fulfills information needs of various users. Now, why it will fulfill information needs of various users is why? Because it will have some characteristics. It will have some characteristics. General purpose framework will follow some characteristics. What are they? Sir, they follow generally accepted accounting principles like concept of prudence, concept of conservatism, matching concepts. So they follow some generally accepted accounting principles, and they follow accounting standards, and they follow fundamental accounting assumptions like going concern, accrual, consistency. They follow the fundamental accounting assumptions. And number 4, they are prepared periodically. They will be prepared what? Periodically. So they will not be prepared for random durations. There will be one periodical duration. For that periodical duration only, these financial statements will be prepared. So that's why they fulfill information needs of various users simultaneously. Okay, sir, we understood what is general purpose framework, but what is the meaning of the special purpose framework? So exactly the opposite of that general purpose framework. They say that special purpose framework refers to such a framework which fulfills financial information needs of specific users, which will fulfill financial information needs of what? One or two specific users. Such a kind of framework I'm going to call it as special purpose framework. On the basis of the special purpose frameworks, almost a separate chapter has been built. Like we have one specialized areas, we have a chapter called specialized areas. In that we are going to discuss 800 series. In that, significant discussion we are going to have regarding the special purpose framework. So, but whatever it is, so what do you mean by special purpose framework? The special purpose framework refers to such a framework which fulfills financial information needs of only specific users, not all the users. Like one common example which I almost always use everywhere, which has been given in the standards itself. So what is that common example is? Say for example, there is a bank. So this bank, there is a company X Limited. This company needed loan from this bank, but banker told one thing: boss, if you expect us to give the loan, we want you to prepare the last 3 years of financial statements on cash basis. What the bank management has told: boss, if you expect us to give the loan to you, yes, we are ready to give you the loan, but we will give you the loan only when you prepare your last 3 years of financial statements on cash basis. Why? Because banker wants to know your actual repaying capability. Okay, this company has prepared the financial statements on cash basis, and they have presented that financial statements to the bank. On the basis of that, bank has sanctioned the loan to the company. Now, they have prepared the financial statements on cash basis. They followed a rule and regulation which is cash basis of preparation of financial statements. But they have followed this framework only to fulfill information needs of one specific user. Who is that one specific user? Bank. Only to fulfill the information needs of the bank, they have prepared this financial statements. So here this company X Limited has followed a framework which fulfill information needs of not all the users. It will fulfill information needs of only specific users. So this is one example of the special purpose framework. Clear everyone? So sometimes the financial statements will be prepared as per general purpose framework. Then how to do the audit, that we will discuss. When financial statement, sometimes you might be as a chartered accountant called upon to conduct audit of such a financial statements which are prepared as per special purpose framework. How to do that audit also we are going to discuss. How to do that audit of conducting audit of special purpose frameworks also we are going to cover here. So this is one categorization of the framework on the basis of purpose. Now, on the basis of presentation, there is one more categorization of the frameworks. This is also going to be very, very important. Why? Because the types of frameworks which we are going to discuss now, its a reference will be there in each and every subsequent chapter. In each and every subsequent chapter, which we are going to have a discussion going forward, there will be a lot of references to the discussion which we are going to have now. Okay, right. So if you come here on the basis of presentation, on the basis of what? Presentation, the frameworks can be further divided into two more categories. What are they? Number one, compliance framework, and the other one is fair presentation framework. This we will try to understand. Okay, so this is the major thing in this chapter. So once we are done with the understanding difference between compliance framework and the fair presentation framework, we can go ahead and discuss the subsequent chapters. So this is the next big discussion in this chapter. Once we are done with that, this chapter will come to an end. Okay. So on the basis of presentation, the frameworks can be further divided into two more categories. Number one is compliance framework and number two is fair presentation framework. First, let me address what is this compliance framework. So they define here something like this. It refers to such a framework in which the financial statements are prepared as per the requirements of such framework without any deviation. Without any deviation, single deviation is also not permitted. Even small deviation is also not permitted. If you are following such a framework where you have to prepare the financial statements as per the rules of that framework, deviation or departure is not permitted. You have to strictly follow. Whether by following it you will get a true and fair view or not, it doesn't matter. If you are required to follow something very strictly as it is with zero deviation, with zero departure, you are strictly prohibited to deviate from the requirements of the framework. Such a framework, I call it as compliance. The name itself says compliance. You have to comply with, you have to follow strictly, you have to follow. 0% deviation is permitted. No deviation is permitted at all. Such a framework, I call it as compliance framework. Like if you see here in the previous case, the banker has asked us to prepare the financial statements on cash basis, and we have actually prepared the financial statements on the cash basis. We did not deviate. We know that by following cash basis of the financial statements, whatever balance sheet position we get, whatever profitability position we get from the statement of P&L, that is not an actual reflection. That is not a true and fair reflection of financial position. That is not a true and fair reflection of our profitability. But still, we have strictly followed it without any deviation. We know that by following this framework, we are not going to get a true and fair view, but still we have strictly followed. Why? Because banker did not permit us to deviate. So this framework is an example of compliance framework. So most of the special purpose financial statements will be compliance framework, where you have to follow strictly without any deviation. And here true and fair view is not guaranteed. True and fair view is not guaranteed. By following compliance framework, true and fair view could be there, could not be there. There is no guarantee in that. Whereas, sir, what is the meaning of the fair presentation framework? Very, very important here. So here also the definition of the fair presentation framework says something like this. It refers to a framework in which the financial statements are prepared as per the requirements of such framework. Here also we will try to prepare the financial statements as per the requirements. Here also we will try to follow the requirements of the framework. But here we are given one freedom. Here we are given a permission. Here we are given some choice. So here also in the case of fair presentation framework also, we try to prepare the financial statements as per the requirements of the framework only. But here we are given permission. Here we are given some freedom to do certain things. Sir, what freedom has been given to us? Number one, we may provide additional disclosures beyond the requirements of the framework. That means we can add extra explanations in our financial statements even though not required in the framework. Or we can altogether deviate from the requirements of the framework. We can ignore whatever has been mentioned in the framework and follow something else also. So in the fair presentation framework, here also what we will do, to the extent possible, we will try to follow the requirements of framework. But here we are given a choice. Here we are given some little freedom to do two things. Either provide additional disclosures beyond the requirements of the framework, or altogether deviate from the requirements of the framework. So either we are given the freedom to provide additional disclosures, or we are given the freedom to deviate from the requirements of the framework altogether. Sir, but with what objective this freedom has been given? This freedom has been given to you to achieve fair presentation. This freedom has been given to you to achieve what? Fair presentation. Your objective here is fair presentation. The name itself says fair presentation. The main emphasis is on fair presentation, not just on compliance. So I will give you one example. This example is also once again given in the standards, which I will use it for the purpose of making you understand the difference between the compliance framework and fair presentation framework. Say for example, there is a company which has purchased a plant and machinery which is costing of 1 CR, 1 crore rupees of plant and machinery they have purchased. As we all are aware, if you have purchased, if you have capitalized any asset in your books of accounts, as per the Companies Act, you are required to charge a depreciation. And as per Companies Act, only two methods of depreciation is permitted. One is either SLM method and the other one is a WDV method. We all are aware, even the rates are given in the Companies Act itself. So if you follow SLM method, the rate of depreciation is 10%. Say, for example, if you follow WDV method, the rate of depreciation is 15%. So if it is a compliance framework, strictly we are required to follow whatever is mentioned in the framework. So if the framework is a compliance framework, either we will charge in our financial statements SLM depreciation, ignore the residual value and all. Either we have to charge the depreciation as 10 lakh rupees in the statement of P&L or 15 lakh rupees in the statement of P&L. Why? Because these two are only permitted. So if it is a compliance framework, we will follow strictly whatever has been given in the framework with a zero deviation. Strictly we are going to follow. So if it is a compliance framework, but let me give you some extra information. Now let me give you some information regarding its consumption pattern. How this machinery will be consumed. See, this machinery is designed in such a way that it will exactly produce 1 lakh units. How many units? It will exactly produce 1 lakh units. And in year 1, they have already produced some 30,000 units out of it. How many units they have already produced in year 1? In year 1, using that machinery, they have already produced 30,000 units. Now you tell me, looking at the consumption pattern of this machinery, other than SLM and WDV, some other method of depreciation is sounding more appropriate, right? So what is that other method of depreciation which is sounding more appropriate? It is actually production units method. Which method? Production units. But if it is a compliance framework, you have to follow either SLM or WDV. That's all. We know by charging the depreciation on production units method. So if you calculate the depreciation as per production units method, what is the value of depreciation? So 1 crore is the total value of the machinery. Total capacity is 1 lakh units. Out of that, 30,000 units are already produced in year 1. So that means 30% is already consumed. 30 lakhs should have been my depreciation if I follow production units method. But which one is giving you more fair presentation? We know that the method of depreciation used should be matching with the consumption pattern. So between SLM, WDV and production units, which one is fair presentation? Production units method is more fair presentation. But if it is a compliance framework, we are not permitted to deviate. We are required to follow either 10 lakh rupees or 15 lakh rupees. But if the framework is a fair presentation framework, I told we are given freedom. No, two options we are given. Number one, either what you can say is you can provide additional disclosures. Sir, how do you provide the additional disclosure? So what do you mean by providing additional disclosures is in the statement of my P&L, in the depreciation, I will show my depreciation as either 10 lakh rupees or 15 lakh rupees only. But in my notes to accounts, I will add an extra explanation. So what I will say in my notes to accounts is we have charged the depreciation on this plant and machinery on either SLM or WDV basis because it is a requirement of the Companies Act 2013. But looking at the consumption pattern, some other method of depreciation is more appropriate, which is production units method. If we have followed that depreciation method, our depreciation would have been 30 lakh rupees. Our profit would have been this much. This is a disclosure I am providing. This is not required as per the framework, but I am doing it. I am giving extra disclosure beyond the requirements of the framework. You tell me what is the objective behind giving this extra disclosure? What is the requirement of you to go beyond the requirements of the framework and give this extra disclosure? Because you have an intention that if a user comes and reads this disclosure, he will have a better understanding. So this is one example where you are giving a permission to provide additional disclosures. And one more option has also been given to you. Either you can deviate from the requirements. Altogether, what you can do? Altogether, you can deviate from the requirements. Sir, what do you mean by deviating from the requirements? That means in my statement of P&L itself, directly what I will do is instead of charging the depreciation as per 10 lakh rupees or 15 lakh rupees, directly I will charge the depreciation as 30 lakh rupees. So here what I have done, whatever has been told in the framework, I have ignored completely that. I have followed something else. Ignoring the thing which is given in the framework, I followed something else that I call it as deviate. But here also, what is my objective behind deviating? to achieve a fair presentation, because I know that if I charge the depreciation as per production units method, that will be a more fair presentation. So if there is such a permission to you in the framework, if there is a permission to you to either deviate from the requirements of the framework or to provide the disclosures beyond the requirements of the framework with the whole objective of achieving the fair presentation, that means fair presentation is the top priority there. Such a frameworks, I am going to call it as fair presentation frameworks. Understood? Clear? So compliance framework. So this is very, very important once again here. Why? Because at various places we are going to bring this discussion into picture. So especially in the reporting chapter. So what will be the requirements of the what will be your wording of the opinion in the case of compliance framework? What will be the wording of the opinion in the case of fair presentation framework? Very, very important. If you don't understand the difference between the two, you are going to do the mistake. So when it comes to compliance framework, what is the main objective here? Here in this framework, you have to strictly comply without any deviation. Deviation is not at all permitted. You are supposed to strictly follow whatever has been mentioned in the framework. Whereas when it comes to fair presentation framework, here objective is fair presentation. Achieving the fair presentation is the top priority. Okay. So tell me where there will always be a true and fair view. Where there will always be a true and fair view. In the fair presentation framework, there will always be a true and fair view is always guaranteed in the fair presentation framework. But when it comes to compliance framework, there might be a true and fair view. There might not be a true and fair view. Okay. So it all depends. We can't say always there will be no true and fair view. It all depends on the facts and circumstances. There could be a true and fair view. There might not be a true and fair view. But when it comes to fair presentation framework, there will always be a true and fair view given by the financial statements. Understood? So like this, we have totally discussed 4 frameworks. On the basis of purpose, frameworks are divided into 2 categories, general purpose and special purpose. On the basis of presentation, frameworks are divided into 2 categories. One is compliance framework, other one is fair presentation framework. This differentiation is very, very important. Why? Because as I was saying, the chapters are built on it. So why we have discussed about these different types of frameworks, where our discussion has started. So we are discussing the 2 broad opinions of the auditor. So number 1, I have told whether financial statements are free from material misstatements. Number 2, I have told you are required to express an opinion whether financial statements are prepared as per applicable financial reporting framework. So as a part of that objective, we have understood what is the meaning of the term applicable financial reporting framework, and we have understood what are the various types of framework. Now coming to the first objective, what is the first objective of the auditor? To express an opinion whether financial statements are free from material misstatements. So what do you mean by this material misstatements? So you are required to express an opinion whether financial statements are free from material misstatements. So we need to understand first what is the meaning of the term misstatement. So as we all are aware, what is the meaning of the term statement? Statement means conveying something. Misstatement means what? Conveying something in a wrong manner. Conveying something in a wrong manner. So misstatement in the financial statement means what? If I have to put it in very simple terms, a misstatement means a mistake in the financial statements. A mistake in the financial statements. Technically, I am going to call it as misstatement. This is what the simple meaning. But we all know simple things don't work in the examination. We have to write the technical definition. Even the term misstatement has been technically defined in the standards. So how they have defined is the difference between amount classification, presentation, disclosure, which is there in the reported financial statements, and amount classification, presentation, disclosure, which is required as per applicable financial reporting framework. If there is a difference between the two, that difference only we call it as misstatement in the financial statements. So if there is a difference between amount classification, presentation, disclosure, in where? In the reported financial statements, the financial statements which are already prepared by the management. In that, there is some amount, there is some classification, there is some presentation, there is some disclosure, which is not matching with the amount required as per applicable financial reporting framework, which is not matching with, which is different from the classification required as per applicable financial reporting framework, which is different from the presentation required as per applicable financial reporting framework, which is different from the disclosure required as per applicable financial reporting framework. That we call it as misstatement. Like say for example, management in their financial statements, they have recognized the revenue as 10 lakh rupees. But as per some applicable accounting standard or Ind AS, the revenue should be recognized as 5 lakh rupees only. So there is a difference in the amount, that we call it as misstatement. or in the financial statements which management has prepared, they have treated certain expenditure as capital expenditure, but as per the requirements of the applicable financial reporting framework, that has to be treated as revenue expenditure. Difference in classification, misstatement. Then difference in presentation. So company is required to prepare the financial statements in their vertical format of the balance sheet and P&L, but the management has prepared a horizontal format of the balance sheet and P&L. Difference in presentation. Once again, misstatement. Or even there could be a difference in disclosure also. Sir, what do you mean by disclosure? Whenever I say disclosure, I am referring to that explanatory information in the notes to accounts. Either as per some standard, as per some Ind AS, as per some As, you are required to explain certain information in the notes to accounts. Either you are not giving that explanation in the financial statements, or you are giving that explanation in a different manner, in a wrong manner. So if there is a difference in the disclosure, that also we call it as misstatement only. Able to understand? See here, one important point which I want to bring it to all your attention. See, generally, whenever I say there is a mistake in the financial statements, whenever I say there is a mistake in the financial statements, one of the common perception, generally what you will imagine, say for example, I'm saying that there is some company X Limited. In that company X Limited's financial statements, there is a misstatement. So what you will generally imagine? So whenever I say misstatement, you generally imagine that there is a mistake in the balance sheet. Either assets are wrong, liabilities are wrong, or balance sheet is not matching, or profit figure is wrong, or cash flow statement is wrong. This is what generally comes to your mind. Yes, you are correct. But going forward, I want you all to change your perception. Whenever I say misstatement, misstatement need not be always quantitative. Misstatement need not always be numbers and figures. We have to change our perception. A misstatement can also happen in the notes to accounts. If the management did something wrong, give a wrong explanation in the notes to accounts, that is also a misstatement only. Misstatement need not always be quantitative. Misstatement need not always happen only in numbers and figures. Misstatement can even happen in the notes to accounts also. Where also the misstatement can happen, misstatement can also happen even in notes to accounts. And not just normal misstatements, very big pervasive misstatements can happen in the notes to accounts. So you have to be very careful. I want you all to change your perception. So going forward, whenever I say there is a misstatement in the financial statements, don't just imagine only numbers and figures. The misstatement could even happen even in notes also, in the explanatory information, in the qualitative information also misstatement could happen. Clear? So material misstatement. So next thing is, we need to be not worried about each and every misstatement. We need to worry about only those misstatements which is material. So now what is the meaning of the term material? Material means something which is significant, something which is important, something which is major. But as we all are aware, in the subject of audit, materiality is something which is subjective, which is very relative. So we can't exactly define this much amount will always be material. I can't define it. Like I can't say 1 crore amount of misstatement will always be material. I can't say it. Why? Because 1 crore of misstatement happened in the Reliance Industries Limited might not be material. Why? Because Reliance Industries Limited financial statements itself will be rounded off in crores. 6 lakh plus crores of revenue of a company. In that 1 crore amount of misstatement has happened. Not material. Take another company which is making 100 crores of turnover, their 1 crore worth of misstatement has taken place, then it becomes material. Same misstatement, same circumstances, same nature. But in one case it is not material, in another case it is material. So what I wanted to say here is, materiality is something which is a very relative term. Materiality is something which is a very subjective term. It changes from person to person, it changes from entity to entity, it changes from audit to audit, it changes from circumstance to circumstance. So we can't absolutely define what is material in all the circumstances. It all depends on facts and circumstances of each and every case. More about determination of materiality, sir. How exactly you will determine what is material, what is not material, how exactly you are going to determine that, we will see it in a while when we take up the chapter risk assessment, internal control and materiality. There we will try to understand it. Okay. So, but as an auditor, you have to express your opinion whether financial statements are free from material misstatements. That means financial statements do not contain any material misstatement. So that you have to express your opinion. Understood? But one general term they have told, a misstatement can be considered as material if it could influence the decision of users of the financial statements. So how they have defined the term material misstatement? A misstatement will be considered as material if it could influence the decision of users of financial statements, then we can call that misstatement as material. So this definition, you just keep it at the back of your mind. So with this, we have completed two broader objectives of the entire audit. So let me see, is there anything else we have to quickly revise in this chapter? So we have covered all this. Misstatement we have covered. And one more thing, the misstatement can happen either because of fraud or error. A misstatement in the financial statements can either happen because of fraud or it can even happen because of error. We already know what is the distinguishing factor between the two. Fraud is something which is always intentional, whereas error is something which is unintentional. So material, legal form, all this we have covered. Now, what is the meaning of the term auditor? See, for audit is the process of doing independent examination, and the person, whoever is doing such independent examination, that person we call it as auditor. But when it comes to the audit terminology, when I say auditor, I am not referring to a single person. From the audit perspective, when I say auditor, if I am using the phrase auditor, I am not referring to one person, I am referring to a team. Generally, say for example, there is an audit firm, A, B, C and co audit firm is there, which is set up by three partners who are practicing chartered accountants. Now, these people are having an office. In the office, there will be various staff available or not. Who and all will be the various staff available? See, there will be audit assistants like you, senior article assistants, so junior article assistants will be there. There will be somebody called paid assistants, nothing but this BCom, MCom qualified people, or the people who have not yet completed their CA final. Generally, they will be working with audit firms, whom we call them as paid assistants. There will be audit managers. So like that, different people will be there in the firm. Say for example, this firm is having a total 50 staff, they are having 50 resources, they are having some 20 article assistants, or 10 paid assistants, some 10 audit managers, etc. Now, if this firm has got audit of the client X Limited, X Limited approached this company and asked them to do the audit. Do you think one single person go and do and handle the audit single-handedly and complete it? Definitely not. So generally, what will happen is when a company approaches, when an entity approaches a firm and do the audit, a team will actually be assigned to that work. So now what this firm has done is they have selected one engagement partner, one of the partner, Mr. A. Three partners are there. So one partner has come forward and told, okay, I will take up the responsibility for completing this audit. So now this person, we call him as engagement partner. And he has picked out of his entire 50 staff, he has picked some 5 senior article assistants, 4 junior article assistants, 3 paid assistants, 2 audit managers. So like that, a team of some 12 to 13 people he has selected. Now this team of 13 people will go and complete the engagement. What engagement? Not the engagement which will happen before marriage. Engagement is a very broad term. So they will go and complete the audit engagement. What they will go and complete? Audit engagement. So engagement term is very, very broader. So what do you mean by engagement? Engagement is a mutual obligation, is an agreement or a contract in which there is a mutual obligation between two persons. So even the engagement which you are aware, something which happens before marriage, even in that engagement also, it is a mutual obligation. Bride agrees to marry the groom, groom agrees to marry the bride. So similarly, if an auditor has agreed to provide the services to the client has agreed to pay the fees to the auditor. This is also a engagement where there is a mutual obligation. A doctor has agreed to provide the treatment to the patients, patient has agreed to pay the fees to the doctor. Engagement. That doesn't mean both are going to marry. So the engagement which you know is not the only engagement. The term engagement is a very broader term. It includes any party, any obligation, any agreement or contract where there is a mutual obligation between two persons, that we call it as engagement. So even even audit is also an engagement. So this team of 13 people is responsible for going and conducting the audit engagement of the client X Limited. So this 13 people, I call them as engagement team. These 13 people, I call them as what? Engagement team. So whenever I say auditor, I am not referring to one person. Whenever I say auditor, I am referring to the entire engagement team. Whom am I referring to? I am referring to entire engagement team, not just one or two persons. When I say auditor, I am referring to entire engagement team here. Able to understand? And in my engagement team, engagement partner will be there, senior article assistants will be there, junior article assistants will be there, paid assistants will be there, audit managers will be there, or any other designation. If the firm is using any other designation, even that other designated persons also will fall under my engagement team definition. So whenever I say auditor, I am talking about entire engagement team except in two cases. Generally, when I say auditor, I am referring to entire engagement team. But in two circumstances, wherever I say auditor, I am referring to only engagement partner. In how many circumstances? In two circumstances, the reference to auditor means only reference to engagement partner. Sir, what are the two circumstances? Number one, acceptance of responsibility. Number two, accountability. So only in two circumstances, whenever I say auditor, I'm not referring to entire engagement team. I'm referring only to engagement partner. So what are the two circumstances? Number one is acceptance of responsibility. See, say for example, if somewhere it was mentioned, auditor has to sign the financial statements for accepting the responsibility. Now, when I say here auditor, generally I told audit means entire engagement team. No. Do you think article assistant also can go and sign the financial statements? Just now, as I've told, auditor means entire engagement team. No. If I told somewhere it was mentioned, auditor is responsible for signing the financial statements, it is the act of acceptance of responsibility. Do you think a paid assistant or an article assistant can go and sign because he's also an engagement team member, he's also an auditor? No. Why? Because when it comes to acceptance of responsibility, auditor means only engagement partner. If somewhere it was mentioned auditor is responsible for signing the financial statements and taking the responsibility, there auditor means only engagement partner. Only engagement partner will sign, not everyone. Next, when it comes to accountability before regulatory authorities, say for example, if somewhere it was mentioned in some law, it was mentioned that auditor has to face imprisonment for 2 years. That means for your actions you have to become accountable. So, say for example, one fine day, you are an article assistant in one firm, your partner and you have done some audit. In that audit, you are not able to find some mistake or you have done something wrong, and police have come to arrest you. And they came to the office. Your partner is not there. You are there sitting in your office. You are an article assistant, you are sitting there in the office. Can the police take you? Can they say, okay, even audit assistant is also a part of engagement team? Auditor means entire engagement team. So you are accountable. Let us come now. Can they pick the article assistants and grab him and take him to the station? No, they can't do it. Why? Because it is a matter related to accountability before regulatory authorities. In cases related to accountability before regulatory authorities, auditor means entire, auditor means not just entire engagement team, it is just an engagement partner. In rest of all the circumstances, wherever they are giving the reference to the term auditor, it means entire engagement team. But in these two circumstances, one is acceptance of responsibility and accountability before regulatory authorities. Auditor means only engagement partner. Clear? So this is what the basic information which we need to have in order to have a smoother discussion for the subsequent chapters. So we have successfully completed the intro part. We have successfully completed the intro part. Now we will pick up the next chapter for our revision, which is audit reporting. A very good weightage from this chapter. Very important chapter from the examination perspective. Very conceptual and very much easier to learn and understand also. Okay, shall we do it, everybody? So this chapter we will try to do it now. Audit reporting, we will try to do it now. So just give me one moment. Right. Fine. So let us start now revising the audit reporting chapter. So very important chapter from the examination perspective. So very interesting, even from the practical perspective also, it is very, very important. Very interesting discussion we are going to have. So not some routine and bragging discussion, very interesting discussion. And the content which we will learn here, that will help you practically also, that will even help you to get through the examination also. So having said that, let us set out the structure, what and all we are supposed to cover as a part of this entire chapter. Let us try to set the structure for this entire chapter. See, but before that, Before I talk about it, I would like to explain few more things here before I talk about this reporting requirements and all. First, let us try to have a quick overview of entire process of the audit. What exactly happens in the entire process of the audit? Okay. So very important discussion. See this here, I'm going to tell you the entire cycle where the audit is going to commence, where the audit is going to end, in between what and all are the processes involved. I will give you overall structure, one basic structure I will give. See this structure we will revisit and make changes each and every time. So each and every time we add our concepts, we'll come back and add a few things in this entire process. Okay. See generally how the process of audit actually works is, number one, first client approaches auditor. Client approaches the auditor asking him to do the audit. So one day you are sitting in your office, a client has come to you and told, sir, we are so and so company, we want you to do the company audit for us. So whenever the client has came to you and asked you to accept some audit engagement, so here first before I accept and before I accept, I will perform certain activities. See, first of all, if a client is coming to me and asking me to do the audit for them, I need to determine whether I should accept that position. I will consider various factors like what is the status of my client, what is the nature, are they fraudulent people, are they genuine people, are they person of integrity or not, am I having capable resources to complete the engagement, will I be able to comply with the ethical requirements. So like that, various factors auditor will consider. Once he has considered all the various factors and if he has satisfied that okay, it will be fit for me to accept this client engagement, then only he will accept it. Okay, so a client is approaching the auditor asking him to do some engagement for him. Now you have to decide whether you will accept that engagement or not, depending on various factors which we will see it later as a part of this discussion. Then okay, and after you have accepted the audit, you have to be clear. You have to be clear about the terms and conditions. Why? Because like in any other commercial engagement, even in audit also, there is a chance of misunderstanding. In every commercial transaction, there is always a chance of misunderstanding. Do you agree with me or not? Yes, there might be misunderstanding with regard to payment. There might be misunderstanding with regard to deliverables. There might be misunderstanding with regard to the responsibilities. Audit is not an exception. Even audit is also a commercial transaction. So in audit also chances of misunderstanding are there. So you need to get clear with the terms and conditions of the engagement. So generally how we can get that clear understanding is by drafting something called engagement letter. In that engagement letter, you will write all the terms and conditions, the responsibilities of the auditor, responsibilities of the management. So what is expected from you, how you are going to give the report, all that terms and conditions you will agree. So basically what we will do first, as I have told, we will decide on accepting the relationship. Number two, we will draft the engagement letter. And there are few more formalities like communicating with the previous auditor, which you will see it in the subsequent chapter, professional ethics. Even we are required to communicate with the previous auditor once. So like that, some formalities will be there. All that formalities we will fulfill. This I generally call it as preliminary engagement activities. What I will do? Preliminary engagement activities I will try to perform. So basically these are the activities which I will do even before I start doing the audit. I will perform all these activities. If you see the examples, whatever I have told you here, like deciding whether to accept the relationship or not, drafting the engagement letter, communicating with the previous auditor, all this I have done even before I start doing the audit. So these activities I call it as preliminary engagement activities. So I perform all the preliminary engagement activities, and if I have accepted the audit, then the next step what I will do is I will plan. As I have told, this is not a full and final list, guys. Periodically we will come and make some changes wherever necessary, depending on the chapter we are covering. We will come back and make the changes to this structure. See, like any other activity requires the planning, even audit also we need to plan. But in the case of planning of audit of the financial statements, there are three stages involved. One is establishing of audit strategy, other one is development of audit plan, and the final stage is development of audit program. So I will do the planning. Along with that, materiality determination and all also I will do. Like I have told, we need to fix the materiality. No, materiality is subjective term, I have told. So what is material, what is not material? So that materiality I will fix. I will do the planning, materiality fixation and all will happen. And whatever planning you have done, that planning should be executed or not. That plan should be executed. Basically, you will sit at the time of planning, you will sit and analyze, okay, these things I have to perform, these things I have to do, these activities I need to perform. So like that, you will do all the planning, and that plan needs to be executed. Basically, the execution phase of the audit, what we mainly do is we perform something called audit procedures. Execution is nothing but what? Performance of some procedures, which we call them as audit procedures. So what we try to do in the execution phase, we basically try to perform audit procedures. Sir, what do you mean by procedures? What do you mean by audit procedures? See, audit procedures is a very broad term. Audit procedures is a very broad term. It includes everything which you have done in the audit to obtain something called evidence. To obtain something called what? Evidence. Now, if I change here, if I divert from this structure for a while now, see, the ultimate objective of the auditor is to what? Express an opinion. Just in the previous session we have covered, just in the previous chapter we have covered, the ultimate objective, the final product of the entire process of the audit is to express an opinion. So that opinion you have to express. That is where the audit will come to an end. So this is the starting process. Client is approaching the auditor, asking him to do the audit. This is the starting process, whereas the last ending phase is expression of opinion. Now, like any opinion in this world requires some supporting information or not. Say for example, if you came to me and told, sir, I need an opinion on so and so person. You're coming to me and asking me, sir, do you know a person who is a chartered accountant? I want your opinion on him. See, if I have to give an opinion on a person, on an object, on a place, I should have some supporting information. Without information, just in fluke, I can't say anything, right? Even in the audit also, if I am expressing the opinion, that opinion should be based on some supporting information. That supporting information in the audit terminology, I call it as something called audit evidence. Audit evidence, I call it. So what do you mean by audit evidence? The information supporting the auditor's opinion. Like any opinion should have a supporting information, even the auditor's opinion also should be supported by proper evidence. That evidence we call it as audit evidence. So only when we have audit evidence we can express the opinion. But just because you are an auditor, the moment you have been appointed as an auditor, automatically evidence will not come and fall in your lap. You need to perform some procedures. Just because you are appointed as an auditor, the evidence will not automatically come and fall in your lap. You need to perform some procedures from your end to obtain the audit evidence, which will give the basis for your opinion. And that procedures which we are performing to obtain the audit evidence, that procedures we call it as audit procedures. That procedures we are going to call it as what? Audit procedures. So basically, the procedures which you as an auditor have performed to obtain a sufficient and appropriate evidence, that we call it as opinion. That evidence, that procedures we call it as audit procedures. So this is what basically happens. This is what the overall structure, this is what basically happens in the entire audit process. But still, I'm telling you, this is not the full and complete chart. This requires various upgradations and updations over a period of time as we discuss the subsequent chapters. But for the time being now, so tell me what and all is involved here. First, the first step is the client approaches the auditor. Then you will perform some preliminary engagement activities. Then you spend your time for planning and determining materiality. Then that plan is required to be executed, and the execution of the plan actually happens by way of performance of audit procedures. By performing that procedures, you are going to get something called audit evidence, and based on that audit evidence, you are going to form an opinion. You are going to express an opinion. The moment you express your opinion, the process of audit will come to an end. The process of audit will get completed. Clear, everybody? See, now what we are going to do is we are going to hit the last part. So we are going to first understand the final product. See, why? Because if you are clear about your final product, then you can streamline your procedures, right? Yes or no? See, for example, if you are a manufacturing concern, you are going to start a manufacturing entity. If you don't have clarity of your final product, how your final product should be, how much quality it should have, what standards it should have, so which customers it is going to tackle, unless you have a complete picture of your final product, will you be able to set up your entire manufacturing process? No. So even in the audit also, before we can go into the details of the what exactly going to happen in the entire process of the audit, it's always better to know what is our final product. So first we will become clear, first we will all become aware of what is the final product we are expecting. So what is the ultimate result we want, and then we will go into the procedural formalities. Okay. So now in the audit reporting chapter, I am going to talk about this final phase of the entire process of the audit, which is expression of opinion. Okay. So one thing we are all clear now, the ultimate objective of the auditor is to express an opinion. Sir, but how that opinion will be expressed? How that opinion will be expressed? See, when I say you are required to express an opinion, if I am an auditor, I am conducting audit of some company, my ultimate objective is to express an opinion. So how do I express that? Will I post a video on my YouTube channel? So I have this YouTube channel. Will I post a video here saying I am conducting audit of so and so company, I am giving an unmodified opinion? Do you think is it appropriate? Or can I go to the general meeting of the company, take the mic there and announce my opinion? I have conducted audit of this company and my opinion is this and that, blah blah blah. Can I speak out before the shareholders? Will it be worth? No. So when I say you have to express your opinion, that opinion should be in a written document. So whatever opinion you are required to express, that opinion should be in a written document, and that written document which contains the auditor's opinion, that we are going to call it as audit report. That we are going to call it as what? Audit report. So the ultimate objective of the auditor is to express an opinion, and the proper way of expressing the opinion is not orally or making a YouTube video or something like that. That opinion needs to be presented in a written format, and that written document which contains the auditor's opinion, that I'm going to call it as audit report. And how to prepare that audit report? I'm telling that final product, no, that final product of the entire process of the audit is audit report. And in this chapter, audit reporting, we are going to learn how to prepare this audit report, what should be the format of the audit report, what should be the contents of the audit report. That's what basically we are going to learn here. Everyone able to understand here? Right. So now how to prepare that audit report? Actually, we have some standards, 4 standards we have, which are actually talking about the format, structure and presentation of the audit report. Sir, which 4 standards are talking about the audit report? The 4 standards which are talking about audit report are: number 1 is SA 700, then we have SA 701, then we have SA 705, and after that we have SA 706. So these are 4 standards we have which are talking about audit report. What should be the format, what should be the contents, what should be the presentation, what should be the structure? Every discussion has been contained in this 4 standards. Okay, and not just this 4 standards, along with that we also have various sections of the Companies Act which are going to talk about how reporting requirements of the auditor. So we have 143 subsection 1 of the Companies Act, 143 subsection 3 of the Companies Act, 143 subsection 11, 143 subsection 12. So like that we have 4 subsections which are actually talking about the reporting requirements, that also we are supposed to cover. So this is what the entire discussion which we are going to have in this chapter, audit reporting. So 4 SA 700 series of the standards, along with that a few subsections of section 143 of the Companies Act talking about the auditors reporting requirements. Okay, so first what we will try to do is we will try to hit with SA 700, which is the first and foremost standard in the SA 700 series, which is guiding us how to prepare the audit report. And the main subject matter of this discussion is how to prepare, what will be the contents of the audit report. That is the main objective and scope behind that SA 700. So let us try to understand what should be the format and what should be the contents of the auditor's report. Okay, so if you come to SA 700 here, so these are all the contents of the auditor's report. So what should be the contents? Here we have the list of contents. Let us see here. So first there should be title. So even if we have a look at the practical reports also, so generally in our regular sessions and the EOB lectures, we take the help of the audit reports to make us understand here. Just give me one moment, whether for example sake, we will take one practical reports, because these days instead of asking the direct theory questions, they are asking the questions of drafting. Mainly they're asking questions of drafting in the audit reporting chapter, like they're asking you draft the opinion paragraph, draft the basis for opinion paragraph, draft the emphasis of matter paragraph, draft the other matter paragraph. So like that they are giving questions these days revolving around the drafting. To know the drafting, to get comfort of the drafting, we need to look at one practical example. So let us have a look at one practical example here. So just give me one moment, I will load any practical audit report here. Just give me 1 minute. Okay, so looks like I have to download. Just give me a minute. Okay, got it. Fine. Perfect. So here I have taken one audit report for the sake of our reference, which we can use it for the purpose of our discussion. So why I am putting the emphasis here on showing you that practical reports is, so as I was saying, in the recent days, instead of asking you the direct theory questions, they are asking the questions regarding drafting. So in order to know the drafting, we need to have a practical experience, right? So having said that, let me talk about the first and foremost thing. So contents of the auditor's report. Sir, what should be the contents of the audit report? So as I have told, audit report is a document through which we are expressing the opinion, but the standard did not leave it to our choice. Sir, how I have to draft the audit report, which paragraphs I have to use, what language I have to use. That freedom the standards have not given to us. The standard told, we will tell you the format, we will tell you the terminology, we will tell you the contents, we will tell you the paragraph. Simply follow it and give your audit report strictly in compliance with it. So SA 700, the first and foremost standard, forming an opinion and reporting on the financial statements. So this standard is giving us the contents. Let us try to understand each and every content in a detailed manner. Number one, first and foremost content in the audit report, there should be a title. Sir, what do you mean by title? There should be a proper heading for your audit report. Generally, the title of the audit report in the case of statutory audits is they will use the title called Independent Auditor's Report. What title they will use? They will use a title called Independent Auditor's Report. So like that, one appropriate title or heading will be there. Then once you have given an appropriate title to your report, the next thing is addressing. See, basically, audit report is a document, is a kind of letter through which you are expressing an opinion. So there should be some address. When I say it is a letter through which you are expressing an opinion, who is that addressee of the letter? So that addressee you have to mention. Generally, they are owners. Addressee will be the owners. Like in the case of a company, you will address that audit report to the shareholders or members. If it is a partnership firm, you will address your opinion to the partners. If it is a sole proprietor, to the concerned sole proprietor. So depending upon the legal form or structure of your client, you will decide accordingly who will be your addressee, appropriate addressee you will try to present it. So like even if we have a verification, even if we have a look here, as you could see, first there will be a title, Independent Auditor's Report, an appropriate title will be there. After that, addressee will be there. Addressee will be generally the members of the company. In the case of a company, it will be members, right? So first we will do this two. Title will be there, addressee will be there. Now immediately after that, the first and foremost paragraph in the auditor's report should be opinion. See, title and addressee, these are not opinions, these are something like headings. So the first and foremost paragraph in the audit report should be opinion. The standard SA 700 told, boss, you are giving the audit report to express your opinion. So first directly come to the point, tell us your opinion. After that, whatever you wanted to say it. So then comes the first and foremost paragraph in the auditor's report, which is opinion paragraph. Now, we need to have a discussion regarding opinion paragraph. So the ultimate objective of the auditor is to express an opinion. So let us try to have a quick understanding of different kinds of opinion. So guys, if you are already able to remember, I have divided the opinions into two broad categories. Like any other opinion, even auditor's opinion also can be broadly divided into two categories. What are the two broad categories of the opinion? Number one is unmodified opinion and number two is modified opinion. So if I have to put it in common parlance, unmodified opinion is something we call it as positive opinion, whereas modified opinion is something I can call it as negative opinion. So we need to become clear now when we will give unmodified opinion, when we will give modified opinion. So first I will talk about the easy one. We will give unmodified opinion when we have obtained sufficient and appropriate audit evidence that financial statements are free from material misstatements. And also we have obtained sufficient and appropriate audit evidence and we are satisfied that financial statements are prepared as per applicable financial reporting framework. So when we have performed our audit procedures and we have obtained sufficient and appropriate audit evidence, what evidence we have obtained? That financial statements are all free from material misstatements and also the financial statements are prepared as per applicable financial reporting framework. Basically, when we have obtained evidence regarding the two objectives, whatever we have seen in the introduction part. So if we are satisfied with the two objectives, we give something called unmodified opinion. And there are other names for this unmodified opinion. We also call it as unqualified opinion or even we call it as clean opinion also we can call it. Clean opinion, unqualified opinion, unmodified opinion, whatever you wanted to call it, you can call it. Sir, now what kind of terminology I have to use? What kind of terminology I have to use? Why? Because if you are giving unmodified opinion, since we are going through all this formal education, since we are learning all the standards, we will get to realize when we say unmodified opinion, we chartered accountants can realize that, okay, this is a genuine, this is a positive opinion. But can you expect everybody to understand in the same manner? Why? Because everybody is not learning the standards on audit, right? So that's why we can't overcomplicate the readers by using this technical terminology. The standard told, if you are giving unmodified opinion, we will give you the phrases, use only that phrases. What the standard has told, if you are giving an unmodified opinion, we will give you the phrases which you have to use only those phrases. Sir, what are those phrases I have to use? So the standard says you are required to use the phrase that financial statements are giving a true and a fair view. So however, if I put it in different way here, so if you are giving unmodified opinion, how to use the phrases in your opinion paragraph says it depends on whether you are reporting on the financial statements prepared as per fair presentation framework. It also depends on whether you are reporting on the financial statements which are prepared as per compliance framework. As I have already told, if it is a fair presentation framework, my objective will be, the objective of the fair presentation framework will be to achieve fair presentation. Whereas compliance framework, the objective of the compliance framework is a strict compliance. So if I am conducting audit of the financial statements prepared as per fair presentation framework, and if I have performed all my audit procedures, if I am satisfied that financial statements are prepared as per applicable financial reporting framework, financial statements are free from any kind of material misstatement, if it is a fair presentation framework, I have to use the phrases financial statements give a true and fair view, or alternatively, what phrase you can use as financial statements present fairly in all material respects, that too in accordance with the applicable financial reporting framework. Why? Because we expect, if we are reporting on the financial statements prepared as per fair presentation framework, my objective there is to check whether that financial statements are giving true and fair view. So if I am satisfied that everything is okay with the financial statements, I have to use any of these phrases. Which phrase I have to use? Either I have to use the phrase financial statements present fairly in all material respects, or alternatively I can use the phrase financial statements give a true and fair view. On the other hand, if I am reporting on the financial statements which are prepared as per compliance framework, here I have nothing to do with the true and fair view. I am required to only comment whether they are prepared as per the financial reporting framework. I have nothing to do with checking the true and fair view. So here I need to check only whether they are strictly prepared in compliance with the compliance framework. So in case if you are conducting audit of the financial statements prepared as per compliance framework, and if you are satisfied, yes, the financial statements are prepared as per the compliance framework, then then which of phrases you have to use here is, so you have to use the phrase something like this: accompanying financial statements are prepared in all material respects in accordance with applicable financial reporting framework. Here you are not supposed to say anything related to true and fair view, because that is not our objective in the compliance framework. But in case if you are conducting audit of the financial statements prepared as per fair presentation framework, any of these two phrases we can use. Either we can use the phrase financial statements are present fairly in all material respects, or you can alternatively use the phrase financial statements give a true and fair view in accordance with applicable financial reporting framework. And if you see here in the compliance framework, there is no reference given for true and fair view, because that is not required in the compliance framework. Able to understand? Clear and comfortable, everybody? So this is what regarding unmodified opinion. Okay, so when we will give unmodified opinion, when we have obtained sufficient and appropriate audit evidence, and when we are satisfied that the financial statements are free from material misstatements and they are prepared as per applicable financial reporting framework. Okay, so even if we have a look at the practical discussion, so even if you look at here it is an opinion of the auditor on this fair presentation framework. Generally, whatever financial statements which companies will release, all that are fair presentation framework. So here if you see, the auditor has given the opinion. If you look at the opinion paragraph, as I've told, drafting is very important. So everywhere you look at the opinion paragraph in the audit report, it will contain two subparagraphs. Everywhere the opinion paragraph will contain two subparagraphs. The first subparagraph, I will come back to that later. The second subparagraph will actually contain the opinion of the auditor. So let us see what the auditor is saying here. In our opinion, and to the best of our information, and according to the explanation given to us, the aforesaid standalone financial statements give all the information required by the Companies Act and in the manner so required, and they give a true and fair view in conformity with the accounting principles of the state of affairs and also the profit. So the most important thing where you have to pay attention here is what phrase the auditors of Reliance have used. They have used the phrase that the financial statements are giving a true and fair view. So that means what kind of opinion it is? Unmodified opinion. See, nowhere in this paragraph you will be able to find the term unmodified, but still we are able to identify this is an unmodified opinion. How come we are able to identify that this is an unmodified opinion? With the help of this terminology. Able to understand? Right. Now, let us come back to the other discussion. Sir, modified opinion. When we will give modified opinion? See, basically, if I put it in very simple terms, if the auditor is not satisfied with the true and fair view, if the auditor is not able to obtain, if the auditor is not satisfied that financial statements are free from material misstatements, or if the auditor is not satisfied that financial statements are prepared as per applicable financial reporting framework, or when the auditor is hesitant to say that financial statements give a true and fair view, that means auditor doesn't want to say financial statements are giving true and fair view because he found something wrong. He had some trouble in saying that. Then auditor will bring a negativity in his opinion. So whenever the auditor brings a negative comment in his opinion, that opinion we are going to call it as modified opinion. Technical definition of the modified opinion, we'll come back to that later, but one basic concept you have to understand here: when the auditor doesn't want to give a completely positive opinion, when he is having some trouble in saying that, that means when he found something is wrong in the financial statements, then he will give a modified opinion. So before we look at the definition of the modified opinion, so let us try to understand the three kinds of modified opinion. So there are three kinds of modified opinion. So what are the three kinds of modified opinion? Number one is qualified opinion. Then number two, we have adverse opinion. And number three, we have disclaimer of opinion. So we need to understand when the auditor will give qualified opinion, when the auditor will give adverse opinion, and when the auditor will give disclaimer of opinion, that we will try to understand. So if I give you the quick revision of all these three opinions, the qualified opinion can be given in two cases. Qualified opinion can be given in two circumstances. Sir, what are the two circumstances? Circumstance one, auditor has obtained sufficient and appropriate audit evidence. So auditor obtained sufficient and appropriate audit evidence. It is available. Auditor was able to perform audit procedures. He was able to obtain audit evidence. And depending on that audit evidence, he concluded that financial statements contain a misstatement. He concluded that financial statements contain a misstatement. There is a misstatement in the financial statements. So what is there? There is a misstatement. He found some mistake in the financial statements. And he concluded that the effect of the misstatement is only material and not pervasive. Misstatement is material. So he performed audit procedures, he obtained sufficient and appropriate evidence. On the basis of that evidence, he concluded that financial statements contain a what? Misstatement. A misstatement is there in the financial statements. The effect is material, but it is not pervasive. Sir, what do you mean by pervasive? Pervasive technical definition, we'll come back to that in a while. But the meaning of the pervasive, the general meaning of the term pervasive is a misstatement will be considered as pervasive if it is big enough to say financial statements are completely wrong. If I have to even put it in simple terms, very big misstatements, I call it as pervasive misstatements. So here what is happening is auditor has performed audit procedures. He obtained audit evidence. On that evidence, he concluded that financial statement contain a misstatement. That misstatement is material. Yes, that is significant effect. That is significant enough. But is it very big? No, it is not very big. In that cases, auditor will give something called what? Qualified opinion. So this is one case where auditor will give qualified. So one more case where auditor can give qualified opinion is auditor is unable to obtain sufficient and appropriate audit evidence. The auditor is unable to perform audit procedures, and because he is unable to perform audit procedures, he is unable to obtain audit evidence. Like if I give you some example, if I give you one quick example to make you understand, say I am conducting audit of this balance sheet of the company. So there are fixed assets, there are current assets. Under current assets, I have inventory, trade receivables, cash and cash equivalents. So like that, various assets I have. And liabilities also I have, share capital I have, reserves and surpluses I have, long-term borrowings I have, short-term borrowings I have. See, I am able to perform audit procedures on every item. I am able to obtain evidence regarding share capital. I am able to obtain evidence regarding reserves and surpluses. I am able to obtain evidence regarding borrowings. Fixed assets, I was able to obtain evidence. Trade receivables, I was able to obtain evidence. Cash and cash equivalents, I was able to obtain evidence. But this inventory, I am unable to obtain sufficient and appropriate audit evidence. There is a place where the inventory has been kept. At that inventory, there is a very bigger figure here. Say, for example, total inventory amount is 50 crore rupees. Out of that, 5 crores worth of inventory was kept in a warehouse. That warehouse I can't go and physically verify because of some calamity. One quantity of stock worth amounting to 5 crore rupees was kept in a warehouse, which he was unable to visit to obtain that evidence. So that's why I was unable to obtain that evidence. So here, if you look at this typical scenario, auditor is unable to obtain sufficient and appropriate audit evidence. And if at all the matter regarding which I am unable to obtain evidence, regarding 5 crores worth of inventory, I am unable to obtain evidence. If at all this goes wrong, 5 crores I am unable to obtain evidence. So I am assuming if at all this 5 crores of stock itself is not there, what will be the possible effect? So here I have to use the phrase possible effect. So I am unable to obtain sufficient and appropriate evidence, and the possible effect. Why I am using the phrase possible? Because I don't have evidence. I am estimating. The possible effect of the matter regarding which I am unable to obtain evidence is material. If that 5 crores goes wrong, that is material. but it is not pervasive. It is not a very big misstatement to say financial statements are completely wrong. Then also I will give qualified opinion. Then also I will give what? Qualified opinion. So broadly, qualified opinion can be given in two cases. Number one, auditor is having sufficient and appropriate audit evidence available. On the basis of that evidence, he has concluded that financial statements contain a misstatement whose effect is material but not pervasive. On the other hand, auditor is unable to obtain sufficient and appropriate evidence whose possible effect, see wherever, this is very, very important. These phrases are very important. This terminology is very important. This is what will either give you the marks or this is what will make you lose the marks. So you will feel that you have written everything correctly, but you will not use a proper terminology. That's why you don't get the expected marks here. So here I have to use the term possible effect. Whenever sufficient and appropriate audit evidence is not available, you have to use the phrase possible effect. If you don't use a possible effect, gone. You will not get the marks. So I am unable to obtain sufficient and appropriate audit evidence, and the matter which I am unable to obtain evidence, if that goes wrong, the possible effect is material but not pervasive. Then I will give something called qualified opinion. And how to identify the qualified opinion is, what kind of phrase I have to use is, I have to use the phrase something like this: except or subject to certain items. Except or subject to certain items. If it is a fair presentation framework, I will say financial statements give a true and fair view or present fairly. Or if it is a compliance framework, I will say except or subject to certain items, financial statements are prepared as per compliance framework. So if you look at the terminology here, if I am giving qualified opinion, I am saying that except or subject to certain items, financial statements give a true and fair view. Guys, you tell me, is it a completely positive opinion? Am I saying completely financial statements are giving a true and fair view? The answer is no. I am not completely saying financial statements are giving a true and fair view. At the same time, am I giving a completely negative opinion? Am I saying financial statements are completely wrong? No. It is a positive kind of opinion with a slight negative comment. It is not a completely positive opinion. It is not a completely negative opinion. It is a positive opinion with a negative comment attached to it. So that is what we call it as qualified opinion. So how to identify the qualified opinion? What terminology you have to use? So if I show you the terminology here. So these are different kinds of modified opinion have been explained in SS 705. So if you come to SS 705 here, this is what the terminology you have to use, except for the effects of the matters which are described in basis for qualified opinion section. That means except for certain items, financial statements give a true and fair view or they present fairly in all material respects. That means there are a few things are there, few negative things are there. Apart from that, financial statements are giving a true and fair view. Understood? And in two cases, you are supposed to give qualified opinion. Okay. So this discussion, qualified opinion discussion, we have completed. Now let us talk about one more discussion, which is adverse opinion. Now we will talk about adverse opinion. Sir, when auditor will give adverse opinion? So the auditor is supposed to give adverse opinion when he is having sufficient and appropriate audit evidence available. Evidence is there. And on the basis of that evidence, auditor has concluded that financial statements contain a misstatement. On that basis, he has concluded that financial statements contain a misstatement. And the misstatement, the effect of the misstatement is material. It is significant enough. And it is not just a material, it is even a pervasive misstatement. It is a very big misstatement. What is pervasive? I will tell it in a short while. But auditor has performed audit procedures, and by performing that audit procedures, he has obtained a sufficient and appropriate evidence. On the basis of that evidence, he has concluded that financial statements contain a misstatement. The effect of that misstatement is not just a material. The effect of that misstatement is pervasive. It is a very big misstatement to say financial statements are completely wrong. So in those cases, auditor will give adverse opinion. And what kind of terminology you are supposed to use when you are giving adverse opinion is, you have to use the phrase, you have to say directly, it is completely negative. Adverse opinion is something which is completely negative. The auditor will say financial statements do not give true and fair view. Straight away, complete negative he will say. Financial statements do not give a true and fair view. Straight away, completely negative comment he will give it. Able to understand? So if you come back here, adverse opinion will be given in only one case. See, if you have to say something is completely wrong, you can say it only when you have evidence. So that's why for giving adverse opinion, having sufficient and appropriate evidence is a must. So auditor will give adverse opinion when he is having obtained sufficient and appropriate audit evidence and concluded that financial statements contain a misstatement which is material and also pervasive. And what phrase he will use in the opinion paragraph? So because of the significance of matters explained in basis for adverse opinion paragraph, the accompanying financial statements do not present fairly or they do not give a true and fair view. Next one, right? Next one, disclaimer. Sir, when auditor will give disclaimer? So let us have a look at when auditor will give disclaimer. So auditor will give disclaimer of opinion when the auditor is unable to obtain sufficient and appropriate evidence. He is unable to perform audit procedures. He is unable to obtain sufficient and appropriate audit evidence. And as I have already told you, when you use the phrase evidence is not available, you have to use the phrase possible effect. Why? Because we don't know. We are assuming. So auditor is unable to obtain sufficient and appropriate audit evidence and the possible effect of that undetected misstatements. Possible effect of that undetected misstatements is not just material, it will also be pervasive. So if I give you an example for this, if you come back to this here once again, say for example, I am conducting audit of this balance sheet. I am unable to obtain evidence regarding fixed assets. I am unable to obtain evidence regarding inventory. I am unable to obtain evidence regarding trade receivable. I am unable to obtain evidence regarding cash and cash equivalents. Multiple items I am unable to obtain evidence. If at all these items goes wrong, what will be the possible effect? Will it be only material or will it cause a very big pervasive misstatement? It will cause a very big pervasive misstatement. So I am unable to obtain sufficient and appropriate audit evidence and the possible effect of that undetected misstatements is not just going to be material, it is a material as well as pervasive. This material as well as pervasive. Then the auditor will give disclaimer of opinion. And how to identify that disclaimer of opinion is auditor disclaimer. The name itself say disclaimer means what? Stopping yourself. So how to identify the disclaimer of opinion is auditor will use the phrase we do not express an opinion on the financial statements. What phrase auditor will use? We do not express an opinion because we are unable to perform audit procedures. We are unable to obtain sufficient and appropriate audit evidence. We will not be able to express an opinion or we do not express an opinion. The moment you find this phrase, that will be a disclaimer of opinion. So when auditor will give disclaimer of opinion, when he is unable to obtain sufficient and appropriate evidence and when the possible effect of that undetected misstatement is not just a material, it is also pervasive, then the auditor will give disclaimer. And what phrase he will use here? So if you look at it here, he will use the phrase we are not able to obtain sufficient and appropriate audit evidence. Clear and comfortable, everybody? So these are all three kinds of modified opinion, and if you pay close attention here, in every kind of modified opinion we have a negative remark. Qualified opinion, little severe negative remark. So I will say here all these three, qualified, adverse, disclaimer, all three are negative opinions. But how can I differentiate that is the severity of the negativity is changing. What is changing? Severity of the negativity is changing. Qualified opinion is a negative opinion, but severity is very less severe negative opinion. Why? Because I am saying that except certain items of financial statements give a true and fair. Whereas adverse and disclaimer are extremely severe negative opinions. Adverse and disclaimer are extremely severe negative opinions because I am saying that in the adverse opinion, I am saying financial statements do not give true and fair view, they are completely piece of shit. Whereas in the case of disclaimer of opinion, I say that I am not able to express an opinion. Both are extremely severely negative, whereas qualified opinion is a less severely negative opinion. Understood? So whatever it is, first, why we have come to here, why we are discussing this? So why? Because we are discussing the contents from SA 700. There they told the first content is title, the second content is addressee, the third content is opinion paragraph. So we are understanding different kinds of opinion. We have understood broadly two categories, unmodified, modified. So unmodified was explained in SA 700 only. The different kinds of modified opinion, like this, what is qualified, adverse, a disclaimer, all this discussion whatever we had till now, these different kinds of modified opinion and all, this is what the discussion contained in SA 705, modifications to the auditor's opinion. So whatever it is, you have to express your opinion. First, you have to arrive at your opinion, whether you want to give qualified or whether you want to give unmodified or you want to give modified. If you want to give modified, which kind of modified opinion you want to give, either qualified, adverse or disclaimer. And one more important thing here, say for example, if you have decided some important conceptual things I'm going to say here, important from the examination perspective, particularly for MCQs here. See, once you have decided that you will give modified opinion, once you have decided that you will give modified opinion, But which kind of modified opinion you have to give? Either you have to give qualified opinion, or you have to give adverse opinion, or you have to give disclaimer of opinion. This decision will depend on only two factors. This decision will depend on only two factors. Once you have decided you want to give modified, but whether you will give qualified, whether you will give adverse, whether you will give disclaimer, that is going to depend on two factors. Number one is availability or non-availability of evidence. The first factor is availability of evidence, whether evidence is available or evidence is not available. Other one is pervasiveness of the misstatement, whether the misstatement is pervasive or not. So these are the only two factors. Even you can look at this chart also. There are only two factors which will decide which kind of modified opinion I will give. Number one, availability or non-availability of evidence. Number two, what is the pervasiveness of the misstatement. Just these two factors will be enough for me to determine which kind of modified opinion is going to be appropriate. Understood? And one more thing here, before I proceed further with the next contents, one more thing I would like to bring it to your attention here. Sir, you are telling misstatement pervasive or not? No. What is the definition of the term pervasive? What is the meaning of the term misstatement? What is the meaning of the term pervasive? See, pervasive is a term which is used in the context of the misstatements. In the context of the misstatements, to describe the effect of either misstatements or possible effects of the misstatements, we use the phrase pervasive. And they say that we can call a misstatement to have a pervasive effect. Number one, if it is not confined to specific elements, if the misstatement is not restricted to one or two items, if the misstatement is spread across so many items, then we can call it as pervasive. Or even if it is confined, sometimes a misstatement will be confined to a single item, but it could represent or it could represent a substantial portion of the financial statements. Like say for example, I am conducting audit of some company, fixed assets 100 crores are there. Under current assets, I have inventory amounting to 50, trade and trade receivables 30, cash and cash equivalents 20, total 200. See, if I find misstatement in all the items, if it is not confined to one item, if it is spread across multiple items, I call it as pervasive. Sometimes what will happen is misstatement will be confined to only one single item. Misstatement will be confined only to single item. Say for example, misstatement is there only in fixed assets, but the amount of misstatement is 80 crore. Then also I call this as mistake. Then also I call this misstatement as pervasive. Why? Because even the misstatement is confined to a single item, it is representing a substantial portion. It is representing a very big portion of the financial statements. Then also I can call this misstatement as pervasive. Or a misstatement can be considered as pervasive if that misstatement relates to such a disclosure which are fundamental to users' understanding of the financial statements. So if the management has made a mistake in those disclosures of the financial statements which are very fundamental to users' understanding of the financial statements, like for example, if the management if the management has made some mistake in the going concern disclosure, management is giving some wrong disclosure relating to the going concern assumption, then that misstatement will be considered as pervasive. So that's what I was saying, guys. Whenever I say misstatement, don't just imagine the quantitative, that is the misstatement in numbers and figures. Even misstatements can happen in notes to accounts, not just ordinary misstatements. A very big amount of misstatements, pervasive misstatements can happen in the notes to accounts. So this definition is very important. So you tell me when a misstatement can be considered as pervasive. Number one, if it is not confined to specific elements of the financial statements. Number two, even if it is confined to specific elements, it could represent a substantial portion of the financial statements. Number three, if the misstatement relates to those disclosures in the financial statements which are very fundamental to users' understanding of the financial statements. So whatever it is, we will say our opinion in the opinion paragraph. Either it is qualified, adverse, disclaimer, unmodified. So we will say our opinion. And as I was saying, in the opinion paragraph, we tell about our opinion in the second subparagraph. But the standard essay 700 says that in addition to the opinion, should also tell some extra information, some compulsory information you should say along with your opinion. So two subparagraphs are there here. In the first paragraph, some compulsory information should come. In the second subparagraph, opinion will come. So what should be the second subparagraph? We have understood. Now what information is there in the first subparagraph? That let us try to understand it here. So once again, if you come back to the contents here, they say that if you come back to the detailed explanation, yes, here. So what should be the contents in the opinion paragraph? So definitely in the opinion paragraph, we will say our opinion. In addition to our opinion, we should also mention certain extra information in our opinion paragraph. As you could see here, number one, identify the entity. That means you have to mention the name of the entity whose financial statements you are conducting the audit. Number two, you have to mention the fact that financial statements have been audited. You have to mention one statement that financial statements have been audited. Number three, you have to mention the title of each component comprising of the financial statements. Like you have to say financial statements contain balance sheet, P&L, statement of changes in equity, cash flow statement, notes to accounts, etc. And even you have to give a reference to the notes, and you should specify the date or period covered by each financial statement comprising the financial statements. So these are 5 items must come in my opinion paragraph. So what are the 5 items? Along with the opinion. These are along with the opinion. So along with the opinion, these are the 5 things which must come in my opinion paragraph. Number one, you have to identify the entity whose financial statements you are audited. You have to mention the fact that financial statements have been audited. You have to mention the title of each of the items of the financial statements. You have to give a reference to the notes. You have to specify the date and period covered by the financial statement items. That's what you will be able to find it in this first paragraph. Okay, right. So after the opinion paragraph, right, 3 contents we have successfully completed: title, addressee, and opinion. Now let us come to the next paragraph. So once we have given this opinion paragraph, the next one comes, which is basis for opinion paragraph. What is the next one? Basis for opinion paragraph. See, you have told your opinion, but why anybody should rely on your opinion? If you let them know on what basis you have expressed your opinion, then the people will be able to rely on your opinion. Sir, what exactly I should mention in my basis for opinion paragraph? The standard says, SS 700 says, in your basis for opinion paragraph, 4 things you must mention. How many items you have to mention in my basis for opinion paragraph? 4 things we have to compulsorily mention in my basis for opinion paragraph. What are that 4 things? Number one, that you have done the audit as per standards on audit. Number two, you have to describe the auditor's responsibility. You have to say that we have one more paragraph. Generally, if you look at the contents, we have something called auditor's responsibility paragraph. So you have to say that there is one more paragraph called auditor's responsibility. There we have explained all our responsibilities. Like that, you have to give a reference to the auditor's responsibility paragraph. Next, you have to mention a fact that you are independent of the entity and also you are complying with ethical requirements. And also you should say that you have obtained sufficient and appropriate audit evidence. You should also mention that you are giving a sufficient and appropriate evidence. Able to understand? So 4 things must come in my basis for opinion paragraph. What are the 4 things which must come in my basis for opinion paragraph? So if you have a look at the practicality, so if you see this basis for opinion paragraph, they are telling that we have conducted the audit as per the standards on audit. First point covered. Then our responsibilities are further described in auditor's responsibility paragraph, reference to auditor's responsibility paragraph given. Third one, they are saying we are independent of the company and even we complied with ethical requirements. Third point, and we believe that we have obtained sufficient and appropriate evidence. So these 4 things must come in my basis for opinion paragraph. Now, see, these 4 things must come in my basis for opinion paragraph if I am giving a unmodified opinion. So if I am giving an unmodified opinion, in my basis for opinion paragraph, whatever 4 things I have explained, that only will come. But in case if I am giving a modified opinion, when I say modified, it could be qualified also, it could be adverse also, it could be disclaimer also. So if I am giving any of this modified opinion, then what will happen is in my basis for opinion paragraph, in addition to that 4 matters, whatever we have read just now, even you have to explain the reason why you are giving qualified, why you are giving adverse, why you are giving disclaimer. That reasons also you are required to explain. If you are giving unmodified, your basis for opinion paragraph will contain only the 4 things which we have discussed now. But in case if you are giving modified opinion, either qualified or adverse or disclaimer, in addition to that 4 things, even you have to explain the reasons why you are giving a modified opinion. That reasons also you have to explain. And what exactly I have to explain the reasons is, if you come back to the SA 705 here, so what changes I have to make to the basis for opinion paragraph if I am giving a modified opinion. So if you come here, so changes to be made to the basis for opinion paragraph in case if you are giving a modified opinion. So first thing, we have to change the heading. So in both, for both opinion and modified basis for opinion, we have to change the headings. Which means if we are giving unmodified opinion, the title of the opinion paragraph will just remain opinion. Basis for opinion paragraph title will just remain basis for opinion. But if I am giving modified opinion, the titles of the opinion and basis for opinion paragraph should change. If I am giving qualified opinion, the opinion paragraph heading will be qualified opinion. Basis for opinion will change to basis for qualified opinion. If I am giving adverse opinion, my opinion paragraph title will be adverse opinion, whereas basis for opinion will change to basis for adverse opinion. The same thing will happen even for a disclaimer of opinion. Disclaimer of opinion, basis for disclaimer of opinion. So if I am giving a modified opinion, the title of the opinion and basis for opinion paragraph should change accordingly. And not just that, what else they say? Amend the heading, so that we have already said that description and quantification of the misstatement. So in your basis for opinion paragraph, if you are giving a modified opinion, you have to describe the misstatement because of which you are giving a modified opinion, and not just describing the misstatement, even you have to do quantification. Even what you have to do, quantification means what? You have to determine the amount of the misstatement. That amount of the misstatement also you have to mention in your basis for opinion paragraph. Sir, so and so misstatement has happened in inventory. That alone will not be enough. What is the amount of misstatement? Quantify and mention it. Sir, if I am unable to quantify, sometimes because of practical reasons, because of difficulties, you might not be able to exactly quantify the misstatement, then you have to mention that fact. If you are able to quantify, quantify and tell the figure. If you are not able to quantify, mention the fact. If it is not practicable to quantify, mention the same in the section. Then sometimes I will be modifying my opinion because of narrative disclosure. Narrative disclosure means what? In the notes to accounts, management has done a mistake. That's why I'm modifying. If that is the case, you have to explain the basis for opinion paragraph. Explanation of how the disclosures are stated. What wrong disclosures management have given, that you have to explain it in the basis for opinion section. If you are modifying your opinion because of non-disclosure, you might also be required to modify the opinion because management is not disclosing certain items. If you are modifying the opinion because management is not giving a disclosure, then you have to explain that then you have to first discuss that non-disclosure with those charged with governance, and you have to explain in the basis for opinion which information was omitted, and unless there is a prohibition from law or regulation, include that omitted disclosure in your basis for opinion section. If there is no prohibition from law or regulation, you have to explain what should have been the disclosure in the notes to accounts. That disclosure as it is, you present it in the basis for opinion. This disclosure, management exactly in this manner they should have given it, but the management did not give that disclosure. This omitted disclosure, you have to include it. Next, if modification results from inability to obtain evidence. Now, one more thing here. See, I told that 4 general things should come in my basis for opinion paragraph. What are they? Number 1, standards on audit. Number 2, you have to give reference to auditor's responsibility paragraph. Number 3, you say that you have to comply with ethical requirements and independent of the entity. Number 4, you have to say that you have obtained sufficient and appropriate evidence. These 4 things will come in my basis for opinion paragraph. But the standard has specifically told that if you are giving a disclaimer of opinion, your basis for opinion paragraph should not contain the last point. Quite logical, no? Why? Because we are giving disclaimer of opinion because we are unable to obtain sufficient and appropriate evidence. So that's why if you are giving a disclaimer of opinion, your basis for opinion paragraph need not contain this last point, that you have obtained sufficient and appropriate audit evidence. That point you should not include. Similarly, you need not include reference to auditor's responsibilities also. Why? Because in the case of disclaimer of opinion, our auditor's responsibility paragraph also will be very, very limited. We will not give detailed explanation. We will give very limited information in our auditor's responsibility paragraph. We will see it later in the subsequent part of the standard. But when you are giving disclaimer of opinion, out of that 4 points which must mandatorily come in my basis for opinion paragraph, 2 need not come. You need not give reference to auditor's responsibilities, and you need not say that you have obtained sufficient and appropriate evidence. That means if you are giving disclaimer of opinion, your basis for opinion along with the reasons why you are giving disclaimer, it will contain only these 2 information, that you have done the audit as per standards on audit and you have complied with ethical requirements and independent requirements. Very, very important from the examination perspective. Next, yeah, that is what this 6th point is trying to say here. Understood, everyone? So this is what regarding opinion and basis for opinion paragraph. Once again, let us go back to SS 700, try to understand the next content. So we have covered 4 contents till now. We have understood title, addressee, opinion, basis for opinion. Then we have a paragraph called material uncertainty relating to going concern. Sir, what is this paragraph? What kind of content will come under this paragraph? This we will discuss when we take up the standard SA 570. So when we take up the standards on auditing chapter, we discuss about SA 570. There I will tell you what exactly will come under this paragraph. So this you can leave it for the time being now. Then 6, 7 and 8, this we will have a separate discussion. First we will complete 700 and 705 completely. So once we are done with 700 and 705, then we will pick up SA 701 and SA 706. There we will have a dedicated discussion regarding what is the key audit matter, what is emphasis, what is other matter paragraph. At that point of time, we will have a dedicated discussion. Okay. So these paragraphs will have dedicated discussion. After all that, next paragraph which will come in my audit report is responsibilities of management. So in your audit report, you have to include a paragraph where you have to explain what will be the responsibilities of the management. So what exactly I will try to mention here in that responsibilities of the management for financial statements, four things should come here. So as you could see, you have to say that the management is responsible for preparing the financial statements. Sir, what information I have to mention that they are saying in that responsibility paragraph? Number one, you have to say that the management is responsible for preparation of financial statements, that too in accordance with applicable financial reporting framework. And you should also mention that the management is responsible for implementation of internal controls. And also you have to mention that the management is responsible for assessing the entity's ability to continue as a going concern, whether entity will be able to continue as a going concern or not, whether they will be able to continue for the next 1 year or not. Making that assessment is also the management's responsibility. And also you have to identify who is having oversight of the financial reporting process. Basically, who is looking after that financial reporting process, that people also have to identify. In case if those charged with governance is looking after the financial reporting process, that you have to identify. So these are four things that must be mentioned in the responsibilities of the management paragraph. What are they? Number one, they are responsible for preparation of financial statements. They are responsible for implementation of internal control. They are responsible for assessing entities' ability to continue as a going concern. Even you have to mention who is responsible for oversight of the financial reporting process. So after this audit, after these responsibilities of the management, then you have to include a paragraph where you are supposed to explain what are auditors' responsibilities. You have to explain. Why? Because not just management will be having the responsibilities, even auditor also will have a lot of responsibilities to fulfill. So here the list will be never ending, not that important from the examination perspective regarding auditors responsibilities. I will tell you which aspects regarding auditors responsibilities are important. I will tell you. So like if you have a look here, so many things where the question will come in the auditor's responsibilities that I will focus. Remaining will just try to have a brief. Like if you see the auditor's responsibility paragraph here, the list is very lengthy. Like you have to mention all your responsibilities, like you have to obtain reasonable assurance, you are responsible to issue an audit report. Reasonable assurance is a high level of assurance but not a guarantee. And you are worried about material misstatements, and when misstatements will be considered material, that you are required to exercise professional judgment, you are required to maintain professional skepticism, you are required to identify and assess the risk of material misstatement, you are required to understand the internal control, you have to understand accounting policies, you have to check the accounting estimates, you have to decide on use of going concern basis of accounting, whether management's use of going concern basis of accounting is appropriate or not. And if it is a fair presentation framework, you have to evaluate whether the financial statements are giving true and fair view or not. If you have made use of the other auditors' work, then you are responsible to explaining areas. This will have a discussion as a 600. You can ignore this for the time being now. And even you should say that you have some responsibilities to communicate with those charged with governance. What and all matters you have to communicate. This we will discuss in essay 260. In the subsequent revision series, we will understand this. And also you have to communicate key audit matters. And what is the key audit matter? This we will discuss in the essay 701. So like this, various items are there which are required to be included in the auditor's responsibility paragraph. Very big paragraph will be there. So much of information, so many responsibilities of the auditor will be explained. But all this is not important. What is important is this point is important. Location of description of auditor's responsibility. Right. Sir, you told all these responsibilities. No, generally the auditor's responsibility paragraph will be very lengthy, where I have to include all that responsibilities of the auditor. What is the location of description of auditor's responsibility? The standard has told you have to include it within the body of the auditor's report. That means within the auditor's report only, keep a paragraph auditor's responsibility and explain all the responsibilities there. This is what in 90% of the cases it will happen. In majority of the cases, this only will happen. So whatever responsibilities of the auditor are there, all that responsibilities, they will include it within the auditor's report only. Like as you could see here, so within the audit report, they have included a paragraph, auditor's responsibilities, and all that responsibilities they have explained here. So you can include it within the body of the auditor's report, or even you can add an appendix to the auditor's report. So what do you mean by appendix? So if you feel that because of this auditor's responsibility paragraph, my report is looking very lengthy and people are not reading important information. So what I can do is I can just give the heading here, auditor's responsibility. I will not write all these responsibilities here. what I will say is I will add it here, refer appendix 1. Refer appendix 1, appendix 2. That means what I will do is this information, this detailed information, I will not include it here. After this audit report, I will add one attachment. I will give a heading, so and so appendix, so and so annex here. There I will explain all the responsibilities. What I will just say here is I will give the heading here, auditor's responsibilities, and I will say refer appendix number 1. I will add one attachment to the audit report where I will explain all that responsibilities. Or what else the standard has given the permission is, if you see here, by a specific reference within the auditor's report to the location of such a description of an website of an appropriate authority where law, regulation or the auditing standards expressly permit the auditor to do so. That means sometimes what will happen is whatever your responsibilities are there, those responsibilities are already mentioned on a website. Your responsibilities are mentioned on some website. If you are permitted by law or regulation, what you can do is, instead of writing all your responsibilities here, or instead of adding it in the appendix, what you can say is, you can say refer to so and so website. That link you can give, provided if it is permitted by law or regulation. Instead of writing your responsibilities here, if your responsibilities are stated somewhere on a website, that link of the website also you can add it here. Able to understand? From here question might come either in the form of MCQs. So whatever it is, location of description of auditor's responsibility, where it should be either within the body of the auditor's report or as an appendix to the auditor's report, or if permitted by law or regulatory authorities, you can give a reference to the website or description of the website where your responsibilities are mentioned. So this is important. And one more important thing here, see, in case if you are giving disclaimer of opinion, then your auditor's responsibility paragraph will not be this much detailed. If you are giving disclaimer of opinion, we have seen list of lengthy responsibilities, no? All that responsibilities you should not include in your auditor's responsibility paragraph. Your auditor's responsibility paragraph should be very limited. It should contain minimum information. Sir, what is that? So if you see here, when auditor disclaims an opinion on financial statements due to inability to obtain sufficient and appropriate audit evidence, auditor's responsibility paragraph shall include only the following. Phrases are very important. So that's why while drafting this material, I did not do so much of summarization. Why? Because if you don't learn the standard terminology, you will not secure the marks, you will not understand the question. So what this paragraph says is, if you are giving a disclaimer of opinion, then your auditor's responsibility paragraph need not include all the details whatever I have told you just now. Your auditor's responsibility paragraph should only include certain items. Only 3 items must be included in the auditor's responsibility paragraph. What are they? Number 1, a statement that auditor's responsibility is to conduct an audit as per the standards on audit. However, you have to add one statement that because of the matters which I have explained in the basis for disclaimer of opinion, you are unable to obtain audit evidence. You are unable to obtain a opinion. And the statement about auditor's independence and ethical responsibilities. Only these 3 lines should come in my auditor's responsibility paragraph. No need to have a detailed auditor's responsibility paragraph. Only 3 things must come in my auditor's responsibility paragraph when I am giving a disclaimer of opinion. What are that 3 things? Number 1, that you are required to do the audit as per standards on audit. But however, because of the matters explained in the basis for disclaimer of opinion paragraph, you are unable to perform that procedures, you are unable to obtain the evidence, and you have to include a statement saying that you have to include a statement saying that you are required to be independent and you comply with ethical responsibilities. Just this 3 information should come in my auditor's responsibility. Rest of all the items are not required to be included. Once again, very important from the examination perspective. So let us go back to the contents once again. So we have understood management responsibility paragraph, we have understood auditor's responsibility paragraph, then we have one more paragraph called reporting on legal and other regulatory requirements. Sir, what do you mean by this? See, we are preparing this audit report as per the standards on audit. Apart from the standards on audit, if there are any other reporting requirements as per governing law, like if I am conducting audit of a company, under Companies Act, under 143 of the Companies Act also I have reporting requirements. I have to report on certain matters as per section 143. So where I will include that in the auditor's report, I can use this paragraph, reporting on legal and other regulatory requirements. So this paragraph will be used to fulfill my reporting requirements apart from standards. So that's what the title also says, report on legal and other regulatory requirements. Apart from the standards, if as per some other law or regulation, if you have any reporting responsibilities, you can use this paragraph to report them here. And after including this, finally you have to sign the audit report. Sir, how to sign the audit report? If an individual is appointed as an auditor, the individual will sign the audit report on behalf of his personal name. He will mention his name and sign. He will mention his membership number. If a firm is getting appointed as an auditor, not all partners will sign. One partner will sign on behalf of the entire firm. So he will sign in his personal name. He will also mention the name of the firm. He will mention his membership number, and also he has to mention the firm registration number. All this he has to include. So whatever it is, or the audit document this report should be signed. If an individual is appointed in his personal name and mentioning his membership number, if a firm is appointed, a partner will sign on behalf of the entire firm, and he will mention his personal name. He will mention the name of the firm. He will mention his membership number, and he will also mention his firm registration number. So whatever it is, that audit report is required to be signed. And then date of signature, the date on which you are putting that signature, the date on which you are signing the audit report, the date of signature you have to mention. The place of signature you have to mention, generally the city to which that the city at which you are signing that report, that date, that place of signature you have to mention. And UDIN is also required to be generated, and that UDIN is also required to be mentioned below your signature. As we all are aware, without the UDIN, today the auditor's signature is not having any validity. UDIN is also required to be included. Understood? So these are all the contents of the auditor's report as per SA 700, and we have covered in a detailed manner all the contents. Okay, so now if you come back to SA 705, there is some more little discussion I would like to explain in SA 705. Then we will wind up 700, 705. We'll go to 701 and 706. So one important information I have to explain here. Yes, sometimes see, one more thing here. Before you want to modify the opinion, before you want to give either qualified, adverse or disclaimer of opinion, first you might be required to communicate the matter with those charged with governance. So if you want to modify your opinion, when I say modifying my opinion, either it could be qualified opinion, disclaimer of opinion, adverse opinion, whatever it is. If I want to modify my opinion, you have to first communicate with those charged with governance, then only you have to modify. They don't say obtaining the permission, just you have to have a word with them and then you can modify. Then this point is important. Consequences of inability to obtain sufficient and appropriate evidence to the management due to management imposed limitation after the auditor has accepted the engagement. That means what will happen is, you are a chartered accountant, the client has approached you, asked you to do the audit. Okay, you accepted the audit, you started doing the audit. But after you have accepted the audit, the management is putting a restriction on you. The management is putting a restriction on you. They are not letting you do your work. Every time they are coming and putting a restriction, because of which you are unable to obtain audit evidence. Because of management imposed limitation, after you have accepted the audit, management is putting a limitation on you, because of which you are unable to obtain audit evidence. Then what you are supposed to do? Very simple steps they will try to say. If you are unable to obtain evidence because of management imposed limitation, they say here, first go and what they say here is, first to go and request the management to remove. Sir, you are putting unnecessary limitation on me, because of which I am unable to continue with my work. Please remove the limitation. Go and request. See, if the management removes the limitation, well and good, we will continue with the audit. But when the problem will come, we have went and requested the management to remove the limitation, but the management is not removing it. Then what we should do? If the management refuses, the auditor shall communicate the matter to those charged with governance. Sir, your management is putting a restriction, and I have requested them to remove it, but still they are not removing it. So you go and communicate with those charged with governance. And if after communicating with those charged with governance also, still if the limitation is not removed, then you should try to look at alternative audit procedures. Whether can you perform any alternative audit procedures to obtain the evidence, evaluate. If you are unable to perform alternative audit procedures also, so what you have done till now, first you have went and requested the management to remove. If the management did not remove it, then what you should do? You should go and request with those charged with governance. Even if those charged with governance are also not removing it, then you should see whether alternative procedures you can perform. See, if alternative procedures also not available, even by performing alternative procedures also you are not able to obtain sufficient and appropriate evidence, then what you should do, sir? Then you should determine what is the possible effect. So you are unable to obtain audit evidence, no? Because of that matter of which you are unable to obtain audit evidence, what will be the possible effect? See, if the possible effect is only material but not pervasive, don't take any extreme step. Continue the audit, give a modified opinion, give a qualified opinion. So if you are unable to obtain evidence because of management imposed limitation, even you are unable to perform alternative audit procedures, you do one thing, determine what is the possible effect. If the possible effect is only material but not pervasive, what you will do? You will give a qualified opinion. Continue the audit and give the qualified opinion. If you feel that if the possible effect of the misstatement is material and pervasive, you are unable to obtain evidence because of which the possible effect is material and also pervasive, and it is not an ordinary limitation, it is a limitation imposed by the management, then standard says first option, withdraw from the engagement. To the extent possible, withdraw from the engagement. In case if withdrawal is not permissible, in some cases withdrawal will not be permissible. In those cases, what you should do is you should continue the engagement and give the disclaimer. But wherever possible, you have to withdraw. If the possible effect because of non-availability of audit evidence or due to management imposed limitation is material and also pervasive, to the extent possible, you have to withdraw from the engagement. If a withdrawal is not permissible, then continue the audit and give the disclaimer. Now you will get a doubt, sir, when withdrawal is not permitted. Very important, most ignored aspect. From here, MCQs are getting tested. Pay attention here. Sir, when withdrawal is not permitted. See, in case of a listed company, SEBI has given some directives and even there are LODR regulations. Because of SEBI and LODR regulations, in some cases, in listed company, you just like that can't withdraw. Sir, when you can't withdraw, say for example, as we all are aware, listed companies will even have quarterly financial statements also. Yes or no? Right. So what they say here is, I'll try to explain it in a simple manner. Say for example, there is one quarter. Okay. Oh shit. So let me explain it here. So say for example, April to March, financial year 24-25. So say for example, April to June, this quarter was completed. Okay. And if you are resigning within 45 days, if you are resigning, you can resign it only after giving the report for this quarter. For this quarter, you will do review engagement, no? So you have to give report for this quarter, then only you can resign. Then in case if you are resigning after 45 days, from the end of the quarter, if you are resigning, you can do it only after giving the report for this quarter, April to June, and also the next quarter. That means for July to September also you have to give the report. You just like that can't withdraw. In case, and one more thing they say here, if you have already given review reports of 3 quarters, that means April to June quarter, you have already given a review report. July to September quarter also you have given a review report. October to December quarter also you have given the report. After giving reports for all the 3 quarters, then you want to resign, you can't do it. In that case, you have to give the audit report for the entire year also. Then withdrawal will not be permitted. You have to continue the audit for the entire year and complete the audit. So in these kind of circumstances, withdrawal becomes very difficult. Then in that cases, you can't withdraw. You have to continue the engagement and give a disclaimer of opinion. So very, very important, guys. This is where the questions are going to come from. MCQs, like if you see here, when withdrawal is not permitted, if resigning within 45 days from the end of any of the quarters of the period covered under appointment, auditor must first issue audit or limited review report for that quarter. If you are resigning after 45 days, the auditor must issue reports for that quarter and the next quarter. If review reports are issued for all the 3 quarters, the audit report for the full year must be issued. That means you can't withdraw just like that. You have to complete the audit. Understood? Clear and comfortable, everybody? So these are the important information from SA 705 and 700. And one more thing, one more small paragraph I want to cover from SA 700. After that, we'll go to SA 701 and 706. This one, supplementary information presented along with the financial statements. In case if any extra information is getting presented along with the financial statements, they are adding one more supplementary information which is not required as per applicable financial reporting framework, but to the financial statements they have attached that supplementary information. Sir, then what about your opinion? Will your opinion cover only financial statements, or will your opinion cover supplementary information also? Will your opinion cover only financial statements, or will your opinion cover even supplementary information also? How to decide it? That decision, whether my opinion will cover only financial statements or even my opinion will cover supplementary information also or not, it depends on auditor's professional judgment in determining whether that supplementary information is an integral part or not. So whether my opinion will cover will my opinion cover only financial statements, or will my opinion extend to financials, will my opinion will extend to supplementary information also or not, that depends on auditor's professional judgment of whether that supplementary information is an integral part or it is not an integral part. If it was decided that supplementary information is integral part of the financial statements, then it should also be covered by auditor's opinion. If you feel that along with the financial statements, they are adding some one more page. Say for example, they are giving product wise revenue, not required as per applicable financial reporting framework, but management has added that statement. Now you use your professional judgment and determine whether that product wise revenue is it an integral part or not an integral part. If you feel that it is an integral part, even you have to express your opinion on the supplementary information also. If you feel that it is not an integral part, it is not an integral part of the financial statements, then what you should do? Then the auditor should evaluate whether supplementary information is presented in such a way that it is clearly differentiated from the audited financial statements. If you are not giving your opinion on the supplementary information, then you should make sure that it is properly separated. That supplementary information is properly differentiated from the financial statements. Why? Because if it is not properly differentiated, the user might have a notion that even your opinion is on supplementary information also, but you are not giving it, no. So that's why you have to make sure that the management has properly differentiated that supplementary information with my financial information. If this is not the case, if the management is not differentiating, if the management is clubbing, then the auditor shall ask the management to change how the unaudited supplementary information is presented. You should ask the management, no sir, I will not agree to it. Please separate it. Or at least give a heading for that information that it is unaudited. You have to ask the management to take that proper care. If the management refuses to do so, if the management is not differentiating, if they are not identifying that it is unaudited, then the auditor shall identify unaudited supplementary information and explain about that in the auditor's report, saying that that information has not been audited. If the management is not bifurcating that, so you include in your audit report, there is some paragraph called other information, not other matter. The management, the auditors generally use one paragraph called supplementary information or other information, like that they will use one extra paragraph. In that paragraph they have to say that your audit report is only on financial information, your opinion has nothing to do with the supplementary information, that you can highlight it in your auditor's report. Understood? Important from the examination perspective. Okay, I think with this we have successfully completed 700 and 705. Now we will try to cover two standards, 701 and 706, which talks about three contents. One is key audit matter and the other one is emphasis of matter and other matter paragraph. Key audit matter paragraph is covered under 701, emphasis of matter and other matter paragraph is covered under SA 706. So let us try to understand these are two standards. With that 700 thing will come to an end. Then we will discuss reporting requirements under 143 subsection 143 subsection 1, 3, 12 and 11, that we will try to have a understanding. But before that, let us try to complete 701 and 706. We will try to cover it. So we will try to communicate now. We'll try to understand now the contents of SA 701, which is talking about communicating key audit matters in the auditor's report. So now the standard has initially we used to have SA 700, 705 and 706. After a certain period of time, they have introduced this new standard called SA 701, and this new standard SA 701 asks the auditor to include in their audit report one more content called key audit matters in their auditor's report. So SA 701 requires the auditors to include in their auditor's report one more paragraph with the heading key audit matter paragraph. Sir, but what exactly is a key audit matter? What exactly is a key audit matter? So you are saying in our audit report, we have to include one paragraph called key audit matter paragraph. But what exactly is the meaning of the key audit matter paragraph? So if you look at the definition, the standard has defined key audit matters in such a manner that key audit matters are those matters that in the auditor's professional judgment were of most significance in the audit of the current period financial statements. So while you are doing audit of the current period financial statements, from the current period financial statements, you have to select a few matters which in your professional judgment you feel it as most significant. from the audit of current period financial statements. You have to identify those matters which you feel it as most significant using what? Using your professional judgment. Once again, here there is no hard and fast rule. It is completely depending on the professional judgment of the auditor. So as an auditor, you use your professional judgment, and from the current year's audit, you select a few matters which you feel it as most significant and explain about that matters in the key audit matter paragraph. And one more instruction the standard has given, you have to select those matters, you have to select the key audit matters from those matters which are communicated with those charged with governance. So there are various matters which we will generally communicate with those charged with governance. From those matters, you have to select a key audit matter. Or if I put the same thing in other way around, if you want to communicate something as a key audit matter, first you have to go and communicate that information with those charged with governance. Okay, so we understood what is the meaning of the key audit matter. Now you will get a doubt, sir, what is the purpose of having this key audit matter? What is the purpose of having key audit matter? See, today our audit reports have become very much similar. We have brought a lot of uniformity because of the standards on audit, because of the SS700, because of SS700 series. Audit reports are uniform today. You pick up any two audit reports, they all will look similar. If both auditors are giving a same opinion, everything will look same except the name of the company, name of the auditor, date. Apart from this formalities, audit reports are exactly going to look similar. And people in the industry have started complaining that these audit reports are not giving us any value addition. We are not deriving any value addition by reading this auditor's report. So that's why I felt that in order to increase or enhance the communicative value of the auditor's report, to increase the communicative value of the auditor's report, the standard SA700 told that you provide greater transparency about the audit, how you have performed. So you identify significant areas and how you have dealt with that significant areas, you explain about it by providing greater transparency, and it will overall increase the communicative value. It will overall enhance the communicative value of the auditor's report. So the main purpose of communicating key audit matters is to enhance the communicative value of auditor's report by providing greater transparency. And this is very important here. Communicating key audit matters is not a substitute for three things. The purpose of communicating key audit matter is not a substitute for three things. Very, very important from the examination perspective. Number one, communicating key audit matters is not a substitute for disclosure, which is required in the financial statements. It is not a substitute for giving a modified opinion. It is also not a substitute for material uncertainty relating to going concern paragraph as per SA 570. Communicating key audit matter is not a substitute for three things. Very important. It is not a substitute for disclosure required in the financial statements as per applicable financial reporting framework. Sir, what do you mean by that? Say, for example, I am conducting audit of the client X Limited. The client X Limited, as per the requirements of their applicable financial reporting framework, they are required to give some disclosure in the notes to accounts. They forgot to do it. They did not explain that notes to accounts in the financial statements. Now they came to the auditor and they asked that, sir, we are supposed to give a disclosure in the financial statements as per applicable financial reporting framework, but we forgot to do it. Anyhow, you are including a key audit matter paragraph in your auditor's report. No, in that paragraph, you explain this disclosure. Do you think key audit matter is a substitute for that? Is the key audit matter introduced to include the disclosures which the management has forgot? No. That is what the meaning of the first point. Key audit matter paragraph is not a substitute for those disclosures required in the financial statements which are required to be done by the management. Similarly, key audit matter is not a substitute for modified opinion. Say, for example, I am an auditor. I am conducting audit. While conducting the audit, I found a material misstatement. If I found a material misstatement, what should be my course of action? I should have given a modified opinion. Can I say, instead of giving modified opinion, I will explain that in the key audit matter paragraph? Do you think it is acceptable? 100% not. So key audit matter is not a substitute for modified opinion. Key audit matter is also not a substitute for material uncertainty related to going concern paragraph. There is some information which is required to be included in the material uncertainty relating to going concern paragraph, which we will see it under SA 570, and the information which is supposed to go to material uncertainty paragraph, that should go to material uncertainty paragraph only, that should not come under key audit matter paragraph. So key audit matter is not a substitute for these three things. Along with that, they also say one more point. Key audit matter is not a separate opinion on any of the paragraphs. So in the key audit matter, whatever matters have been explained, auditor is not giving any separate opinion on any of the matters. Just what simply auditor is doing is, what is a significant matter? what is the matter which is significant. So what is the key audit matter that he will explain. Then why you have selected that as a key audit matter, because of what reasons you have selected this as most significant, that reasons he will explain. Along with that, he will also explain how he has tackled, how auditor has responded, what actions you have taken. That's all. So what is the key audit matter, why he has selected it as a key audit matter, how you have dealt with that. That's it. Only these three things he will explain. He will not give any separate opinion on any of the key audit matter. Next, applicability. Sir, is auditor required to communicate key audit matters in all the entities for the time being now? No. For the time being now, no. Audit is not currently. Key audit matters is not applicable for all the companies. Currently, key audit matters are required to be included only while conducting audit of general purpose financial statements, that too of listed entities. So if you are conducting audit of general purpose financial statements, that too of a listed entity, then only you are required to include the key audit matter. Or sometimes your client might not be a listed entity, but it might be required by law or regulation. If there is any requirement from law or regulation, then also we will include the key audit matter. In rest of all the cases, it is up to the auditor's choice. The auditor will use his professional judgment and decide whether communicating key audit matters in one specific case is required. So the auditors may also decide to communicate key audit matters for other entities. That is completely his choice. But in two cases, it's mandatory. When it is mandatory, if you are conducting audit of general purpose financial statements of a listed entity. Number two, if there is any requirement from any law or regulation. In rest of all the cases, that is up to the auditor's choice. And also how you have to present the key audit matter. So you have to present the key audit matter. You have to use a separate heading, key audit matter. So let me show it here. Let me show the key audit matters here. Yeah. So if you see here, if you want to include the key audit matter, first you have to give a separate side heading, key audit matter. Now in that heading, if you want to explain more than one key audit matter, for each key audit matter, separate subheadings you have to give. So one main heading, key audit matter. And in that, if you have multiple matters to communicate, for each of the key audit matter, you need to have a separate subheading. Like as you could see here, this is one key audit matter. This is the second key audit matter for which a separate heading has been given. There is one more key audit matter for which a separate subheading has been given. So like that, subheading has to be given. In addition to that, before communicating the key audit matter, you need to give some introductory information, some introductory language you have to give. This is the introductory language they are talking to. The same language, even you will be able to find it here also. So this introductory language you have to use. This is also important. Why? Because these days, once again, drafting questions are coming. So before you explain key audit matter, this is the introductory language which you have to use. What is that? Key audit matters are those matters that in the auditor's professional judgment were of most significance while conducting audit of the financial statements. And these matters were addressed in the context of audit of financial statements as a whole and in forming auditor's opinion thereon, and auditor does not provide a separate opinion. As it is this information, as it is this paragraph, you have to include it. Okay, sir, sometimes what will happen is I am conducting the audit, but I don't find anything significant from my current period audits. I have conducted audit of the financial statements of the year 24-25. The standard says from the current year audit, I have to identify those matters which I feel it as most significant. Sir, but I am such an auditor, I have did the audit, but I am unable to find anything as most significant. Can I report last year matters as a key audit matter? The answer is no. You can't explain the last year matters. Sir, but I don't have any key audit matters in the current year. Then what I should do? Here the standards is very interesting thing. If it is a listed company or where it is mandatory to disclose key audit matter, in those cases, what they should do is you have to include in your audit report key audit matter paragraph, and there you have to say that there are no key audit matters. There you have to say what? In that you have to mention there are no key audit matters. Very interesting thing they try to say here. So if you don't have any key audit matter, still you have to include the paragraph key audit matter. In that you have to say that there are no key audit matters. So this is how the format is going to be. This is how the presentation is going to be. So this is how you have to state, except for the matter explained in basis for opinion paragraph or material uncertainty relating to going concern, we have determined that there are no key audit matters. This fact you have to mention. Next, sir, how to determine key audit matter? This I have already told you. Whether a matter is a key audit matter or not, that is something which is completely auditor's professional judgment. Whether a matter is a significant matter or not, that is something which is completely auditor's professional judgment. But however, the standard has given some guidance in which kind of areas you can start looking for key audit matters. That guidance they have given. So in which areas I can start looking for key audit matters? If you see here, you can start looking for key audit matters from those areas where there is a high risk of material misstatement. If the risk of, you can start looking for key audit matters in those areas where there is a high risk, or you can start looking for those key audit matters in those areas where there are significant management judgments. There are certain areas where management has made a lot of judgments. In those areas, you can start looking for key audit matters like provisions or going concern or a provision for bad and doubtful debts. In those areas, you can start looking for key audit matters, or the effect on the audit of significant events or transactions. Like if any significant event or transaction has taken place in the current year, like any acquisition has taken place, any merger has taken place, from those areas also you can determine the key audit matters. So these are the three areas from which you can start looking for key audit matters, where there is a high risk of material misstatement, where there is a significant judgment involved, or where there are significant events or transactions. Then coming to the last part of the standard, when it is prohibited for you to communicate the key audit matters. So SA 701 has also listed some circumstances where the auditor is prohibited from communicating key audit matters. So what are the cases where auditor is prohibited from communicating key audit matters? Number one, if you are giving a disclaimer of opinion. If you are giving a disclaimer of opinion, then your audit report should not contain a paragraph key audit matter. When you are giving a disclaimer of opinion, your audit report should not contain any reference to, your audit report should not have anything called key audit matter paragraph. And not just that, even though you are not giving disclaimer of opinion, in other cases there are some matters which should not be explained as a key audit matter. That means you are not giving disclaimer, you are giving a normal opinion only, but some cases, some matters should not be communicated as key audit matter. So which matters should not be communicated as key audit matter? Number one, if there is a prohibition from law or regulation. If law or regulation prohibits you to disclose such matter, don't disclose that as a key audit matter. Or if the auditor determines that because of the communication there will be more adverse consequences. You feel that if I explain certain matter as a key audit matter, it will have more negative consequences, then also don't explain that as a key audit matter. Similarly, if the auditor concludes that matter is highly confidential or sensitive, such matters also you should not disclose in the key audit matter paragraph. So summary here is, if you are giving disclaimer, your audit report will not contain a key audit matters only. In other cases, some matters should not be contained in the key audit matter paragraph. Which matters should not be there in the key audit matter? If there is any prohibition from law or regulation, or if the auditor feels that communication will result in possible adverse consequences, or if the auditor concludes that the matter is highly confidential or sensitive for the interest of the company. Understood? So this is what regarding SA 701. Now we have SA 706, emphasis of matter paragraph and other matter paragraph in the auditor's report. SA 706, which is talking about two contents. This we will try to cover it. So if we complete SA 706, all the 700 series of standards will be over. Then we will proceed ahead and try to understand the reporting requirements under the Companies Act. Yeah, I think the stream and all is going good. So we have successfully done 2 hours 45 minutes of the live stream. Yes, it's a very good thing actually. So thank you so much guys. You're all being live. So still I'm able to see the views here. Yes, it shows that you're all serious about your preparation and all. Thanks a lot. So all these efforts have been just for the sake of your understanding, to help you out in the examinations. So thanks for your active participation once again. Anyhow, let me proceed further. Right. So SA 706 we will try to discuss now, which is talking about two contents. One is emphasis of matter paragraph and the other one is other matter paragraph in the auditor's report. So let us try to understand what is this emphasis of matter paragraph and what is this other matter paragraph. First of all, I will talk about emphasis of matter paragraph. So what is the meaning of the term emphasis? Emphasis means to highlight. What is the meaning of the term emphasis? Emphasis means to highlight. So emphasis of matter paragraph. So what exactly is this emphasis of matter paragraph? So standard says that emphasis of matter paragraph is used to refer to such matter which is already presented or disclosed in the financial statements. The management in the financial statements, they have already presented and disclosed certain information in the financial statements. But as an auditor, you feel that it is fundamental to the user's understanding of the financial statements. The management in the financial statements which they have prepared, they have included, they have already presented or disclosed certain information without their mistake. The management, without their mistake, they have already disclosed or presented certain information in the financial statements. But as an auditor, you feel that even though the management has presented or disclosed that information in the financial statements, but still the user might not read it, because we can't expect each and every user to go from the first page to the last page of the financial statements. So I do feel that even though the management has included that information in the financial statements, but still user might not go through it. But that information is very fundamental to users understanding. I want to highlight it somewhere in my auditor's report. You tell me, can I highlight it by giving a modified opinion? No, management will give me a tight slap. Why? Because management, without their fault, they have explained. I can't highlight it by giving a modified opinion. How can I give modified? I give modified only when the financial statements are misleading. But in the given case, financial statements are not misleading. Management has clearly presented. Then I can't modify it. Then how can I highlight, sir? What the standard has told is, you do one thing. If you feel that important, if you feel that matter is very fundamental to users understanding, in your audit report, use a paragraph with the heading emphasis of matter paragraph, and in that paragraph, you highlight that information, whatever you want to bring it to the shareholders' attention. Sir, now you will get it out. Sir, what are the examples, sir? Can you give me a few examples where I might feel that even though the management has disclosed that information in the financial statements, but still it is fundamental to users understanding? The examples of matters are something like this. Like, for example, if you see here, if there is any uncertainty relating to future outcome, like the company is going through one litigation, one case is going on, the management, without their mistake, they have clearly explained that as a contingent liability in the notes to accounts. But I felt that the user might not read it. I want to highlight it. I can highlight it in the emphasis of matter paragraph. Or subsequent event, management has adjusted one subsequent event. They did not hide anything. That information they have clearly explained in notes to accounts. So and so subsequent event has taken place. This is adjusting, these adjustments we have done. But I felt that the user might not read it. I want to highlight it somewhere in my auditor's report. Use an emphasis of matter. Or early application of a new accounting standard. Your client has made an early application of a new accounting standard. They have explained it in the notes to accounts, but you want to bring it to the user's attention because it is very much fundamental to his understanding. Highlighted in the emphasis of matter. Or even a major catastrophe or calamity also, you can highlight it in the emphasis of matter. So if you see here, usage, when you can include emphasis of matter paragraph, the auditor shall include emphasis of matter paragraph only when he is not required to modify opinion in respect of such matter. So say, for example, there is one item of the financial statements. In the financial statements, there is one item which is modified, which is materially misstated. Sorry. There is one item in the financial statements which is materially misstated. You tell me, if such item contains a material misstatement, instead of giving modified opinion, can I just highlight it in the emphasis of matter paragraph? Absolutely not. Why? Because if any item is materially misstated, the correct option is not just highlighting, the correct option is giving a modified opinion. So you can include only such items in the emphasis of matter paragraph which are not required, because of which you are not required to give a modified. That means if an item is materially misstated, you can't highlight that information in the emphasis. The correct action is you have to give a modified opinion. And the matter has not been determined to be a key audit matter, which means if a matter is already determined to be a key audit matter, that will go to key audit matter paragraph, that should not come in the emphasis of matter paragraph. So you can highlight such matter in the emphasis of matter paragraph if because of it you are not required to modify the opinion, and if that has not been determined as a key audit matter. Why? Because if it has already been determined as a key audit matter, that will be explained in the key audit matter, that will not come under emphasis once again. Sir, okay, I have determined some matter which is very much fundamental to users understanding. How I have to present it, sir? So how you have to present it is, if you include the paragraph within a separate section of the auditor's report. So you have to include in your audit report a separate heading, emphasis of matter paragraph, like that one heading you have to use it. Let me see whether it is there here. Right. So I think it's not there in the auditor's report. So whatever it is, but anyhow, I will give you, yeah, here it is. So I see here. So you have to include a separate heading, emphasis of matter paragraph. Then what else? Include in the paragraph a clear reference to the matter being emphasized and to where relevant disclosures that fully describe the matter can be found. So in that emphasis of matter paragraph, you have to explain that reference. You have to give reference. As I have told, in the emphasis of matter paragraph, only that information which is already presented will be highlighted now. So you have to give a reference in that emphasis of matter paragraph where the user can go and find that detailed information. Like as you could see here, if you look at this starting phrase, we draw your attention to note number 32A. The auditor has given reference to the place in the financial statements where the user can go and read it in a detailed manner. So that reference must be there. And few more things here. You should mention that auditor's opinion is not modified. Even you have to add a line that we are not modifying our opinion. We are just highlighting this information. to you. So like this is how you are supposed to present. And here also they say the same three things. Whatever three matters for which key audit matter is not a substitute, even emphasis of matter paragraph is also not a substitute for the same three things. What are the three things which it is not a substitute for? It is not a substitute for disclosure in the financial statements. It is not a substitute for giving a modified opinion. It is also not a substitute for material uncertainty related to going concern paragraph as per SA 570. Same, whatever we have discussed in the key audit matter as it is. This is not substitute. Even emphasis of matter paragraph is also not a substitute for that. Understood? So this is what regarding emphasis of matter. Now let us come to the next part, which is other matter paragraph. Sir, what is other matter paragraph? I told that emphasis of matter paragraph is used to highlight that information which is already present or disclosed in the financial statements. They say that other matter paragraph, in the other matter paragraph, we highlight that information which is not presented or disclosed in the financial statements. In the other matter paragraph, we highlight such information which is not presented or disclosed. Which means simply, if I have to put it in very simple sense, in the other matter paragraph, we talk about our responsibilities. Any additional responsibility we have taken, any reduction in our responsibilities. Like for example, there is a joint auditor along with me. I want to explain it. And the principal auditor, there is a branch auditor separately who has conducted the audit of the branch. This you want to explain here. Explain it in the other matter paragraph. You have conducted audit of only current year. Last year you are not the person who did the audit. You want to explain that. Explain it in the other matter paragraph. So mainly we use other matter paragraph for responsibility related matters. So that's what they say here. It is a paragraph which is included in the auditor's report that refer to a matter other than those presented or disclosed in the financial statements. Why? Because if a matter is already presented or disclosed in the financial statements, that we will do it in the emphasis. If something is not presented or disclosed in the financial statements, for that we use other matter paragraph. And mainly we use it, it is relevant to users' understanding of audit, auditor's responsibilities or auditor's report. As I've told, mainly we bring the matters relating to auditor's responsibilities. And here also, when you can use other matter paragraph, number one, it should not have been prohibited by law or regulation. Number two, if it has not been determined as a key audit matter. The same thing, whatever they have told for emphasis, the same thing they are saying it here also. And if you want to include the other matter paragraph, like the way we have done it for emphasis of matter paragraph, even the other matter paragraph also, you have to do it under a separate heading. You have to add a separate heading, other matter paragraph. In that you have to highlight the information. Next. And if you want to highlight, if you want to include emphasis of matter paragraph or other matter paragraph in the auditor's report, first you have to communicate with those charged with governance that you are going to use emphasis of matter paragraph or other matter paragraph, and even wording of that paragraph also you have to explain it. Okay, clear and comfortable everybody? So with this we have completed the 4 standards. 4700 series of the standards we have completed. Now the next thing which we have to address is responsibilities, auditors responsibilities under companies sector. We have various reporting requirements under 143 subsection 1, 3, 11, 12, all that we have. So that reporting requirements we have to cover it now. So now since we have successfully completed the reporting requirements as per the standards on audit, now we have few reporting requirements under few sections of the Companies Act. So we have reporting requirements under 143 subsection 1, we have reporting requirements under 143 subsection 3, we have reporting requirements under 143 subsection 11, and we have reporting requirements under 143 subsection 12. Out of all that, the reporting requirements under 143 subsection 11, which we also give it a name called CARO 2020. So the reporting requirements under 143 subsection 12, subsection 11, CARO 2020 is very important. Without a question from the CARO, there will not be a question paper. Compulsory question will be there from CARO 2020. So apart from that, we have reporting requirements from 143 subsection 1, subsection 3, subsection 12. Let us try to quickly cover it. Not that important from the examination perspective. Just a few points here and there will be there. We'll try to quickly cover them. So first one, reporting requirements under 143 subsection 1. There are 6 matters which the auditor is required to inquire. Sometimes even they might ask a question. What are the matters which auditor is required to inquire? Also they can say. So matters to inquire or matters to be reported under 143 subsection 1, 6 matters we have. Quickly we will try to do it, guys. Not that important from the examination perspective. Quickly we will try to wind it up. Number one, first one, whether loans and advances made by the company. You have to check whatever loans and advances which are given by the company to the others. If they are on the basis of security, I need to check whether they are properly secured or not. And also I need to observe the terms and conditions on which that loans are given. Are they prejudicial? Are they harmful to the interest of the company or its members? This is the first point. So I need to verify loans and advances made by the company. If they are on the basis of security, properly secured. The terms and conditions on which they are made, are they prejudicial? Are they harmful to the interest of the company? Second point, I need to check the transactions which are represented merely by book entries, whether there are any transactions represented merely by book entries. If yes, are they prejudicial? Are they harmful to the interest of the company? Third one, I need to check whether the company is having assets in the form of shares, debentures and other securities, and have they sold any of their shares, debentures and other securities for a price less than the purchase price. Basically, I need to check whether my client is holding any financial assets, whether my client is holding any financial instruments, and whether they have sold any of that financial instruments at a loss less than purchase price. However, this point is not required to be reported if I am conducting audit of such a client which is an investment company or banking company. So this point is not required to be reported in the audit of an investment company or a banking company. Fourth point, whether personal expenses have been charged to revenue account, whether the client is showing any personal expenses to revenue account. That means personal expenses shown as business expenses, report on it. Sorry, there is fifth point. Fourth point is whether loans and advances have been shown as deposits. The client has given loans and advances, but instead of showing it as loans and advances, are they showing it as deposits? Then last point, whether it was stated in the books of accounts that the company has allotted shares for cash. If anywhere it was stated in the books of accounts that the company has allocated the shares for cash. If yes, whether cash has actually been received. If cash is not received, whether the position stated in the financial statements is correct, regular and not misleading. That's all. These are the 6 points which are required to be reported under 143 subsection 1, and you are required to report these points only when you have a negative remark. Only when you have a negative remark you are required to report it. If you have a positive comment, you are not required to report any of the matters. Then there are certain matters which are required to be reported under 143 subsection 3. Here there are plenty of matters are there, but out of all that, the matters under clause J, 143 subsection 3 clause J, these matters are important. They have a chance of asking the question in the examination. But anyhow, all other classes also quickly we will go through. So what are the matters which are required to be reported under 143 subsection 3? Clause A says that whether you have sought and obtained all the information and explanation necessary. Did you get all the information and explanation necessary for the purpose of your audit? And if you have not received any information, what is that effect of such information which you have not received? Number 2, whether in your opinion proper books of accounts as required by the law have been kept, and have you received proper returns from the branches or not? Number 3, in case if you are a principal auditor, you are not the branch auditor, branch office accounts are audited by separate branch auditor. Did that branch auditor send his report to you? Have you considered that report? How you have dealt with that report while giving the opinion on the entire company? So receipt of the branch audit report. Fourth one, whether the company's balance sheet and P&L are matching with the books of accounts and returns. Nothing but financial statements should be matching with the books of accounts. Then whether in his opinion the financial statements comply with accounting standards. Then clause F, do you have any observations? Do you have any comments on the financial transactions or matters which have an adverse effect on the functioning of the company? So do you find any transaction? Do you have any observation where the company has done some financial transaction which is having an adverse effect, which is having a bad effect on the functioning of the company? Then you have to comment whether any of the director is disqualified under 164 subsection 2. And as we all know, a director will become disqualified under 164 subsection 2 where the company has not filed annual return or financial statements for 3 consecutive years. If the company did not file the annual return or financial statements, all the directors will be disqualified for a duration of 5 years. I need to check whether any director of my company has been disqualified under 164 subsection 2. Next one, any qualification, reservation or adverse remark relating to maintenance of accounts and other matters. Did you have any qualification? Did you have any reservation? Do you have any adverse remark relating to maintenance of books of accounts? Do you have any negative remark regarding books of accounts? Comment on it. Then clause I, important. You need to comment whether your client is having adequate internal financial controls and also whether those internal controls are operating effectively or not. So very, very important. 143 subsection 3 clause I, shortcut to remember, 143 subsection 3 clause I stands for internal financial controls. So I need to comment whether my client is having proper internal financial controls and not just that, whether they are operating effectively or not. But however, some companies are exempted from the requirements of internal financial controls. Which companies are exempted from internal financial controls? So it may be noted that reporting requirements on adequacy of internal financial controls will not be applicable. For whom? To a private company, which is either a one-person company or a small company, and also which has a turnover of less than 50 crores as per the latest audited financial statements, and aggregate borrowings from banks or financial institutions or any body corporate at any point of time during financial year less than 25 crores. So these are private companies. It should be either one-person company or small company, or it should fulfill any two conditions, not any two, both conditions. Number one, turnover should be less than 50 crores and its borrowings from banks and financial institutions or any body corporate at any point of time should be less than 25 crores. If these conditions are satisfied by a private company, then they are not required to implement internal financial controls. If the client is exempted from internal financial controls, you will also say you are also not required to report under 143 subsection 3 clause I. So till here, okay. Now comes the important part. There are various matters which are required to be reported under 143 subsection 3 clause J. There are additional matters which are required to be reported. What are they? Number one. So 6 matters we have here. Listen carefully. Number one, you need to comment whether the company has disclosed the impact of pending litigations. If the company is going through any pending litigation, whether company has disclosed impact of all that pending litigations in the financial statements or not, that I need to give a comment. So they are not asking auditor to disclose the impact of pending litigations. They are asking auditor to check whether the company has given the impact of, whether company has disclosed in their financial statements the impact of pending litigations. Number two, I need to check whether company has made a provision for material foreseeable losses, if any, on long-term contracts, including derivative contracts. So if the client has entered into any long-term contract and they know that on this long-term contract they are going to make a loss, they should create a provision, including on derivative contracts. So I need to check whether my client has made a provision for material foreseeable losses on the long-term contracts, including derivative contracts. Then third one, I need to check whether my client is required to transfer any funds to Investor Education and Protection Fund. If yes, have they made any delay in transferring the amounts which are required to be transferred to the IEPF? Next, fourth point, I will have a detailed discussion. Important. So fifth and sixth will try to understand. Fifth one, whether the dividend declared by the company is in compliance with section 123 of the Companies Act. Whether your client company has declared dividend. If yes, they can't declare the dividend, they can't declare so much amount of dividend in whatever manner they want. So whatever dividend they are declaring, that must be in compliance with section 123 of the Companies Act. I need to check the compliance. Similarly, I need to check that whether the client is maintaining such an accounting software which is having a feature of recording audit trail facility. So I need to check my client is using such an accounting software which is having a facility of recording audit trail, and also I need to check that audit trail has been operated throughout the year for all the transactions, and that audit trail feature has not been tampered. That information of the audit trail should not have been tampered with, and it should be preserved by the company as per statutory requirements. So 3 things I need to check. First of all, whether my client is using such an accounting software which is having audit trail. Number 2, that audit trail should not be tampered with. The audit trail should be operated throughout the year, and that audit trail should be preserved. Clear? Next, now comes the fourth point. Here there are some important details which I will try to explain. So in the fourth point, they say 3 sub-points. First sub-point, they say that you need to ask the management a written confirmation. You need to ask the management of your client in a written confirmation that they did not indulge in certain transactions without disclosing it in the notes to accounts. Under the fourth point, the first sub-points, I will try to explain it. Later on, you can read it. In that first sub-point says, the auditor should obtain written confirmation from the management that they did not indulge in certain transactions without disclosing it in the notes to accounts. So what transaction they should not have indulged in? Say for example, your client company is there. Okay. So your client company has given some loan, advance, or they have made investment in another entity, which we call them as intermediary. Your client has given some loan, advance, or investment to an intermediary with an understanding between your client company and the intermediate company. There is an understanding. That understanding could be in written format, or that understanding could be otherwise also. So what is that understanding is, this intermediary should go and give the amount of loan, or they go and give an advance, or either they give a security or guarantee on behalf of some ultimate beneficiary. They have to go and give some loan, advance, or security on behalf of ultimate beneficiary. This is a transaction without disclosing in the notes to accounts. Company should not have done it. ask the management to give a written confirmation that they did not do this kind of transaction. Which kind of transaction? My client company is giving some loan or advance or making an investment in some intermediary with an understanding that this intermediary should go and give the amount as loan, advance, or act as guarantor on behalf of ultimate beneficiary. This transaction the company should not have done it without disclosing in the notes to accounts. Ask the management to give a written confirmation. See, if you understand the substance here, what is happening is client company wants to do some favor to ultimate beneficiary. Either they are prohibited from doing it, or if they do it, they become answerable. So to avoid it, what they are doing, they are creating an intermediary. Should they do it or should they not do it? They should not do it. So that only we are asking the management to give a confirmation that they did not do this kind of transaction. Okay, next, second point. In the second point, in the fourth sub point 2, they say one more thing here. You need to obtain written representation. You need to obtain written confirmation from the management of the company that they did not involve in certain transactions without disclosing it in the notes to accounts. Which kind of transactions? Like say for example, there is a client company. Your client company is there. Your client company has received some funds either in the form of loan, advance, or investment from some another entity, which we call them as funding party. So your client company has received, so client company, we are talking from the perspective of client company. So your client company has received some loan, advance, or investments from a funding party with an understanding. Now funding party and my client company both are having an understanding. So what is that understanding? That my client company, whatever loan, advance, or investment they have received, they have to go and give that amount as loan or advance, or either provide security on behalf of ultimate beneficiary. Should my client, see here in the previous case, my client created an intermediary to do a favor to ultimate beneficiary. But in the second case, my client itself is acting as a intermediary. So you tell me, funding party wants to do some favor to ultimate beneficiary, but to avoid that, they are using my client company as a vehicle, as an intermediary. Should my client company do such kind of transactions? No, they should not do that kind of transactions. Ask the management that they have not done this transaction. Ask them to give a written confirmation. Okay. So two written confirmations you have to get. You should ask the client company to give a written confirmation that they did not create an intermediary to do a favor to ultimate beneficiary. They should also ask the management to give a written confirmation that my client company did not act as intermediary for facilitating a fraudulent transaction. So ask the management to give this two written confirmation. And the third sub point says that if you ask the management will give written confirmation. They will say that yes sir, we did not do any of these transactions. But will you blindly believe it? No, we should not blindly believe it. We should perform some procedures as we feel suitable and check whatever confirmation management has given under the previous two cases. Are they correct or are they misleading? Able to understand everyone? So two written confirmations we will obtain. And in the third point, they say management will give written confirmation. No one will voluntarily come and say they have done the mistakes, but don't blindly believe it. Perform some appropriate procedures and find out whether those written confirmations which you got from the management, are they appropriate or are they wrong statements? Clear? So these are the few reporting requirements under 143 subsection 3 clause J, having a high chance of getting tested in the examination. Then we have reporting requirements under 143 subsection 12. We'll cover 143 subsection 12. Then we will try to understand 143 subsection 11. Sir, what are reporting requirements under 143 subsection 12? Reporting requirements under 143 subsection 12, that we also call it as fraud reporting. That we also call it as what? Fraud reporting. So as an auditor, as a part of your responsibility of conducting audit of a company, if you have reason to believe that a fraud has taken place, then you have some reporting requirements to fulfill. And in order to fulfill that reporting requirements, we divide the frauds into two categories. The fraud in which the amount involved is 1 crore or more, the fraud in which the amount involved is less than a crore. If the amount involved in the fraud is 1 crore or more, you are required to report that matter to the central government. If the amount involved in the fraud is less than 1 crore, no central government reporting. You are not required to report to the central government. So let us try to understand what is the manner of reporting if the amount involved is 1 crore or more, and what will be the manner of reporting if the amount involved is less than a crore. So if the amount involved is 1 crore or more, then you are required to report to the central government, and the manner of reporting is, first, within 2 days, you are required to report the matter to the audit committee. If audit committee is there, to the audit committee you report. If there is no audit committee, then only to the board of directors. So here most of the students often come under a misconception. They have a notion that auditor will have an option to either report the matter to audit committee or board of directors. No. If audit committee is there, report to the audit committee only. If audit committee is not there, then report to the board of directors. So whatever it is, auditor first communicate the matter within 2 days to the audit committee or board of directors if there is no audit committee, and give them 45 days of time. And give them 45 days of time to seek their reply or observations. If reply is received, within 45 days, then you need to report the matter to the central government within 15 days of reply. Within 15 days of reply, the auditor is required to report the matter to the central government. And what and all you have to communicate? You have to communicate the report which you have sent to board of directors or audit committee. On that, what replies you have received. On that reply, what are your comments or observations. So everything you have to communicate. And all this reporting should happen in form number ADT 4. In form number ADT 4, you have to communicate. And this reporting should take place on letterhead of the auditor. And that letterhead should contain all the details of the auditor, like the name of his firm, his address, his mobile number, his email address. It should contain the seal of the auditor. It should contain the signature of the auditor. And when I say you have to report the matter to the central government, the information, this ADT 4 will be reported to Secretary, Ministry of Corporate Affairs. Clear? So within 45 days, if you receive reply, within 15 days of receiving the reply, you have to report the matter to central government. And what and all you are required to report? A report which I have originally sent to board of directors or audit committee. On that, what reply you have received? On that reply, what are your comments? And all this reporting requirement should take place in form number ADT 4 on the letterhead of the auditor, containing all the details of the auditor. Then, sir, what if the reply is not received? If I did not receive reply, then what will happen? Even if the reply is not received, then also you are required to report to the central government. And what and all you will report here? You will report the matter which has been sent to audit committee or board of directors, along with the fact that reply has not been received. Here also reporting requirements will happen in form number ADT 4. Here also the reporting requirement will take place on the letterhead of the auditor, and it should also contain seal and all. Everything will be there. Understood? So these are the reporting requirements under, in case if the amount involved in the fraud is 1 crore or more. So if you see here, if the reply is not received, they did not mention the time limit. Here they told within 15 days of receiving the reply, you have to communicate. In case if the reply is not received, they did not mention the time limit here specifically, but there is an implied time limit here. You can derive the time limit from the other case. So what you will generally do is, you will give the management 45 days of time to reply. If you did not get that reply within 45 days, within 15 days from the expiry of the 45 days, you are required to communicate the matter to the central government. So there is no express time limit, but this time limit is implied from the other case. Next, sir, what if the amount involved in the fraud is less than 1 crore? Here also they say you are required to report the matter to audit committee or board of directors. How many days, sir? Within 2 days of the knowledge of the fraud, you are required to report it. And within 2 days of the knowledge, you have to communicate. And what and all you are required to communicate? Nature of the fraud along with a description. What is the approximate amount involved, and who are the parties involved? Who are the parties involved? These are 3 things you have to communicate to audit committee if it is there. If audit committee is not there, to the board of directors. That's all. Your responsibility will come to an end. There is no requirement to report this matter to the central government. But however, after you have fulfilled your reporting requirements, now the board of directors, they will give something called a board's report. In the board's report, they have to disclose some information like what is the nature of the fraud along with the description, what is the approximate amount involved, who are the parties involved, along with what remedial actions are taken. These 4 points are required to be highlighted in the board's report, not in the any other report. The auditor's responsibility will come to an end once you communicate nature of the fraud, approximate amount involved, parties involved. But finally, when the board will give board's report, in that board's report, they will explain these 3 things along with the remedial actions taken. And whatever reporting requirements we have seen here, all that reporting requirements will be applicable for company secretary, even cost auditor doing the cost audit. In case if you fail to comply with that reporting requirements, you have to face the penalties. Clear? So this is what reporting requirement under 143 subsection 12. Now we come to the most important part, reporting requirements under 143 subsection 11, CARO. 143 subsection 11, CARO reporting requirements. We will try to see it now. Okay, right. So let us try to have a look at it. CARO reporting requirements. We have a total of 20 matters which are required to be reported. 21 actually. The 21st point will come in the audit of consolidated financial statements. So, but first let us look at the matters which are required to be reported. See, before we can talk about what are that 20 or 21 matters which are required to be reported, first let us try to understand applicability. So first we have to understand applicability. Sir, does auditor of each and every company is required to report on CARO? First, initially they have told yes, auditors of every company is required to report on CARO, but later they have given relaxation to few companies. So first let us concentrate on the applicability. Not that important from the CA final perspective. At the CA inter level, they ask so many questions from applicability. At the CA final, they ask questions less on applicability, more on the reporting requirements, but we don't know what will be the mindset of the ICA at any point of time. At the CA final level also, they might think of asking the applicability. So just on a precautionary measure, we will try to understand. Sir, they told that this CARO reporting requirements will apply to every company, including a foreign company. However, it shall not apply for certain companies. So to whom it shall not apply? For a banking company, CARO is not applicable. For an insurance company, CARO is not applicable. For a Section 8 company, CARO is not applicable. For a one-person company, CARO is not applicable. For a small company, CARO is not applicable. And a private limited company, if it satisfies all four conditions. Not anyone. If a private limited, it should not be a private unlimited company, it should be a private limited company, and it must fulfill four conditions for CARO to be not applicable. That means if a private limited company has violated even one of the below mentioned conditions also, then CARO will become applicable. So for a private limited company, the CARO to be not applicable, we need to, that private limited company should fulfill four conditions. All four conditions they have to comply. Sir, what are that four conditions they have to comply? Number one, it should not be a subsidiary or holding of a public company. That means if your client is a private limited company, its holding company should not be a public company, its a subsidiary company should not be a public company. So neither the holding company nor the subsidiary company should be a public company. Condition number one. Number two, the total paid up capital and reserves and surpluses should be less than or equal to 1 crore as on the balance sheet date. So as on 31st of March, as on the balance sheet date, the total of paid up capital along with the reserves and surpluses shall be less than or equal to 1 crore. It should not exceed 1 crore. When we have to check this condition, we have to check this condition only as on the balance sheet date. And the total borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. Third condition, borrowings, not all borrowings, you have to consider only borrowings from banks and financial institutions, and they should not exceed 1 crore, not just on the balance sheet date, at any point of time during the financial year. So at any point of time during the financial year, if the borrowing has exceeded 1 crore, CARO will become applicable, not just on the balance sheet date. So here you have to be very careful. For paid up capital and reserves and surpluses, they are asking us to check the condition of not exceeding 1 crore only as on the balance sheet date. But when it comes to borrowings from banks and financial institutions, they are asking us to check whether it has not exceeded 1 crore at any point of time during the financial year. Like say for example, financial year 24-25, as on 1st of April, the opening balance of the borrowings from banks and financial institutions is 70. During the year, they have obtained additional borrowings as on 30th of June, they have obtained additional borrowings of 40 lakh rupees. But during the year, 30th of September, they repaid some 20 lakhs worth of borrowings. So as on the balance sheet date, as on 31st of March, the closing balance is 90 lakh rupees. Will CARO become applicable? Yes. Sir, closing balance is less than 1 crore? No, doesn't matter. Why? Because for some point of time, the borrowing has exceeded 1 crore rupees, CARO will become applicable. And the last condition, the total turnover calculated as per Schedule 3, including revenue from discontinuing operations, shall not exceed 10 crores during the financial year. So when a private limited company has satisfied all these four conditions, then CARO will not become applicable to it. So what are the four conditions? Number one, not being a subsidiary or holding of a public company. Number two, the paid up capital and reserves and surpluses shall not exceed 1 crore as on the balance sheet date. The total of borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. The turnover calculated as per Schedule 3, including revenue from discontinuing operations, shall not exceed 10 crores during the financial year. Clear? So this is what regarding applicability. And few more things which you have to keep in mind. So in case if you are calculating the limits, in case if you are checking the applicability, in case of a company which is having branches, company is having head office plus branches, these limits you have to calculate for the company as a whole, not for head office separately and branch separately. The limit has to be calculated for the company as a whole. And once for company as a whole, CARO becomes applicable, all the principal auditor, all the branch auditor, everybody has to report on the CARO. Next, see, if you take holding companies, they will prepare two sets of financial statements, standalone financial statement, consolidated financial statements. For both, audit will happen. There will be an audit report on standalone financial statements. There will be audit report on consolidated financial statements. First, talking about limits calculation. Limits are required to be calculated on the basis of standalone financial statements, not on the basis of consolidated financial statements. And one more thing here, the CARO, the auditors are required to report on CARO only on standalone financial statements. The CARO is generally exempted for audit of consolidated financial statements except one clause. Only one clause they are required to comment in the case of audit of consolidated financial statements, which is clause number 21. So only one clause is required to be reported in the case of audit of consolidated financial statements. All other clauses are exempted. Clear? So these are the few points which you have to keep in mind regarding applicability. Now comes the clauses. Sir, what and all are the different clauses which are required to be reported? What and all are the different matters which are required to be reported? As I have told, total 21 matters are there which are required to be reported. Let us try to address each and every point in a detailed manner. And as I am saying, without a question from CARO, we are not seeing a question paper these days. Very, very important, easy scoring actually. So what are the clauses to be reported? Number one, first clause is regarding property, plant and equipment. So when I say property, plant and equipment, here they are talking about tangible, intangible, everything they are collectively combined it under property, plant and equipment. So let us see what are the matters which are required to be communicated, which are required to be verified by the auditor regarding PPE. Number one, first I need to check whether the client is maintaining proper records. They are not asking auditor to maintain the records. They are only asking the auditor to check whether company is maintaining proper records. And in that records, from that records, you should be able to know quantitative details of the PPE and intangible assets and also their situation. So quantitative details and the location of the PPE, we should know. So whether the company is maintaining such records regarding PPE or not, I have to check. Number two, physical verification. They are not asking auditor to do physical verification. They are just asking auditor to check whether management has physically verified the assets. Physically verified fixed assets at reasonable interval. Sir, what is reasonable interval? Once in every 3 years. Need not be every year. Once in 3 years, they should have done the physical verification. This they have told it as per the guidance note on CARO. So whatever it is, the auditor should verify whether management has done physical verification of fixed assets, that too at reasonable intervals. Okay. Reasonable intervals is once in every 3 years. Next, whether any discrepancies on that verification, whether any discrepancy has been found out. What do you mean by discrepancy? Between the stock, between the assets lying physically and the assets as per books, is there any discrepancy is there? And whether that discrepancy has been properly dealt with in the books of accounts. So that is the second point. You need to check whether management has done the physical verification and at reasonable intervals on that verification, whether any discrepancy has been found out. If yes, whether it has been properly dealt with in the books of accounts. Third point, we need to check the title of the immovable properties. So when I say immovable properties, land and buildings will come here. So I need to check whatever immovable properties are there, which are shown in the balance sheet, whether the title of the immovable properties is in the name of the company. Sir, how will I get to know title is in the name of the company or not? Get that sale deeds and ownership deeds. So you need to check whether in the sale dates the name of the company is there or not. If not, if you find that there are certain immovable properties which are not held in the name of the company, then you need to give some extra details. You need to report some extra details. What details I have to report? Number one, description of the property. What is its gross carrying value? Held in whose name? If it is not in the name of the company, then in whose name it is there? Whether that person in whose name the property is there, is he a promoter, director or employee? For how much duration the company is holding that asset, and the reason why that is not in the name of the company. Why it is not transferred in the name of the company? What is the reason for that? Clear? That is the third point. So 3 points we have seen regarding PPE. What are they? Number one, whether the client is maintaining proper records. Number two, whether physical verification has been done. Number three, title of the immovable properties is held in the name of the company. Number four, I need to check whether the company has done the revaluation of its PPE or intangible assets or both during the year. If yes, I need to check that revaluation has been done on the basis of valuation done by a registered valuer. That revaluation should have been done by registered valuer. Revaluation should not be done on the basis of whatever comes to the management's mind. I need to check that revaluation has been done after getting the valuation certificate from the registered valuer. And also I need to specify the amount of change. Before revaluation, after revaluation, what is the amount of the change I have to report, but only when change is a 10% or more in the aggregate of net carrying value of each class of PPE or intangible asset. Change you are required to mention only when before and after revaluation the change is 10% or more, that too in the net carrying value of aggregate of each property, plant and equipment, class of property, plant and equipment. Here often students will get confused. Say for example, buildings is there, buildings class of PPE is there. In that three buildings we have building 1, building 2, building 3. Building 1 before revaluation, after revaluation values are there. So building 1 some value, building 2 some value. So before revaluation, after revaluation some values are there. Now when I talk about the change, building 1 has been revaluated by more than 10%. And for building 2 the change is 4%. The building 3 has been revaluated by minus 6%. Now people will feel that since the change in the value, since the amount of change is more than 5% here and here, building 1 and building 2 amount I am required to mention. No, this is not how you need to check. How you need to check is, you need to check the value, aggregate value of each class. For the entire building class, what is the value before revaluation? What is the value after revaluation? Here you need to calculate the change. For example, for the entire class, before and after revaluation, the change is only 3%. Then nothing is required to be reported. Then nothing, no amount is required to be reported. So you need to specify the amount of change only when the change is a 10% or more in the aggregate of net carrying value of each class of property, plant and equipment or intangible assets. I think I might have done a mistake here. 60. Let us take this 60. So you might come to a wrong conclusion that building 1 and building 3 amount is required to be reported. No, only when the entire class, for the entire class, if the change is 10% or more, then only report the amount, right? So 4 points regarding PPE. Number 1, maintenance of records. Number 2, physical verification at reasonable intervals. Number 3, title of the immobile properties is held in the name of the company. Number 4, revaluation. Number 5, Binami transactions. Whether any proceedings either have been started or already started in the past and are pending against the company for holding any Binami properties under Binami Transactions Prohibition Act. If yes, whether company has appropriately disclosed the details in its financial statements. They are not asking auditor to disclose the Binami cases. They are asking the auditor to check whether company has disclosed the transactions of Binami actions in their financial statements. If any case has been initiated or if any case is pending for holding any Binami properties, whether the company has disclosed the details of that pending litigations in their financial statements or not, that I have to comment. They are not asking auditor to give the details of that Binami transactions in his auditor's report. Clear? So first point is PP. Regarding PP, 5 points we have: maintenance of records, physical verification, title of the immobile properties, revaluation and holding of Binami transactions. Next one, the second clause which is required to be reported is relating to inventory. Second matter which is required to be reported is relating to inventory. So regarding inventory, what I need to check? Let us see. Physical verification. Here also I need to check whether physical verification of inventory has been conducted at reasonable interval, not by the auditor. I need to check whether inventory physical verification has been done by the management at reasonable intervals. For the purpose of inventory, reasonable interval means once in every year. Once in a year, they have to do the physical verification of inventory. When it comes to PPE, once in 3 years, but when it comes to inventory, once in a year, they have to do the physical verification. Number 1, if yes, whether we need to check, we need to comment whether management has done physical verification of inventory. If yes, whether coverage and procedures of such verification are appropriate. Did the management do the physical verification in a proper manner? Have they covered as per the size of the inventory? And what procedures they have followed for physical verification? Are they matching with the size of the company? That I have to give a comment. If I have to put it in simple terms, whether the management did the physical verification in a proper manner or not, I have to give a comment. Number 2, on doing that physical verification, did you find any discrepancy of how much 10% or more in the aggregate for each class of inventory were noticed, and if so, whether they have been properly dealt? Here also, if you find any discrepancy, you need to report, but only when the discrepancy is a 10% or more. Not for each item of inventory, for each class of inventory. Like we have raw material, work in progress, finished goods, stores and spares. No. So for each class, if the discrepancy is a 10% or more, then only required to report the amount here. Next point regarding inventory is relating to working capital loans. So this point says that whether your client company has got any working capital loan, has been sanctioned working capital loan on the basis of their current assets from any bank or financial institution for an amount exceeding 5 crores. Whether your client company has got any working capital loan on the basis of security of current assets for an amount exceeding 5 crores at any point of time during the year? If yes, see, generally when your client has got the working capital loan against the security of current assets, then your client will be required to submit quarterly stock statements. Your client will be required to submit quarterly stock statements. So they will submit the quarterly stock statements. Accordingly, the limits will be reset. Now they have put one responsibility on the auditor to check your client, whatever quarterly stock statements your client is submitting to the bank, are they matching with the books of accounts or not? That means I have a responsibility to check whether my client is submitting genuine stock statements or fake stock statements that my client is submitting. That I need to check and give a comment. And this point will become applicable only when your client company has been sanctioned a working capital limit of more than 5 crores. Sorry. So if you see here, whether at any point of time the company has been sanctioned working capital limits in excess of 5 crore rupees in aggregates from banks or financial institutions on the basis of security of current assets. If yes, they will submit quarterly returns. I need to check whether that returns are in agreement with the books of accounts or not. Clear? Next. So 2 points we have covered. Third clause is regarding investments, guarantee, security, loans or advances given by the company. So if your company has given any loans or advances and all, for that we need to report some points. Total under clause 3, we have 6 matters which are required to be reported. See, first point talks about segregation. So what does first point say here is, check whether your client company has given any loans and advances. If yes, we need to identify how much amount of loans are given to subsidiary, associate, joint venture, divided, others. So we need to check whether my client company has made any loans and advances. If yes, I need to identify how much amount of such loans are given to subsidiary, associate, joint venture, how much amount of such loans are given to others. Now, for subsidiary, associate, joint venture, I need to disclose how much amount of loan has been given, and also closing balance as on the balance sheet date. For others also, how much amount of loan has been given and what is the closing balance. Simply, I have to bifurcate. What is the amount of loan given and closing balance for subsidiary, associate, joint venture, and for others. Bifurcate the amount and report it. However, this point is not applicable in case if you are conducting audit of such a entity whose principal business is to give loans. This reporting requirement will not become applicable in case if you are conducting audit of such an entity whose principal business is to give loans. That means for NBFCs, this point will not become applicable. For banking, CARO is altogether exempted, but for NBFCs, this point is not required to be reported. So that's what you will be able to find it here. So when the company has given loans, provided advances, to guarantee, you need to simply bifurcate what is the aggregate amount and outstanding balance to subsidiary, associate, joint venture, and aggregate amount and balance outstanding to parties other than subsidiary, associate, and joint venture. Second one, this is something a repetition from 143 subsection 1. I need to check under whatever terms and conditions these loans, investments or guarantees are made, are they prejudicial? Are they not prejudicial to the company's interest? Nothing but terms and conditions should be fair. There should be proper rate of interest. There should be proper security. There should be a proper repayment period. So like that, whether terms and conditions are not prejudicial to the interest of the company, I need to check. Third one, the company just like that should not give the loans and ignore it. I need to check that whether they have prepared a schedule of repayment of principal and payment of interest. Repayment schedule should be there. And I should check whether the receipts are regular on or before the due dates they are receiving that installments or not. I need to check. Then if any amount remains overdue for more than 90 days, I need to check what steps are taken by the company for recovery of that principal and interest. So I need to check if any amount remains overdue. If it remains overdue for more than 90 days, what steps are taken by the company for recovery of that principal and interest? I need to comment. Then this point, E point, talks about rescheduling extension of overdue loans. So what do you mean by this is, so what does fourth point say here is, the company has given loan in the past, which has fallen due in the current year. What do you mean by fallen due? Due date is in the current year. So if it has fallen due in the current year, what they should have done, they should have recovered it. But what the company is doing is, instead of recovering the money, they have either extended the loan, or either they have renewed the loan, or they have given fresh loan to the same person from which he is repaying the old loan. You tell me, should it be done or should it not be done? It should not be done, right? So that's what they are asking you to check. Whether company has given loans or advances in the past, which has fallen due in the current year, but instead of recovering it, the company is either extending it, renewing it, or fresh loan is given to the same party to settle the existing loan. If you find any such a transaction, disclose what is the total amount of such extended, renewed, or fresh loans given to the same parties, and also calculate the percentage with the total loans. From the total loans, how much is this percentage of loans? That percentage also you have to calculate and report it. However, here also this point will not become applicable in case of those entities whose principal business is to give loans. So that means for NBFCs, once again, this point will not become applicable. And then comes the last point regarding loans, demand loans without repayment period. So you need to check whether your client has given any loan without mentioning any repayment period. Is it a good sign or bad sign? It is a bad sign. So you need to check whether your client company has made any loan without mentioning any repayment period. If yes, then you need to disclose what is the aggregate amount of such a demand loans. You need to calculate percentage to the total loans, and even you have to specify how much amount of such loans are given to promoters and related parties. So this is the third clause. So totally under third clause, which is talking about loans, investments, and guarantees, 6 points we need to check under this clause number 3. Number 1, we need to segregate the balance aggregate amount and balance outstanding between subsidiary associate joint venture other than subsidiary associate joint venture. Number 2, terms and conditions I have to check. Number 3, I need to check whether there is a repayment schedule. Number 4, if something is overdue for more than 90 days, what steps are taken for recovery? Number 5, if any loan has been renewed, extended, or fresh loan given, what is the amount and percentage? Number 6, if any loan has been given without mentioning any repayment period, what is the total amount, percentage, whether how much amount has been given to promoters and related parties? But out of all this, first and fifth point will not become applicable for a company whose principal business is to give loans. Next, fourth one is also talking about investments and guarantees made by the company. Very simple here. I need to check in case if the company has made any investment or guarantee, whether they have complied with the provisions of section 185 and 186 of the Companies Act. That's it. If not, the details of the non-compliances. Then fifth clause is regarding deposits. Whether your client company has accepted deposits. If yes, whether they have complied with the requirements of 73 to 76 of the Companies Act, whether they have complied with the directives of the RBI, whether they have complied with order of any company law board or court or tribunal. If there is any non-compliance, nature of the contravention should be stated. That non-compliances should be given. So fifth point is regarding deposits. Next, sixth point is regarding cost records. I need to check whether my client is required to maintain cost records as per section 148, whether section 148 will be applicable for my client. If yes, whether they have maintained that cost records or not, I have to give a comment. So total 6 clauses we are done. What are the first 6 clauses? First clause is regarding PPE. Second clause is regarding inventory. Third clause is regarding loans, investments, guarantees made by the company. Fourth point is also regarding loans and investments and guarantees. Fifth point is regarding acceptance of deposits. Sixth point is regarding cost records. Seventh point, once again important point, statutory dues. There are some reporting requirements regarding statutory dues. Sir, what are statutory dues? Statutory dues are those dues which are required to be paid mandatorily under law. And for the purpose of reporting requirements, these statutory dues are divided into 2 categories. Number 1 is undisputed statutory dues and the other one is disputed statutory dues. Sir, what is undisputed statutory due? There is some statutory amount which you are required to pay and you are not going for appeal or no conflict is there, you also agree to it. So such an undisputed statutory due. Sir, what is disputed statutory due? There is some amount which you are required to pay as per law, but you are filing an appeal. A case is pending before assessing officer, court, tribunal, high court, supreme court, whatever it is. So when it is an undisputed statutory due, I need to comment whether the company is regular in depositing all its undisputed statutory due. On or before the due date, the company is making deposit of all that undisputed statutory dues or not. And number 2, you need to check if there is any amount outstanding for a period of more than 6 months from the date it become payable as on the balance sheet date. If some statutory due is not paid and there is no dispute also, you are required to pay some statutory amount and there is no dispute also, but it is remaining unpaid and it is remaining unpaid for a period of more than 6 months as on the balance sheet date, that amount you are required to report. Which means, say for example, I am conducting audit of financial year 24-25. So the company is required to pay some TDS amount. Say they are required to pay some TDS on 31st of Jan 2025. But this amount is not paid till 31st of March 2025. Undisputed. No dispute is there. 10 lakh rupees of TDS they have not paid. Am I required to report? No, not required to report. Sir, it is outstanding? No. Yes, it is outstanding. But you are required to report only when it remains outstanding for a period of more than 6 months. So it is outstanding only for a period of 2 months, not required to be reported. So only those statutory undisputed dues which are outstanding for a period of more than 6 months as on the balance sheet date, only those are required to be reported. Clear? So when it comes to disputed statutory dues, two things you are required to report: what is the amount involved in the dispute, and forum where the dispute is pending, basically before which authority the case is pending, that is required to be disclosed. Next, eighth clause, which is talking about disclosure of undisclosed income. Sir, what do you mean by disclosure of undisclosed income? Very simple. What here they say here is, during the current year, if any income tax assessment has taken place, either scrutiny, raid, whatever it is, if any income tax assessment has taken place, and as a part of that assessment, some income has been surrendered or disclosed. Some income which was not previously disclosed in the books of accounts, which was not previously recorded in the books of accounts, that was surrendered or disclosed as a part of income tax assessment. That means as a part of assessment, you have offered it. Now, just offering to the tax authorities alone will not be enough. That would have not been recorded in the books of accounts also in the past. That previously unrecorded income should have been brought into the books of accounts also. So basically, for the purpose of clause 8, we need to check whether during the year any income tax assessment happened. As a part of that income tax assessment, whether any undisclosed income has been surrendered. If yes, just surrendering to the tax authorities alone will not be enough. Even that unrecorded income should be brought into the books of accounts. Whether they have done it or not, I have to check it. Next. So now, ninth point is regarding loans. So till now we have seen so many clauses talking about loans given by the company. Now we have clause 9, which is talking about loans accepted by the company. If your company has taken any borrowings, regarding that repayment of the loans, I need to check certain points and you have to include in the CARO report. What are they? Number 1, I need to check whether company has made any default in the repayment, either payment of principal or payment of interest, whether company has made a default. What do you mean by default? Not pay. Even if you don't pay in time, that is also default. Say for example, due date is 8th of August, but you paid it on 9th of August. Has the company made default? Yes. So either not paying altogether or even paying after the due date is also default. So I need to check whether the company has defaulted in repayment of loans. If yes, I need to report the period and the amount of default. That too lender wise I have to report. For each lender, what is the amount of the default? What is the period of the default? That lender wise details you are required to report it. Next one, willful defaulter. I need to check whether my client has been declared as willful defaulter by any bank or financial institution. So you need to get the credit scores or CIBIL reports. From there you can find it out. Third one, if your client has taken any term loan, they would have stated the purpose. They are going to use this term loan for some purpose. I need to check whether my client has used a term loan only for the set purposes. If not, if the loan is diverted, the purpose and the amount which has been diverted, that I am required to report. Fourth one, if your client has taken any short-term loan, but instead of using it for short-term purposes, have they used it for long-term purposes? That I need to check and give a comment. Fifth one, your client has taken a loan not for your client's requirements, but your client has taken a loan to meet the requirements of subsidiary associates and joint ventures. If yes, what is the amount of such loans? You have to report it. So if you see here, whether company has taken any funds from any entity to meet the obligations of its subsidiary associates or joint ventures, if yes, nature of such a transactions and amounts also you are required to report. Last one, your client has taken a loan by pledging the securities which it holds in subsidiary associate and joint venture. Fifth point says your client has got the loan to meet the requirements of subsidiary associate joint venture. Report it. Sixth point, your client has got the loan for your client's requirements only. But for getting that loan, you need to pledge something. No. What they have pledged is they pledged the securities of subsidiary associate or joint venture. So pledging the securities of subsidiary associate joint venture, if your client has got any loan, you need to give the details thereof and also report whether the company has defaulted in any of such loans. Clear? So when it comes to the ninth point, repayment of loans, we have in total some 6 points which are required to be reported. What are they? Number 1, client has made any default in the repayment, whether your client is declared as willful defaulter, whether the term loans were used for the set purposes, short-term loans were used for long-term purposes, whether your client has taken any loan for meeting the obligations of subsidiary associate joint venture, and whether your client has taken any loan by pledging the securities of subsidiary associate joint venture. Next one. 10th point talks about IPO or FPO, whether your client has made any IPO or FPO. If the client is going for IPO or FPO, they will release a prospectus. In that prospectus, they will say for what purposes they are going to make use of it. So I need to check whatever money, whether money raised by way of IPO or FPO, including debt instruments, including debentures IPO, whether they are utilized for the said purposes, for whatever purpose which has been mentioned in the prospectus, for the same purpose the money raised has been used or not. I have to check it. If not, if you find that the amount has not been used for the said purposes, defaults, delays along with subsequent rectifications, everything should be reported. Same thing for preferential allotment. If your company has made any preferential allotment or private placement of shares, here I need to check whether section 42 and 62 of the act has been complied with or not. Even for preferential allotment or private placement also, there will be prospectus, they will mention the purpose. There also I need to check whether they have been used for the said purposes or not. If not, provide the details in respect of amount involved and what non-compliances they have done. So this is what regarding clause 10. So till now we have completed 10 clauses. What are they? Number 1 PPE, number 2 inventory, 3 and 4 regarding loans, 5 is regarding acceptance of deposits, 6 is regarding maintenance of cost records, 7th is regarding statutory dues, 8th is regarding unrecorded income, 9th is regarding repayment of the loans, 10th is regarding utilization of IPO or FPO. Now coming to the 11th point regarding frauds. If you have any fraud that you are required to report it under 143 subsection 12, in addition to that you are also required to report the fraud under CARO also. So whether any fraud by the company or on the company has been noticed or reported during the year. If yes, what is the nature of the fraud, amount involved in the fraud, mentioned in the report of, mentioned in the CARO also. See, there is slight difference here. Under 143 subsection 12, if you have reason to believe, you have to report. But under CARO, you have to report only noticed or reported frauds. That means proven frauds are only required to be reported, whereas under 143 subsection 12, reason to believe is enough. Next one, you need to comment whether any of the auditors have submitted form ADT 4, whether any of the auditors have submitted 143 subsection 12. Form ADT 4 just now I have told you, right? So I need to comment whether any of the auditors, not just you, either secretarial auditor, cost auditor, whether any auditor has submitted form number ADT 4, that I have to give a comment. And whether auditor has considered whistleblower complaints. If there are any whistleblower complaints, whether you have considered it or not, you have to comment. 3 points are required to be commented under clause 11. Then we have Nidhi company. In case if you are conducting audit of a Nidhi company, 3 things we need to check. Nidhi company should have net owned funds to deposits ratio of 1:20. That means for every 1 rupee of net owned funds, they can accept a maximum 20 rupees of deposits. Whether they complied with that or not, we have to check. And also whether Nidhi company has kept a 10% in unencumbered term deposits, yes or no, that you have to check. And also I need to check whether Nidhi company has made any default in the payment of interest or repayment of principal. So 3 points, net owned funds to deposits ratio, 10% should be kept in unencumbered term deposits, and whether they have made any default in the payment of interest or principal. Next, I need to check whether any related party transactions are there. If yes, whether they have complied with section 177 and 188 wherever applicable. And also there are various disclosure requirements for related party transaction as per accounting standards. Whether all that disclosure requirements are fulfilled or not, I need to check. Then I need to check whether my client is having internal audit system which is matching with the size and nature of the business. And also I need to comment, as a statutory auditor, did I make use of any of the report of the internal auditors? Have you considered any report of the internal auditors? That also I need to check. So clause 13 talks about related party transactions. Clause 14 talks about internal audit system. So internal audit system is very, very easy. In internal audit system, only 2 points, whether your client is having internal audit system commensurate with size and nature of the business, and number 2, reports of internal auditor, have you considered it or not. Then 15th point, non-cash transaction. I need to check whether company has entered into any non-cash transaction with the directors of the company. If yes, there are certain rules under section 192 of the Companies Act, whether they have been complied with or not, I need to check. Then in case if you are conducting audit of NBFC, then there are certain points you are required to report. Number 1, is the NBFC required to get the registration under 45 IA of the Reserve Bank of India Act? If yes, whether that registration has been obtained or not. Number 2, whether your client is carrying out any non-banking financial or housing finance activities without obtaining certificate of registration. Number 3, whether your client company is a core investment company. If yes, whether they fulfill the criteria of CIC. In the CIC also, if you fulfill extra conditions, you will become exempted or unregistered CIC. Whether that additional conditions are fulfilled or not, I need to check. Which means if your client is NBFC, say for example, just example sake I am saying, if your client is a NBFC, if they fulfill some 10 conditions, they get the status of CAC. If my client is a CAC, whether that 10 conditions are fulfilled or not, I need to check. After becoming CAC, if I fulfill some extra 5 conditions, then I will become exempted or unregistered CAC. If my client is that exempted or unregistered CAC, I need to check the compliance with these 5 additional conditions also. Basically, criteria they are meeting or not, I need to check. Then also I need to comment if my client is a big group companies, my client is having various holding subsidiary associate companies. As a part of entire group, is there only one CIC or more than one CIC? If there is more than one CIC in the entire group, I need to mention what is the total number of CICs as a part of that group. Clear everyone? So this is what regarding NBFC. 3 points. Number 1, whether they obtain registration under RBI. Are they conducting any non-banking financial or housing finance activities without obtaining certificate of registration? Number 3, is your client is classified as CIC or exempted CIC, whether they fulfill the criteria. As a part of the group, is there one CIC or more than one CIC? If there is more than one CIC, what is the total number of CICs as a part of the group? Next one. 17th point, has your company made any cash losses, that too in the current year as well as the preceding financial year? If yes, that amount of cash losses you are required to report. So one thing you have to remember here, you need to report the amount of cash loss only if the company has made cash loss in the previous year also, in the current year also. If the company has made cash loss only in 1 year, no need to report. In the previous year, in the current year, in both the years they should have made the cash losses, then only you are required to report it. Next, see, cash loss is different, loss as per the statement of P&L is different. Sometimes as per the statement of P&L you might find a loss, but that might not be cash loss. So from the P&L you need to do the reverse calculation and calculate the cash losses. Say for example, the company might be having a loss as per the statement of P&L, 2 crores of loss is there, but this is not a cash loss. Now I need to calculate the cash loss from this. So loss as per the statement of P&L is 2 crore, but the depreciation, non-cash expense is there, 5 crore. I have to add it. If you add it, the company has actually made a cash profit. So if you have a loss as per the statement of P&L, that is not when reporting requirements will come. The reporting requirements under CARO clause number 17 will come only when you have made a cash loss, that too in the current year and also in the previous year. So you need to calculate the cash loss. Next, resignation of the auditor. You need to check whether any of the statutory auditors have resigned. If yes, try to understand because of what issues, because of what objections, because of what concerns they have resigned, and how they are having an impact on your audit, that you need to check. So whether any of the previous auditors resigned, if yes, you need to understand because of what issues, what objections and what concerns raised by the previous auditor. Next one, this is one such point. 19th point is one such point where you need to comment on the future. Generally in audit we comment only on the past, but this is one such point where they have extended our scope to the future. So now what this point number 19 says is, the auditor has to, I will read this in a different order. So if you read the second point here, you need to comment whether auditor is of the opinion that there is no material uncertainty existing as on the date of the auditor's report, that the company is capable of meeting its liabilities existing at the balance sheet date as and when they fall due within 1 year from the balance sheet date. Which means what? Say for example, 24, 25 financial year. The financial year starts from 1st of April till 31st of March 2025. Now after the year got closed, I am doing the audit. Say for example, I am giving my audit report on 30th of June. Now I need to analyze as of this date, as on the date of auditor's report, is the company having the capacity to pay all the liabilities which fall due within 1 year from the date of balance sheet. From the date of balance sheet, if you calculate 31st of March of 2026. So whatever liabilities which fall due within 1 year, basically current liabilities. So whatever liabilities which fall due within 1 year from the balance sheet date, is the company in a position to pay that liabilities, or is there any uncertainty existing? That you have to determine as on the date of your auditor's report, and you have to say your opinion. So if you see here, once again if you read it, whether auditor is of the opinion that no material uncertainty exists. That means the company is capable of paying as on the date of auditor's report, that company is capable of meeting its liabilities existing at the date of the balance sheet as and when they fall due within 1 year. So whatever liabilities which are existing on the balance sheet date and which fall due within 1 year, that is basically all your current liabilities, is the company having capability to pay its current liabilities, or is there any uncertainty that you have to give your comment? But however, on what basis you give your comment? On what basis you will give your comment? Just whatever comes to your mind you will say? No. On what basis you have to give your opinion is, on that they say it in the first point, on the basis of financial ratios. You have to calculate some ratios. You have to do some aging analysis of expected dates of realization of financial assets and payment of financial liabilities. Nothing but what is the date of realization of your debtors, what is the date of payment to the creditors, are you receiving the money before the payment dates, and using other information accompanying financial statements, and also auditor's knowledge of board of directors and management plans. Even as an auditor, you have to go and sit with the management, try to understand their plans, and after considering all this information, you have to give your opinion. Clear, everyone? So simply I have to express my opinion. Is a company capable of paying its current liabilities? On what basis I will take? I will say this information on the basis of financial ratios, aging analysis, and on the basis of realization of financial assets and liabilities, using information accompanying financial statements, and even auditor's knowledge of board of directors and management plans. Using all this information, I have to comment. Then, regarding CSR expenditure, I have some reporting requirements. Very simple, they try to say here. I will try to explain it. Clause number 20, regarding CSR expenditure, 2 points I need to report. Number 1, say for example 24-25 financial year, the company is getting covered under section 135. They need to spend 2% of their average profits on CSR. Say for example, average profits of the company is 100 crores, 2 crore rupees they are required to spend on CSR. Now, what the company has done is, within 6 months, that means till 30th of September, they want to develop a project. They have to decide a project, how they are going to spend the money. So they are required to spend 2 crores of money, right? The company has decided 1 crore, they will use it for construction of school. In the rural area, they will construct one school. Some 50 lakh rupees, they will give it as donation to the old age home. Some 30 lakh rupees, they will give it as donation to orphanage. So they are required to spend 2 crore rupees. Till 30th of September, they have projects for this much amount. 1 crore, they want to spend it on school. 50 lakh rupees, they want to give it as a donation. 30 lakh rupees, they want to give it as donation to orphanage. I'm not telling they have spent it. They have a project ready. For how much amounts they have a project? For 1.8 crore, they have a project. For how much amount they have to spend? 2 crore. That means within 6 months from the end of the balance sheet date, they are unable to have the projects for 20 lakh rupees. They are not able to decide how to spend that 20 lakh rupees. I'm not telling money should have been spent. Having a project itself is alone enough. So out of 2 crore, the company is having a project for 1 crore, 50 lakh rupees and 30 lakh rupees within 6 months. But within 6 months, they are unable to decide, they are unable to have any project how they are going to spend this 20 lakh rupees of money. So now what the Companies Act has told us, this amount they have to transfer it to a fund specified under Schedule 7. In the Schedule 7, they have specified some funds like PM CARES fund. So PM National Relief Fund, like that they have specified some funds. This money should go to that fund. Once the money go to the fund, government will take care of it. Now I need to check whether this amount for which there is no project that has been transferred to the fund specified under Schedule 7 or not. That I need to check. So whether in respect of other than ongoing project, that means you don't have any project ready, the company has transferred unspent amount to a fund which is specified under Schedule 7 to the Companies Act within a period of 6 months of the expiry of the financial year. Next, second point, one more point we have. See, within 6 months they have a project ready. Say for example 50 lakh rupees, they want to give donation. They have written a check and gave the donation. 30 lakh rupees, they want to give it as a donation to orphanage. They have written the check and gave it to the orphanage. 1 crore, they want to construct a school. But as we all are aware, school construction will not take a day or two. So they have a project ready for 1 crore, but they did not spend the money yet. So now what the act says is, if you have a project ready, but the money is not spent for the project, that money is going to take some time to be spent. This money should be kept in a separate bank account. This money should be kept in a separate bank account. Company only will have control over it. Just to segregate the normal funds from the CSR funds, they are asking you to keep that money in a separate bank account. So whether the company has kept that in the separate bank account or not, that also I need to check. First case, if you don't have project ready, the money will go to the government. It will go to fund. Second case, you have a project ready, but you want to spend it slowly, keep that money in the separate bank account. So that's what they say here. Whether any amount remaining unspent under 135 subsection 5 pursuant to any ongoing project. That means you have a project ready, but the money is not yet spent. That amount has to be transferred to a special account in compliance with 135 subsection 6 bank account they are talking here. So these are the reporting requirements under clause 20. So these 20 clauses will come in the audit reports of the standalone financial statements. Now clause number 21, this will come only in the audit report of consolidated financial statements. Now what is this clause number 21 says is, clause number 21 says, see, you are conducting audit of consolidated financial statements. What will be included in the consolidated financial statements? Holding companies will be there, subsidiary companies will be there, associates will be there, joint ventures will be there. Now what they say here is, if you are conducting audit of consolidated financial statements, you should go through audit reports of all the companies which are included in the consolidated financial statements. And in the audit reports of each of these companies also, go to CARO section and find out in any of the 20 clauses, does any clause contain a negative remark. So if you are an auditor conducting audit of consolidated financial statements, get the audit reports of all the companies which are included in the consolidated financial statements, go through their CARO reports, find out in any of that audit report, any of the paragraph of the CARO contains a negative remark. If yes, mention that in the consolidated financial statements audit report. So we have to say for example, in the holding company, para number 11 contains a negative remark. So I have to say in my consolidated financial statements audit report, so and so company X Limited, which is the holding company, in their CARO audit report, para number 11 is there, which contains a negative remark. That name of the company, relationship, and which paragraph contains a negative remark, that information you have to include. This only one point you have to include in the audit report of the consolidated financial statements. So if you see here, whether there have been any qualification or adverse remarks by the respective auditors in the CARO reports of the companies which are included in the consolidated financial statements. If yes, indicate the details of the companies, paragraph numbers of the CARO report containing the qualification or the adverse remark. Understood? So this is one such clause which will come in the consolidated financial statements, and these 21 matters under CARO you have to report it, whether you have a positive comment or negative comment. In all the cases you are required to report it. And in case if you are giving any negative remark, you have to mention the reasons why you are giving negative remark. In case if you are unable to express opinion on any of the clauses, you have to explain the reason why you are unable to express the opinion. Understood? So this is what the revision of the audit reporting chapter, where we have revised 4 standards along with various reporting requirements under section 143, various subsections of section 143. Hope you guys might have found this marathon series informatory and value addition in your preparation. Right. So let us resume our discussion then. So yesterday we have started day 1 of our CA final marathon for September 2025 attempt, and we have completed 2 chapters. Mainly we are done with introduction to the audit, and also we have completed this audit reporting. We had a very comprehensive revision of these 2 chapters. Now today we will be my target for today's session will be, we have to cover the 500 series revision, then we have to complete the 200 series of the revision. So these are very pretty important standards. 500 series of standards important for MCQs as well as the descriptive questions. Then we have 200 series of the standards, which is also going to be very important for descriptive questions as well as MCQ questions. So I have a target of completing today 500 series. 200 series also we will complete it, and we will try to do SQC and audit strategy planning and program. We'll see how the things will go. We will see. So but today we'll complete 500 series and 200 series. Then depending on the availability of the time, either we can complete both audit strategy planning and program and SQ and quality control, or we might end up with doing one chapter. So today being Sunday, we will extend it also a little bit. I am ready to extend my session, and even now, unfortunately, our live has started late by 30 minutes. So I am ready to sit here and do that thing for you all. So I expect the same from you. Please do have the patience, sit here, we will learn a lot, right? So without any delay further, let us try to proceed further, right? So we will start our discussion with, we'll start our revision with SA to SA 500 series. We'll start our revision with SA 500 series. So guys, we are having different kinds of standards which are issued by ICAI, and we will see even going forward there are multiple categories of the standards. Like we have something called SAs, which is talking about, which is providing guidance regarding audit engagements. If you are a chartered accountant in practice and if you are doing audit engagements, then SA, standards on auditing, will become applicable. Then we have something called SRAs. Whenever you are doing review engagements, then SRE will become applicable. Then we have SAE, standards on assurance engagement. When you are associated with other than historical financial information, then SAE will become applicable. Then we have SRS. Whenever you are doing related services, then SRS will become applicable. See, SRE, SAE, SRS, these are series of the standards. We will have a dedicated discussion. We have dedicated chapters talking about standards on review engagements, standards on assurance engagements, and for standards on related services. We have the dedicated standards. We will talk about them later, at a later point of time we will talk about it. So now mainly our focus is going to be on standards on audit. First we will focus on the standards on audit. So in the standards on audit also we have different series of the standards. We'll be picking up the 500 series now, and the 500 series of the standards, these are the standards which are providing the guidance regarding evidence and the related matters. SA 500 series of the standards are those standards which are providing guidance regarding audit evidence and related matters. Multiple aspects relating to evidence SA 500 series will talk about. So having said that, in SA 500 series, we have multiple standards to cover. We have SA 500, 501, 505, 510, 530, 540, 550, 560, 570, 580. So these are the standards which are mainly relevant for CA final examination. So these are standards we are going to have a first quick recap. So I will start my discussion with SA 500. In the 500 series, I will start my discussion with SA 500. And the title of SA 500 itself, if you look at the title of the SA 500, SA 500 is a standard which is going to talk about audit evidence. SA 500 is a standard which is going to talk about overall audit evidence in general. Now, we have already explained you in the previous session what is the entire process of the audit. So if you remember, the ultimate objective, the final outcome of the entire process of the audit is expression of opinion. But to express that opinion, we need some supporting information. That supporting information in the audit terminology, we are going to call it as audit evidence. The information which supports the auditor's opinion, or the information which forms a basis for the auditor's opinion. So that information in the audit terminology, we are going to call it as audit evidence, right? So that is what the simple meaning of the term audit evidence. So this standard will give you overall basic things relating to audit evidence, what methods are available, how we can obtain the attributes associated with the term audit evidence. This standard is going to give you a brief overview of the concept of audit evidence. See, before we can understand about audit evidence, it becomes necessary for us to know about audit procedures. Why? Because only when you perform audit procedures, from performing that audit procedures only, we are going to get the evidence, right? Just because we are appointed as an auditor, the moment we enter the client's premises, evidence will not automatically come and fall in our lap. We need to put some efforts from our side in order to gather that evidence, and that procedures which auditor is performing to gather that evidence, we call them as audit procedures. So audit procedures is a very broad term. So let us start our revision with by understanding what are the different kinds of audit procedures. So I will say here, audit procedures can be broadly divided into two categories. How many categories? Audit procedures can be broadly divided into two categories. Number one is risk assessment procedures, and number two is further audit procedures. And this further audit procedures can be further divided into two categories. We call them as compliance procedures, and also we call them as substantive audit procedures. So broadly two categories, but if I put it into specific terms, into three categories like risk assessment, compliance, and substantive audit procedures. So let us try to understand what happens in the risk assessment procedures, what happens in the compliance procedures, what happens in the substantive audit procedures. So starting with risk assessment procedures. So in the risk assessment procedures, if you are getting appointed as an auditor of any company, see, we all know the main objective of audit is to verify the financial statement and express our opinion. There is no doubt about it. Everybody will agree to that. But that doesn't mean the moment you are appointed as an auditor, the moment you start doing the audit, directly you will go to the accounts department and start verifying books of accounts. This you will not do. So initially, in case if you are getting appointed as an auditor, first thing what you will do is, before you go to the accounts department and start verifying the books of accounts, you try to perform some procedures by which you will try to obtain an understanding. You try to perform some procedures by which you try to obtain an understanding of three things. You try to obtain understanding of entity, you try to obtain understanding of environment, and you try to obtain the understanding of internal controls. First thing what we should do, so before we go to the accounts department and start verifying books of accounts, we need to obtain a good understanding of entity, environment, and its internal control. So what entity my client is, to which environment it belongs, to which industry it belongs, what kind of internal controls are there in my organization. So first we need to obtain an understanding of entity, environment, and its internal control. Sir, for what purpose, sir? To identify and assess. What is the purpose of understanding the entity, environment, and its internal control? To identify and assess the risk of material misstatement. So to find out the risk of material misstatement. Sir, what is risk of material misstatement? The chance of happening of misstatement in the financial statements. Where there is a possibility of happening of material misstatement in the financial statements, that susceptibility, that chance we have to find out. So to find out that, we understand the entity, environment, and its internal control, that procedures we are going to call them as risk assessment procedures. Now coming to the compliance procedures. So first we will take some 1-2 days of time. We try to understand about entity, environment, and its internal control. and we will identify risk of material misstatement. In which area risk is higher, in which area risk is lower, that risk we will identify. Next, what we will do? So then what we will do is we will not immediately once again jump to the accounts department and start verifying the books of accounts. Then we perform some procedures where we try to obtain audit evidence regarding operating effectiveness, where we try to obtain evidence regarding operating effectiveness of internal controls. See, at the risk assessment procedures, we get a basic understanding. At the risk assessment procedures, we try to make a list of all the controls the client is having. But just because controls are there, it doesn't mean they are operating effectively. So whether controls in the organization are operating effectively or not, we need to perform some procedures to determine the operating effectiveness of controls. That procedures we call them as compliance procedures. There is other name for compliance procedures. We also call it as test of controls. What do we also call it? We also are going to call it as test of controls. So whatever it is, we try to perform risk assessment, then we go to the verify internal controls and try to obtain evidence regarding operating effectiveness of internal controls. And once we have completed that compliance procedures, then we will go to substantive audit procedures. Sir, what will happen in the substantive audit procedures? This is where the ultimate audit is going to happen. So here what we will do is we try to get the books of accounts of the client, we try to get the financial statements of the client, and we try to determine whether that books of accounts and financial statements are reliable or not. We try to check the supporting documents, we try to ensure that accounting data and financial statements are correct or misleading. So actual verification of books of accounts and financial statements we will do, and that procedures we are going to call them as substantive audit procedures. So ultimate evidence, whatever we require for the purpose of expression of opinion, that evidence we are going to get it only by way of performing of substantive audit procedures. In the risk assessment procedures, we only understand the entity. In the compliance procedures, only we test the internal controls. And see, this understanding is very, very important. Why? Because throughout the standards, we will see risk assessment procedures, compliance, substantive. So going forward, when you come across this terminology, you should not be keeping the blank faces. You should have the good conceptual clarity. And between compliance procedures and substantive audit procedures, there is a relationship. What is that relationship is? Auditor will perform compliance procedures. From that, he will get to know the operating effectiveness of internal controls. And on the basis of that findings of the compliance procedures, the auditor is going to determine nature, timing, and the extent of the substantive audit procedures. So on the basis of outcome of the compliance procedures, the auditor is going to determine nature, timing, and extent of substantive audit procedures. That means if he finds that controls are effective, he will perform less substantive audit procedures. If he finds that controls are not effective, he will perform more substantive audit procedures. So the nature, timing, and extent of substantive audit procedures will be decided on the basis of outcome of the compliance procedures. Able to understand everyone? Clear and comfortable? So this is what regarding different types of audit procedures. Okay, now by performing these procedures, we are going to get something called audit evidence. We are going to get something called audit evidence. So this evidence, most of the audit evidence is going to come from accounting records. Majority of the evidence, whatever auditor is going to use, or whatever auditor is going to gather as a process, as a part of the audit, that we are going to get it from accounting records like books of accounts, financial statements, and everything. Supporting documents all will included here. But accounting records, agreed, accounting records is a major source of evidence for the auditor, but it is wrong to say accounting records are the only source of evidence. The auditor can also get evidence from other information apart from accounting records. Also from other sources also, auditor can get the audit evidence. Like when I say other than accounting records, what will be included here is MOA, AOA, minutes of the meeting, external confirmation. So like that, there could be other information also which can give the audit evidence to the auditor. So whatever it is, auditor is going to get audit evidence from the accounting records, or he can also get the evidence from other information as well. Okay. Then see, whenever there are different types of audit evidence also. Depending on nature or firm, we can divide the audit evidence into three categories. One is documentary, other one is oral, other one is visual. The names itself say, if you get it in a written format, documentary; if you get it in oral format, visual; if you are getting in a word spoken, oral format; and if you are getting by way of looking at something, that will be a visual evidence. And depending on the source, evidence can be further divided into two categories. One is internal evidence and the other one is external evidence. One is internal evidence, other one is external evidence. Internal evidence is the evidence which is originated within the client's organization, whereas external evidence is the evidence which is originated outside of the client's organization. So you tell me, between internal versus external, which evidence will be more reliable? Always external evidence is going to be more reliable than when compared with the internal evidence, because that is getting generated outside of the entity's premises, on which the client's management and staff will have less control over it. Next, see, whenever we use the phrase audit evidence in the subject of audit, whenever we use the phrase audit evidence in the subject of audit, it will always be preceded by two terms. It will always be preceded by two terms. Even in the audit reporting chapter also we have seen, they will not just say evidence, they will always say sufficient and appropriate audit evidence. So wherever the term audit evidence is used throughout the subject of audit, they just don't use it in a standalone manner. They try to prefix two attributes to the term audit evidence. They always ask the auditor to obtain sufficient and appropriate audit evidence. Now, what do you mean by sufficiency? What do you mean by appropriateness? Sufficiency is a measure of quantity of audit evidence, whereas appropriateness is a measure of quality of audit evidence. Sufficiency is a measure of quantity of audit evidence, whereas appropriateness is a measure of quality of the audit evidence. So they have only told what is the meaning of sufficiency, what is the meaning of appropriateness, but which evidence will be sufficient, which evidence will be appropriate, that is something which has to be decided by the auditor himself using his professional judgment. What evidence will constitute sufficient? How much quantity of evidence will be considered as sufficient? What quality will be considered as appropriate? That is something which auditor himself has to decide using his professional judgment. So using his knowledge, experience and training, the auditor has to decide how much quantity will be sufficient, how much quality will be appropriate. Whereas in order to determine how much, while taking that decision, while arriving at that conclusion, how much quantity will be sufficient, how much quantity will be appropriate, the auditor will consider various factors. Like if you take the sufficiency, he will consider various factors like size of the population. If the population is bigger, we need large quantity. It depends on risk of material misstatement. Higher the risk of material misstatement, higher quantity of audit evidence we want. It depends on materiality. So if the item is more material, more evidences will gather. Less evidence, less material, less evidences we will gather. It depends on effectiveness of internal controls. If the controls are more effective, less evidence. If the controls are less effective, more evidence. Clear? On the other hand, appropriateness of the audit evidence, it depends on two factors. It depends on relevance and it depends on reliability. So reliability means the trustability of the evidence. If the evidence is more reliable, that will be more appropriate. And reliability once again depends on source and nature. Source and nature. Like between internal, external, which one is more reliable? External is more reliable. Between documentary, oral, visual, which one is more reliable? Documentary is more reliable. So appropriateness depends on relevance and reliability is further going to depend on source and nature of the evidence. Everybody comfortable till here? Right. Then apart from that, we need to understand one more important thing regarding this SA 500. What are the various methods to obtain audit evidence, or what are the various procedures? Also sometimes they use it, methods, techniques or specific procedures to obtain audit evidence. See, audit is a universal subject. The beauty of the subject of audit is universal. All over the world, the subject of audit is going to remain uniform. Country to country, accounting policies, accounting principles, accounting standards might change, but country to country, audit will remain the same. So across the world, universally, anywhere you do the audit, for obtaining audit evidence, we have only 7 methods or 7 techniques available. Wherever you go in the world, anywhere in the world, if the audit is happening at any such place, there are only 7 methods which auditors are using to obtain the evidence. So what are that 7 methods which auditors are using is, number 1 is inspection. So if I list down those things here, so if I go to the material, let us have a look at the material. From here itself, we will try to learn. Yes, if you see here. So universally, we have only 7 methods to obtain audit evidence. Number 1, inspection. Number 2, we have inquiry. Number 3, we have observation. Number 4, we have external confirmation, recalculation, reperformance, and analytical procedures. So across the world, wherever you do, wherever the audit is happening, there all the auditors are making one of these 7 methods, or they might be using a combination of these methods. So repeat everyone, what are the 7 methods of obtaining audit evidence? Inspection, inquiry, observation, external confirmation, recalculation, reperformance, and analytical procedures. Sir, what exactly happens in each of this method? If you look at inspection, inspections contain 2 aspects. If you are either doing documentary examination, if either you are doing examining documents or your records, like that means you are examining, we are doing the record examination, or even if you are doing physical examination of an asset, that will fall under inspection. Like if I'm checking supporting documents, I'm doing inspection. If I'm doing physical verification of the asset, I'm doing a inspection there also. On the other hand, inquiry. Sir, what do you mean by inquiry? Inquiry means seeking information from the knowledgeable person by way of asking the questions. You find that some person, you believe that some person will possess the required information, you go to him, ask the question, get the responses. That is inquiry. And this inquiry can be a formal written inquiry, or it could be an informal oral inquiry. And inquiry will give you less persuasive evidence than when compared with all other methods. Inquiry will give evidence, but it will be less persuasive, it will be less convincing evidence. So why evidence from inquiry is less convincing is because you can't expect anybody to come and voluntarily disclose what mistakes they have done. So that's why inquiry will give evidence, but it will be least persuasive when compared with all other methods. And by doing inquiry, three kinds of information you will get. Either you will get new information which you are not previously aware of it, or the information which supports or which corroborates with the information which you already know, or the information which differs from the information which you know. So by doing any inquiry, we can get only three kinds of information. Number one, altogether new information which you are not previously aware of, or information which supports the information which you already know, or information which contradicts with the information that you already are aware of. So by doing inquiry, only these three kinds of information you are going to get it. And as I've told, evidence which you are getting from inquiries is less reliable. Sir, then what do you mean by observation? Observation means looking at the process being performed by others. Observation means what? Looking at the process being performed by others. Like for example, I want to obtain evidence regarding inventory. So management is doing physical verification. I am sitting and observing whether management is doing physical verification properly or not. So here I am looking at the process being performed by others. That method we call it as observation. See, observation will give evidence, but the problem is the reliability will be restricted only till the point of time such observation is taking place. Why? Because when you are not observing, what is the guarantee the same person will do the same activity in the same manner? So there is no guarantee, right? So that's why observation, yes, it will give reliable evidence, but its reliability is restricted only to the extent that observation is taking place. Then comes external confirmations. And what do you mean by external confirmation? Obtaining a direct written response from a third party. So if you want to know whether debtor's balance is correct, creditor's balance is correct, bank balance is correct, you can get to know about it by way of getting a written confirmation from the third party, that we call it as external confirmation. Then recalculation is mainly relating to checking of arithmetical accuracy. Today this method is no longer relevant. Why? Because today all the calculations are getting assigned to the software. So here in the today's environment, there might not be such a need to verify the arithmetical accuracy. Then we have another method, reperformance. Reperformance means what? A process which has already been performed by the management or entity. Auditor is reperforming. Auditor is independently executing that process once again to get the evidence. So reperformance will give you best evidence. Why? Because you are executing independently the transaction once again. But the problem with the reperformance is it is very, very time consuming. It is very much a time consuming. It will take a lot of time, but it will give you best evidence. And then finally we have one more method for obtaining evidence, which is analytical procedures. The name itself says it is not just some routine checking, it is analytical. Here we do analysis. Sir, what we do in the analytical procedures? In the analytical procedures, what we do is we try to study the relationship between financial and non-financial information. We try to study the relationship between financial and non-financial information, and on the basis of studying that relationship between financial and non-financial information, we evaluate whether financial information is correct or not. So basically, instead of doing the routine checking of checking the supporting documents and all, we try to study the relationships, like we do the ratio analysis, and from that we find out whether the financial information is correct or not. That we call it as analytical procedures. So universally across the world, we only have these 7 methods to obtain audit evidence: inspection, inquiry, observation, external confirmation, recalculation, reperformance, and analytical procedures. Clear, everyone? Right. And one more important thing, one more last concept which I will try to explain from essay 500. This is relevant for your CA final examination. And very often you come across a term called assertion. Very often at every chapter, in every standard will come across this term called assertion. Sir, what do you mean by assertion? Assertion means representations which are made by management. Assertion means representations which are made by management regarding account balances, class of transactions, and disclosures. So regarding various items of the financial statements, whatever assertions, whatever statements, either implied or explicit. So all that representations made by the management regarding various items of the financial statements, which we call it as assertion. Like if I have to put you simple terms, take for example balance sheet item. On the balance sheet there is a fixed assets. They have shown fixed assets at some value. By showing that fixed assets, management is making various representations, like they are telling that fixed assets are in existence, fixed assets they have completely recorded, and fixed assets are properly valued, and the company is having the rights against that fixed assets. So all these are representations impliedly made by the management. All this we call them as assertions. Similarly, if you take any long-term borrowing, they have shown in the balance sheet some long-term borrowing. By showing that long-term borrowing, here also they are making various representations, like they are saying that these liabilities are in existence, they have completely recorded the liabilities, they have valued that liabilities properly, and they have an obligation to pay the amount of that liability. Similarly, if you take the P&L item, say for example we have revenue. When they have shown the revenue at certain figure, they are making various assertion here also. Here they say revenue transactions have occurred, occurrence assertion. They have completely recorded all the revenue transactions. They have measured the revenue correctly, and they are making a cutoff assertion. That means which says that they have recorded the revenue only which belongs to the current year. So like this, whatever representations which are made by the management regarding various items of the financial statements, that I call it as assertion. And frankly, and typically if you see here, as an auditor, when I try to do the audit, I try to obtain the evidence regarding these assertions only. Like if I have to verify fixed assets, I will try to obtain evidence regarding whether fixed assets are in existence, whether they are completely recorded, whether they are valued properly, and whether there are rights of the company against that assets. If I have to verify revenue, what things I will try to verify? Whether revenue has actually occurred, whether they have completely recorded, whether they have measured properly, whether it belongs to current year. So basically, whatever representations which management is trying to do, only those regarding those representations only, as an auditor, I will try to obtain the evidence. Understood? That's all. So this is what regarding SA 500. So successfully we have completed SA 500. Now we will try to cover SA 501. We will try to cover SA 501. So for this, I have a kind of charts here which will help us for our quick revision. Right. So all this I have made it available on the website, so you can have a look at them. Right. So SA 501, sir, what does SA 501 talk about? So SA 501 is also talking about audit evidence only. So if you see here, SA 501 is also talking about audit evidence. Sir, but we have already seen the standard for audit evidence. Just now we have covered SA 500. So the difference between SA 501 and SA 500 is SA 500 is a standard which is talking about overall audit evidence in general, whereas SA 501 also is the standard which is talking about audit evidence, but it will talk about specific considerations for selected items. So this standard has selected 3 items. This standard has selected 3 items where they are giving a special guidance to you. Sir, what are the 3 items which are selected on which SA 501 is giving a special guidance to us? Number 1, how to obtain audit evidence regarding existence and condition of inventory. As an auditor, what things you can do in order to obtain evidence for obtaining audit evidence regarding existence and condition of the inventory, and how you need to obtain audit evidence regarding completeness of litigations and claims. Number 3, how you can obtain sufficient and appropriate audit evidence regarding presentation of the segment information. So 3 items they have selected: how to obtain evidence regarding existence and condition of inventory. Number 2, how to obtain evidence regarding completeness of litigations and claims. Number 3, how to obtain evidence regarding segment information. So let us try to understand what guidance does the standard give in order to obtain evidence regarding these 3 selected matters. We will try to understand it. First of all, coming to existence and condition of inventory. So if inventory is there in the balance sheet of the company, are you required to obtain sufficient and appropriate evidence regarding that inventory? The answer is 100% yes. Yes, we need to obtain audit evidence regarding that inventory. Sir, but how can I obtain that evidence? So the standard says that the standard is telling you a few steps here. So as an auditor, what you are supposed to do is, in order to obtain audit evidence regarding the inventory, so every management will do physical verification of their stock. Either they will do it on the balance sheet date or they will do it close to the balance sheet date. The management of every company will do a physical verification of their stock. Many entities will do on the balance sheet date, and some entities will do something close to the balance sheet date, either 5 or 10 days close to the before or after the balance sheet. They will do it. Management will do it. And whenever management is doing that physical verification, they will inform the auditor. They will inform the auditor. Now, as an auditor, you should try to attend that management's inventory counting process. As an auditor, the first step which you as an auditor to do are required to do to obtain audit evidence regarding existence and condition of inventory is the management of every company will do physical verification, and as an auditor they will tell you. So as an auditor, it is your responsibility to go and attend that inventory counting process. Management will do the inventory counting. You have to go and attend there. Sir, by attending there, what I am supposed to do? So after you have attended that inventory counting process, what you should do there is you should go there and evaluate the management process. That means you try to understand what process management is following for doing that inventory verification. Number two, sit there and observe the management counting. Sit there and observe how the management is doing that counting. And inspect the inventory. Randomly, you check the quality of the inventory, inspect the inventory. And you also try to perform the test counts. If you are feeling bored sitting there idle for a long period of time, what else you can do is you can go and perform the test counts. On a sampling basis, you can also do the counting. So whatever it is, management will do physical verification. They will call you. It is your responsibility to go and attend that inventory counting process and follow these 4 steps, perform these 4 steps. Okay, evaluate the process, observe the management counting, inspect the inventory, and perform the test counts. And if they are doing inventory counting on the date of balance sheet, well and good. If they are doing the inventory counting on other than balance sheet date, say for example, management is doing inventory counting on 10th of April 2025. So you will go there and perform that 4 steps. You are satisfied with the quantity of the stock. But here, what you need to do is the stock which is there on 10th of April, that will not come in my balance sheet. The stock as on 31st of March will come in my balance sheet. Now you have to do the reverse calculation. So how you will do the reverse calculation? You will take the stock as on 10th of April, that stock you will take, and whatever sales that have been made from the balance sheet date till the counting date, that you will add it, and whatever purchases that have been made from the date of the balance sheet till the date of counting, that you will reduce it. The balancing figure should be matching with my stock as per the balance sheet date. Yes or no? So this you need to verify. You need to perform audit procedures on these intervening transactions, sales and purchases which are made from the date of the balance sheet till the date of the counting, that we call it as intervening transactions. On that also you need to perform some audit procedures. So whatever it is, you try to attend the management's inventory counting process. See, sometimes what will happen is management is doing inventory counting. They have informed the auditor also, but the auditor is unable to attend that inventory counting process. Management is doing inventory counting. They have invited the auditor also, but because of some circumstances, auditor is unable to attend that inventory counting process performed by the management. Then what he is supposed to do? Then the standard says, if you are unable to attend the management inventory counting process, auditor shall himself do the physical verification on a test checking basis. You have to plan the physical verification on some alternative day. If you are unable to attend management inventory counting, you take your team, plan the inventory verification on some alternative date. You have to do the counting on your own. So if you are unable to attend management's counting process, you shall do the inventory verification by yourself on some alternative date. See, but in some cases, what will happen is management has asked you, management is doing inventory verification, but you are unable to attend. You thought, okay, I will go and do the physical verification on my own, but that has also become highly impracticable now. Management did the inventory verification, they invited you, you did not go. You thought you will do the verification on your own on some alternative date, but that has become highly impracticable. So when I say impracticability, it is not because of time and cost constraint. Impracticability should be because of circumstances beyond your control, like calamities, riots, social disturbances. These are the examples of calamities. These are the examples of impracticabilities. I have a lot of time it will take, lot of distance I have to travel. This is not the reason for impracticability. So whatever it is, if physical verification becomes highly impracticable, then as an auditor, you should perform alternative audit procedures. Sir, what could be alternative audit procedures? That you have to decide on the basis of your professional judgment. There is no hard and fast rule anywhere. So you should try to perform alternative audit procedures to obtain audit evidence. If alternative audit procedures are also not possible, then you have to modify your opinion. If alternative audit procedures are also not available, you have to modify your opinion. And here, generally, the opinion will be, the impact will be either a qualified opinion or a disclaimer of opinion. So why qualified or disclaimer? Why? Because it is a case of non-availability of audit evidence. So if you are unable to go to physical verification, if you are unable to perform alternative audit procedures, this is a typical scenario where you are unable to obtain audit evidence. In that case, you are required to modify your opinion. Either you have to give a qualified opinion or you have to give a disclaimer of opinion. Understood? And one more thing the standard will say here, when you go for inventory counting, these are the matters which you need to pay attention. So matters which are relevant in planning attendance at physical inventory counting. Either you are attending the management's inventory counting or you are doing the inventory counting on your own. These are the matters which you have to pay attention. So which matters you have to pay attention? You have to pay attention to nature of inventory, stages of completion of work in progress. You have to identify the risk of material misstatement related to inventory. What is the nature of internal control? What kind of controls are operating over inventory? Whether the proper instructions are given for inventory counting. What is the timing? Is it getting done on the balance sheet date or other than balance sheet date? What kind of inventory maintenance system the company is following, perpetual or periodical? The location where the inventory is held, and what is the risk of material misstatement for that, and is there any requirement of expert in verification of some inventories? We might be required to take the help of expert, determine is there any need for the expert. So these matters you have to pay attention. Now, coming to the next part of the standard, coming to the next thing, sometimes what will happen is your client will be the owner of inventory, but that inventory is not in the possession of your client. Your client will be the owner of inventory, but that inventory might be in possession of third party. Do I need to obtain audit evidence regarding that inventory which is there in the custody of a third party? Answer is yes. Yes, even if the inventory is in the custody of third party, then also you need to obtain audit evidence. Sir, how can I obtain audit evidence regarding the inventory which is held in the custody of a third party? So what the standard says here is, if the inventory is held in the custody of a third party, what you can do is you can try to get the external confirmation from the third party. You can try to get external confirmation from the third party. See, generally external confirmations will be reliable, but sometimes if you have a suspicion, if you have a doubt regarding reliability of external confirmation, then you should not just stop with external confirmation. You need to, if possible, try to attend the third party's premises or arrange the another auditor. If you know some other person who is at that location, to go and do the verification on your behalf, arrange some other auditor, or even you can verify the documentation between that third party and your client when external confirmations are not reliable. If external confirmations are reliable, well and good. When external confirmations are not reliable, don't just stop with external confirmation, perform this extra steps also. Clear? Everybody understood? So we have tackled the first part of the standard, how to obtain evidence regarding existence and condition of inventory. Now let us come to the second part, how to obtain evidence regarding completeness of the litigations and claims. See, litigations and claims are also one of the important critical area in the items of the financial statements. Now the standard is giving us guidance how to obtain audit evidence regarding completeness of litigations and claims. Whether management has completely disclosed all the litigations and claims in their financial statements, or are they hiding something from the financial statements. Regarding this, you need to obtain sufficient and appropriate audit evidence. And how you can obtain that audit evidence is, the standard SA 501 says, first they are asking you to identify the risk of material misstatement. They are not asking you to directly go and identify the misstatement. First, they are asking you to identify the risk of material misstatement. Sir, how can I identify that risk of material misstatement in the area of litigations and claims? Three simple steps should perform the below procedures to identify the risk of material misstatement. What are they? Number one, inquire with the management and entities in-house legal counsel. Just go and inquire with the management, and if there is an in-house legal team, internal legal team, go and communicate with them. Inquire with them. Have they disclosed completely all the litigations or not? Number two, read the minutes of those charged with governance. So whatever those charged with governance meetings are there, read the minutes of those charged with governance meetings, and even review the legal expenses account. Track the legal expenses account, do the analytical procedures, like when compared with the last year, in the current year, is there any huge significant increase or decrease in the legal expenses? So whatever it is, perform these three steps to identify risk of material misstatement. Once again, I'm telling, I'm not finding out the misstatement directly, just I'm identifying risk of material misstatement by doing what? By doing three simple steps. So what are the three simple steps? Inquiry of the management, review of minutes of the meeting, and verifying the legal expenses. Now, once you have performed that three steps, there could be two options. There could be two outcomes. Yes, there is a risk of material misstatement, or no, there is no risk of material misstatement. That means after I have performed that three simple steps, I found that management did not hide anything. There is no suspicion for me. So if you did not find any risk of material misstatement, end the procedures with that three steps. Just to perform that three steps and end your audit procedures if you did not find any risk of material misstatement. But however, by doing that three steps, if you find some suspicion, there might be something hidden in the litigations and claims. If you find that there is a risk of material misstatement, then you need to perform extra procedures. By performing that above three simple steps, if you find the risk of material misstatement, then you should perform extra procedures. What are that extra procedures I have to perform? Number one, auditor shall communicate with entities external legal counsel. Whoever is the entities external legal counsel which the company has appointed, that you have to communicate with him. Sir, how can I communicate with him, sir? You can communicate with him through a letter of inquiry. Through a letter of inquiry, you have to communicate, which will be prepared. Here it is very important. You have to communicate with the entity's external legal counsel through a letter of inquiry, and that letter of inquiry should be prepared by the management and it will be sent by the auditor, and we will ask the entity's external legal counsel to respond back to the auditor directly. So auditor has to communicate with entities external legal counsel through what? Letter of inquiry. Who should prepare that letter of inquiry? Management. Who should send it? Auditor should send it. And in that letter of inquiry, you should ask the external legal counsel to respond back directly to the auditor, not to the management. Okay, so if you have sent the letter of inquiry, if the external legal counsel has responded, well and good. There is no complication. But when the problem will arise is, I want the management to draft the letter of inquiry, but the management told, no, we will not draft the letter of inquiry. We will not help you to prepare the letter of inquiry. Or management has helped me to draft the letter of inquiry, but the external legal counsel does not respond. He is not giving me response, or he is prohibited from responding. Because of his ethical requirements, is prohibited from responding. Any of this thing could happen, which creates a bottleneck. If the management gives a permission, they drafted the letter of inquiry, we sent it to the external legal counsel, he responded back. If everything runs so smooth, well and good. But when the problem will come, either management is not drafting a letter of inquiry, or they have drafted, I have sent it, but external legal counsel is not responding or is prohibited from responding. If any of these things happens, then there is a problem. So then the standard says, if any of these things happen, the auditor shall perform alternative audit procedures. What he shall perform? Alternative audit procedures he shall perform. Sir, if alternative audit procedures are also not possible, then what I should do, sir? Then you should modify your opinion. And which kind of modified opinion? This will also be a typical case of non-availability of audit evidence. So here also I will give either a qualified or a disclaimer of opinion. Able to understand? And not just that, you obtain written representation from the management stating that they have disclosed all the litigations and claims and they are not hiding anything from the auditor. Ask the management to give a written confirmation. And also sometimes auditor will feel that just communicating through a letter of inquiry alone will not be enough. Auditor might feel that it will be better if he goes and directly meets with the entity's external legal counsel. Sometimes auditor will have a feeling that communicating through letter of inquiry alone will not be enough. He might be required to go and meet with the entity's external legal counsel personally. Sir, when such need will arise, the need to go and directly meet with the entity's external legal counsel will arise if the auditor feels that the risk from that litigation is a significant risk, or the matter is very complex to understand, very difficult to understand, or when there is a disagreement between management and external legal counsel. In these circumstances, the auditor might feel that it will not be enough to just communicate through letter of inquiry. It will be better if he can go and meet with the entity's external legal counsel. And there is also one more point which I would like to add here. See, generally what will happen is, if you ask the external legal counsel a general inquiry, so if you post a letter of inquiry, and in that letter of inquiry also, if you are making a general inquiry, like a general inquiry, not asking any specific details, if you are doing a general inquiry, in many cases external legal counsel will not respond. Why? Because they are not free like anyone. So they will have their own duties and all. So if you do general inquiries, they will not respond. So if you want to get a response from the entity's external legal counsel, you have to send a letter of specific inquiry. You have to send a letter of what? Specific inquiry. Sir, what information should be included in that letter of specific inquiry? Number one, you should give a list of all the litigations and claims. Whatever management has communicated with you as an auditor, whatever litigations and claims you are aware of, include a list of all the litigations and claims. And where available, management's assessment of the outcome and estimated financial implications. So all list of all the litigations, and what is the management's assessment, what assessment management has made. Have they determined that it will result into a provision, or have they determined it will result into a contingent liability? Management would have made some assessment. No, what is the management's assessment? And after giving list of litigations and the management's assessment, and in that letter of specific inquiry, you ask the legal counsel, you request the legal counsel to confirm on the reasonableness of management's assessment. So you ask legal counsel to respond, sir, for this litigation, management has made this assessment. Is it reasonable? And also provide further information if the list is incomplete or incorrect. Or even you ask that legal counsel, sir, these are the list of litigations I got to know. Is there anything missing from this list? So like this, if you could draft a letter of specific inquiry instead of making a general inquiry, the chances of getting the response will be much higher. Understood? So this is how we need to obtain audit evidence regarding litigations and claims. Now let us come to the last part regarding which the standard is giving the guidance in how to obtain audit evidence regarding presentation of segment information. So what things we can do in order to obtain evidence regarding segment information? So if you see here, very simple. When it comes to segment information, we have the standards. When it comes to segment information, we have accounting standards. If Ind AS is applicable, we have a dedicated Ind AS. If accounting standards are applicable, we have a dedicated AS. Simply, we need to check whatever the requirements of the applicable financial reporting framework is there, are that complied with or not. That's it. Why? Because in the accounting standards or Ind AS, they have given guidance how to identify the segments. They have suggested you some methods. They have suggested you some calculations. So you need to just try to understand whether management has identified the segments by following all the requirements given in the accounting standards. That's what even they try to say here. So as an auditor, you should try to obtain evidence regarding presentation and disclosure of segment information. How? By obtaining an understanding of methods used by the management. Try to obtain an understanding of what methods are used by the management in determining the segment information. And then you evaluate whatever methods management have used, whether they are as per the applicable financial reporting framework, and also test that methods, whatever management have used. And wherever suitable, you try to perform analytical procedures. You try to study the relationship. Last year segment information, current year segment information, you compare it with a competitor. Try to perform analytical procedures. Now, if you come to this part, sir, this standard is asking me to obtain understanding of the methods. No, which methods? What things? What are the examples of the matters which I need to understand regarding the methods? So that they are extending it here. So understanding of the methods used by the management, examples of the matters that may be relevant when obtaining an understanding of methods used by the management. So what things you will try to understand? Sales transfer charges between the segments, how the sales are getting bifurcated, how the charges are getting bifurcated, how the assets are getting bifurcated. Comparison with the budgets. If they have budget, segment wise budgets are there, so try to do a comparison with the budgets, and how the assets are getting allocated, on what basis costs are getting allocated. And even you need to check consistency with the previous period. Well, last year whatever principles have been followed regarding segment information, in the current year also it has been consistently applied or not, that you need to check it. Clear, everybody? So this is what SA 501 is going to give the guidance about. Now let us talk about SA 505. This is a standard which is talking about external confirmation. This is a standard which is going to talk about external confirmation. Very important. In the recent times, we are seeing a lot of MCQ questions from this standard SA 505. Simple standard, easy standard, and if you are able to understand the concept at a reasonable level, easily some MCQs you can answer it. So SA 505, they are talking about external confirmation. If you remember, in the SA 500, we have understood what are the various methods for obtaining audit evidence. In that, one of the method is external confirmation. Yes or no? So what is this external confirmation? How we can make better use of it to obtain the audit evidence? All that guidance has been given under SA 505. So let us see what does the standard say. So SA 505, external confirmation. First, that defining the term external confirmation. So what do you mean by external confirmation? So they say that external confirmation is a direct written response which is obtained by auditor. A direct written response which is obtained by auditor from a third party or confirming party. When I say third party, outside of the client's management, outside of the client's staff, a third party like debtor, creditor, banker. So if the auditor is getting a direct written response, see, if you get an oral response, that will have no validity as an external confirmation. In order to be considered as external confirmation, that response must be compulsorily a written response, which can be either in paper form or even it could be in electronic form. Either you can get that written response by way of a printed letter or even you can get an email, no issue. So a direct written response obtained by the auditor from a third party or a confirming party, that we are going to call it as external confirmation. And these external confirmation requests can be broadly divided into two categories. We can divide the external confirmation request broadly into two categories. Number one is positive confirmation request and number two is a negative confirmation request. So what is positive confirmation request? What is a negative confirmation request? We'll try to simply understand it. So positive confirmation request refers to such a confirmation request where if the auditor is expecting the third party to respond, either he agrees with the information or even if he disagrees with the information. That means I'm expecting a response from the third party in all the circumstances. Like for example, I'm drafting a confirmation request in the letter. I'm saying that, sir, I'm an auditor of so-and-so company. I came to know that you are a debtor. My client is saying your balance is this much. Please confirm whether you are required to pay this much amount or not. So that means I'm expecting the third party to respond. Either he agrees with the information or disagrees. That means even if he agrees also, I'm expecting a response. Even if he disagrees also, I'm expecting a response. That I call it as positive confirmation request. Then I have something called negative confirmation request. Negative confirmation request refers to such a request where you are expecting the third party to respond only when he disagrees. I don't want the response from the third party if he agrees with the information. I want the response from the third party only when he disagrees with the information. And also sometimes I will draft the confirmation request in such a manner that where I will not say the amount. What I will say is I will ask the third party only to provide the information directly. Like for example, I will draft the confirmation request something like this. Sir, I am an auditor of so and so company. I came to know that you are a debtor for my client company. Can you please tell me what is the amount which you are required to pay to my client company? What is the amount which you are required to pay to my client company? So that means I'm asking the third party to confirm, to give me the information directly. This will also form part of my positive confirmation request. So either I am expecting the third party to respond, either he agrees or disagrees, or I am expecting the information directly from the third party. Both will fall under both will fall under positive confirmation. On the other hand, if I am expecting a response from the third party only when he disagrees with the information, that we call it as negative confirmation request. Clear and comfortable? And one more thing, between positive confirmation request and negative confirmation request, you tell me which one is more reliable. See, always positive confirmation request will be more reliable than when compared with a negative confirmation request. That doesn't mean you should not use negative confirmation request at all? No, you can use a negative confirmation request, but in which circumstances you can make use of negative confirmation request, that also standard is trying to help us out. We will see in the rest of the standard. We'll see in which kind of circumstances we can make use of negative confirmation request. Clear and comfortable, everyone? Right. So apart from that, a few more definitions they will try to say here. They will also say exception. We need to understand even the meaning of the term exception. Sir, what is the meaning of the term exception? Nothing but the information which is contained in the confirmation request and the response which you got from the third party, if both are not matching, that I call it as exception. Like in the information in the books of accounts of the client, they told that 10 lakhs is owed by the debtor, but the debtor gave me a response that no sir, I am required to pay only 8 lakh rupees. This difference is there. This difference only I call it as exception. And one important thing we have to remember here, exception doesn't always mean a misstatement. If you find an exception, that doesn't always mean misstatement. Why? Because because exception might arise not only because of misstatements by your client. Exception can also arise because of the third party's mistake also. So that's why when you find a difference, that we call it as exception. When you find exception, don't immediately jump to the conclusion that it is a material misstatement. We have to investigate further whether there is a mistake in our client's books or there is a mistake in the third party's book. Then we have to arrive at a conclusion whether that exception is resulting into misstatement or not. Clear? Then one more term also they define here, non-response. Sir, what do you mean by non-response? So they say two things here. You are sending a positive confirmation request. You are sending a positive confirmation request that has been delivered to the third party, but the third party is not responding. So you send a positive confirmation request and the third party is not responding to it. That we call it as non-response. Or you send a confirmation request either positive or negative, but it has been returned undelivered. Returned undelivered. That means the recipient can't be traced. You got your confirmation back, either positive or negative. If you are sending a confirmation request, either positive or negative, but it was returned undelivered, this scenario we call it as a non-response. One more case, you are sending a positive confirmation request. It was delivered to the third party, but the third party did not respond appropriately. Then that also we call it as non-response. Whereas if you send a negative confirmation request, if it was delivered but you are not getting a response, that we can't consider it as non-response. That we can't call it as non-response. Why we can't call it as non-responses? Why? Because in the negative confirmation request, if you don't get the response, we generally expect that the third party has agreed with the information which is there in the request. Clear, everyone? Right. So this is what regarding non-response. Then, so if you want to obtain the evidence from the external confirmation procedure, you need to follow 4 steps, or you need to have control over 4 steps if you want to get the best evidence from the external confirmation procedure. Sir, what are that 4 steps? Number 1, determine the information regarding which you want external confirmation. Number two, select the appropriate confirming party, determine who is that appropriate party to whom you have to send the confirmation request. Then you have to design your confirmation request. You have to do the proper designing of the confirmation request. And once you have designed it, you have to send it and do the follow up of that confirmation request. So there will be 4 steps involved if you want to get the best evidence from the external confirmation. So what are the 4 steps? Number one, determine the information which you want to get the confirmation. Number two, select the appropriate confirming party. Number three, design the confirmation request. Number four, send the request and do the follow up wherever required. Now talking about each and every step in a detailed manner. First one, determining the information to be confirmed. So as we all are aware, generally we use external confirmation. Generally, we use external confirmation to confirm the balances, to confirm the amounts and figures, to get the quantitative details. But do you think the usage of external confirmation is restricted only to this confirmation of balances? Definitely not. We can also use external confirmation for qualitative aspects. For other than accounts and balances also we can use it, like to confirm the terms and conditions of the agreement, to confirm whether the title deeds are really there with the banker, to confirm whether there are any side agreements with the customers. Even for these qualitative aspects also you can start making use of external confirmation. You need not restrict the use of external confirmation only to quantitative aspects. You can also use it for other than quantitative aspects. And next step, once you have selected the information regarding which you want confirmation request, the next important step is you need to identify the appropriate confirming party. Who in the third party is the appropriate person to whom you have to send the confirmation request, that you have to determine. Why? Because if you send the confirmation request to an inappropriate third party, either you will not get the response, or even if you get the response from that inappropriate party, that response will not be reliable. So that's why you need to select the appropriate confirming party. So once you have selected the appropriate confirming party, then you have to design your confirmation request. Sir, while designing the confirmation request, you need to consider various factors, like you need to pay attention to risk of material misstatement. You need to you need to pay attention to presentation. That means you want to present it in a paper form or electronic form. You need to use your past experience. You need to verify that also depends on the assertion, that respective assertion, if it is more risky positive, less risky negative. It also depends on method of communication. So what is the method of communication? Once again, oral, not oral, physical form, email. And also it depends on management authorization. Is the management has given you the approval or not? And few more points also they say here, like if you see here, few more factors which you are required to do is, where is it? Yeah, here it is. So designing the confirmation request, everything I have included here, like risk of material misstatement, layout and presentation, past experience you have to use, what assertion you are addressing, that you have to consider, what is the method of communication, do you need management authorization? Because some third parties will say we will respond only when you have management approval. In those cases we need to get the authorization. And also confirming parties ability to provide the confirmation request. Clear? Next, follow up. So once you have done all that, once you have designed the confirmation request, you will not keep it in your locker, right? So you have to send the confirmation request and you have to do the follow up. See, one more thing here, we will do the follow up only in the case of positive confirmation request. When we will do the follow up, we will do the follow up only in the case of positive confirmation request. We will not do it in the case of negative confirmation request. So if you can follow these 4 steps carefully, you will get the best evidence from external confirmation. Then I told that the confirmation request will be of 2 types, positive confirmation request and negative confirmation request. I told which one is more reliable. Positive confirmation request will be more reliable, or negative confirmation request will be more reliable. Positive will be more reliable. Does that mean should I not make use of negative confirmation request at all? No, you can use it. When you can use it, you can use it only in the areas where the risk of material misstatement is very low. Where the risk of material misstatement is low, there we have to use negative confirmation request. That's what I have kept it here. Don't use negative confirmation request if the risk is very, very high. Why? Because negative confirmation will give less persuasive evidence. It will give less convincing evidence than when compared with the positive confirmation request. And you should use negative confirmation request as a sole substantive audit procedure only in the below mentioned areas. So if you want to use negative confirmation as the only audit procedure, you can do only when only all the below conditions are met. What are they? Number one, risk of material misstatement is very, very low. Controls are effectively operating in that area. The population is very small and contain homogeneous transactions. A very low exception rate you are expecting, and recipient doesn't disregard request. That means you know the recipient very well, that if he sees the request he will definitely respond. So that means you don't have any information which makes you believe that recipient will disregard. That means if you know that recipient will disregard, that means he will ignore the request. There you should not send positive, there you should not send negative confirmation request. There you have to send the positive confirmation request. So you can use the negative confirmation request when all these conditions are present. Understood? Next, sir, I want to send a confirmation request to the third party, but the management is refusing to allow me to send a confirmation request. I want to send the confirmation request to the third party, but the management is refusing me to send the confirmation request to the third party. Then what I should do? If the management is refusing you to send the confirmation request, first go to the management, inquire reasons, ask them why they are stopping you from communicating with a third party. Now, if there is a reasonable justification, management gave you valid reason. So they told that some cases going on. If you ask the external confirmation now, the third party will not respond. Why? Because that you can use it as evidence, that the that your client can use it as evidence in the court of law. So that's why the third party is not responding. So if there is a reasonable justification, then the standard says try to perform alternative audit procedures. If alternative audit procedures are also not possible, communicate with those charged with governance, and if required, modify your opinion. Why? Because here also it will be a case of non-availability of audit evidence. So if there is a reasonable justification, this is what you are supposed to do. But if there is no reasonable justification, you want to send the confirmation request, but the management is not allowing you to send the confirmation request, and there is no reasonable justification for doing it. And when I ask them the reasons why they are stopping me from communicating with the third party, they're not giving me any reasons at all, or they're giving me all the invalid reasons. In that case, I need to reassess my risk of material misstatement. Initially you might have thought risk is low, but now you got to know about true nature of the management. Reassess your risk of material misstatement, especially risk of fraud. Then you have to communicate with those charged with governance, and even here also you need to consider modifying your opinion. Able to understand everyone? Clear and comfortable? Right. Now, let us talk about SA 510. So, we have successfully completed 3 standards from the SA 500 series. We have completed SA 500, 501, and also we have completed 505. So, let us now try to proceed further with the next standard, which is SA 510. We will try to revise now. Right. So let us try to understand SA 510. So SA 510 is going to talk about initial audit engagements, and especially in the case of initial audit engagements, what will be the auditor's responsibilities regarding opening balances. Mainly the standard will talk about opening balances, and that too in the case of initial audit engagements. So here we are required to understand the terms first. They are using 2 terms in the title of the standard. Number 1, they are using initial audit engagement. Number 2 is opening balances. So let us try to understand the meaning of both these terms. First, we will try to understand what is the meaning of initial audit engagement. The name itself says. See, they define that initial audit engagement refers to such an engagement where either previous year was unaudited or the previous year was audited but by a predecessor auditor, not by you. Last year audit has altogether not happened. Say for example, if I am supposed to conduct audit of the financial year 24-25. Now last year 23-24, it is not at all audited. In that case, this year will become an initial audit engagement for me. Or last year it was audited 23-24, last year it was audited, but it was not audited by the same person. It was audited by predecessor auditor. Some different firm has done the audit of the last year. That means last year auditor and current year auditor are different. If I have to put it in simple terms, if the last year auditor and current year auditor both are different persons, then the current year audit will become initial audit engagement. Next, one more term they are using here, opening balances. So what is the meaning of opening balances? Opening balance refers to those balances which are there at the beginning of the financial year. And these are nothing but, these opening balances are reflected from closing balances of the previous year. And what does this opening balances reflect? They say opening balances will reflect 2 kinds of information. How many kinds of information? Opening balances will reflect 2 kinds of information. It will reflect the effect of transactions which has taken place in the previous year, and it will also reflect the accounting policies which are followed in the previous year. So opening balances will reflect to you 2 information. Number 1, opening balances will reflect the effect of the transactions which have taken place in the previous year, and it is also going to reflect the accounting policies which are followed in the previous year. So like this two informations it is going to reflect. What is going to reflect? Opening balance is going to reflect it. Now you tell me, as an auditor, are you required to obtain audit evidence regarding opening balances? Yes. Why? Because these opening balances, no matter how correctly you account for the current period transactions, if the opening balances itself is going to contain a misstatement, no matter how correctly we account for the current year transactions, the closing balances always will have a material misstatement. If the opening balances contain a material misstatement, no matter how much correctly we account for the current year transactions, even the closing balances also will carry a material misstatement. So that's why we need to obtain audit evidence whether opening balances contain a material misstatement or not. Sir, how can we obtain that audit evidence? By performing some audit procedures. How can we obtain the audit evidence regarding opening balances? By performing audit procedures. So what audit procedures I need to perform to obtain the evidence regarding opening balances? So if you come here, what audit procedures I need to perform regarding opening balances? So they say here, read the most recent financial statements, whatever most recent financial statements are there. Like for example, if you are doing audit of 24-25 financial year, what will be the most recent financial statements? 23-24. So read the most recent financial statements and try to obtain sufficient and appropriate audit evidence whether opening balances contain a material misstatement by performing some procedures. Which procedures? Number one, if prior period closing balances have been correctly brought forward, take the last year's balance sheet and check whether the last year's figures are correctly brought forward into the accounting software. Then determine if opening balances reflect application of appropriate accounting policies. Whatever accounting policies that are reflected in the opening balances, whether they are appropriate or not, you have to check it. And perform one or more of the following procedures, like pursuing the audited prior year financial statements, evaluating whether current year audit procedures provide evidence regarding opening balances. Sometimes you try to perform audit procedures on the current year transactions, that will give you evidence regarding opening balances. Like for example, you are conducting audit of the financial year 24-25, you came to know that in the current year on 10th of April one of the debtor has gone bankrupt. That means if on 10th of April one of the debtor has gone bankrupt, there should have been some provision as on 31st of March 2025. So like this, when you perform audit procedures on the current year transactions, sometimes you get the evidence regarding opening balances. Remain alert to that. And also perform specific audit procedures regarding opening balances, like taking the opening trial balance from the accounting software, taking the last year audited balance sheet, putting them side by side, comparing the balances. So like this specific audit procedures you have to perform. And also nature and extent of audit procedures. How much nature and extent of audit procedures you will perform on opening balances, that depends on various factors. That means, will you perform more audit procedures on opening balances or will you perform less audit procedures on opening balances? That is going to depend on factors. Like which factors? So it depends on accounting policies, it depends on nature of the transactions and items of the financial statements. It also depends on risk of material misstatement. Higher the risk, more will be the audit procedures. It also depends on significance. If opening balances are very huge numbers, then also we spend a lot of time on opening balances. And whether prior period financial statements were audited and if the predecessor auditor was modified. If the last year financial statements have audited and if the last year auditor has given modified opinion, then the risk is very high there. Then we need to spend more time on opening balances. Why? Because the chances are, in order to avoid the in order to manipulate, the management might do that adjustments in the opening balances. So that's why, especially if the previous auditor has conducted the audit and he gave the modified opinion in the last year financial statements, then you have to be very careful. Then they say audit procedures regarding current assets and liabilities. Regarding current assets and liabilities, what procedures you have to perform? Like sometimes some evidence about opening balances may be obtained through current period audit procedures. Like as I have told, sometimes you perform audit procedures on the current year transactions, but that will give you audit evidence regarding opening balances. And especially for inventories, what procedures you have to perform regarding opening balances is observing a current physical inventory count and reconciling to opening inventory. So you should attend the current year's inventory counting and you have to do the reconciliation to the opening balances. And you need to perform audit procedures on the valuation, and also you need to carry out some gross profit ratio calculation and cutoff procedures you have to perform. So especially when it comes to inventories, opening balances, these are procedures you have to perform. And for non-current assets and liabilities, for that opening balances, what procedures you have to perform is by examining accounting records and other information. That is the only thing which you can do, and even if required, you can get the confirmation with third parties as well. So whatever it is, we will perform all the procedures whatever we have read now to obtain audit evidence whether opening balances contain a material misstatement or not. See, once we have performed all the audit procedures whatever we have discussed now, there might be two outcomes possible. there might be two outcomes possible. So outcome number one, opening balances contain a material misstatement. See, outcome number one will be even much other than that. See, if you came to know that opening balances do not contain any material misstatement, if you came to know after performing all the audit procedures, opening balances do not contain any material misstatement, are you required to modify any opinion? Not required. Why? Because if the opening balances do not contain any material misstatement, what is the purpose of modifying the current year opinion? Not required, right? On the other hand, when you performed audit procedures on the opening balances, you got evidence that opening balances contain a material misstatement. You have obtained sufficient and appropriate audit evidence that opening balances contain a material misstatement. So if you have come to know that, if you have obtained evidence that opening balances contain a material misstatement, then you have to give a modified opinion. What kind of modified opinion? Either you have to give a qualified opinion if the effect of that misstatement is only material, or adverse opinion if the effect of the misstatement is material and also pervasive. On the other hand, if the auditor is unable to obtain audit evidence, sometimes what will happen is auditor unable to obtain audit evidence regarding opening balances. Auditor unable to obtain audit evidence. I think I have already written it in the charts here. Yeah. So by performing all the audit procedures, two outcomes could be possible. If the auditor obtains sufficient and appropriate audit evidence that opening balances contain a material misstatement, either give a qualified opinion or adverse opinion. If auditor is unable to obtain sufficient and appropriate audit evidence regarding whether opening balances contain a material misstatement or not, you are unable to perform audit procedures. You are unable to obtain audit evidence whether opening balances contain a material misstatement or not. If that is the case, then you are required to give either a qualified or disclaimer, depending on what is the possible effect of that undetected misstatement. If the possible effect is only material but not pervasive, give qualified. If the possible effect is material and also pervasive, give disclaimer. And see, one more thing the standard will address. When I say opening balances, I told that opening balance will reflect two things. Opening balance will reflect the effect of the transactions which have taken place, and it is also going to reflect accounting policies. See, when I say accounting policies, there is one fundamental accounting assumption associated with accounting policies. What is that? Consistency. So one of the fundamental accounting assumption which is associated with the accounting policies is consistency. So I need to check whether accounting policies are consistently applied in the current financial year. While verifying opening balances, since I will get to know about what accounting policies are followed in the last year, it becomes necessary for me to obtain sufficient and appropriate audit evidence whether accounting policies are consistently applied. Without any valid reason, accounting policy should not be changed. If there is a valid reason because of which you are changing the accounting policy, then there should be a proper disclosure of the change in the accounting policy. So two things. Number one, without any valid reason, accounting policy should not be changed. Number two, if at all there is a valid reason for change in the accounting policy, that change should have been appropriately presented and disclosed and accounted for. Both the things you need to check. If any of that thing is missing, that means without any valid reason, if accounting policies are changed, that means consistency principle is violated. Or there is a valid reason, that's why the accounting policy has been changed, but the management did not give a proper disclosure of the change in accounting policy in the financial statements, then also I will give a modified opinion. So two things they try to say it here. Even if you see here, yeah, audit reporting regarding accounting policies. If the auditor concludes that accounting policies are not consistently applied, that means without any valid reason, accounting policies are changed, or changes in the accounting policy are not appropriately presented or disclosed. So this, when there is no valid reason, without any valid reason, you are changing, or there is a valid reason for change in the accounting policy, but it is not properly presented or disclosed. In any of this case, the auditor shall either express a qualified opinion or adverse opinion, depending on the effect of that accounting policy being material and also pervasive. Clear? And one more last point the standard will say, SA 510, modifications in the predecessor auditor's report. See, last year audit was conducted by the predecessor auditor. He gave the audit report on the last year's financial statements, but the predecessor's auditor report contains a modified opinion. That means if the last year's audit report contains a modified opinion, is there a mandatory obligation on the current year auditor also to give modified opinion? The answer is no. So just because last year's audit report contained a modified opinion, there is no mandatory obligation on the current year auditor also to give a modified opinion. The current year auditor will give modified opinion only because of only when the matter because of which last year auditor gave the modified opinion, if it is not resolved in the current year, if it is relevant for the current year, if it is a material in the current year, then only he will modify. Just because there is a modification, he will not do it. He will also analyze the reasons in the current year. If he feels it relevant, material, and not rectified in the current year, then only he will modify the current year's opinion. Understood? That's all. So this is what regarding SA 510. So SA 510 also we have completed. Now we will talk about SA 530. We will talk about SA 530, which is relating to audit sampling. So this is also one such area, SA 530, where they are asking MCQs. See, they ask descriptive questions mainly from this SA 530 at the CA inter level, but at the CA final level, instead of asking a descriptive question, they are focusing mainly on MCQs when it comes to SA 530. Very simple standard only. If we could pay minimal attention, within a short time we can complete this SA 530 revision. So let us try to understand what does this SA 530 talk about. So as the title, as you could see, audit sampling. So we all are aware that today auditors are not doing 100% verification, and almost 100% verification has become close to impossible. Today the volume of the transactions is very high, and the technology is getting used very rapidly. Organizations are concentrating more on internal controls. So in this today's business environment, still if the auditor says the traditional method of following 100% verification, then audit will not be effective in the today's environment. So today all the auditors, if not all, most of the auditors are conducting their audit by following the sampling methods. Sir, first of all, what do you mean by audit sampling? First of all, what do you mean by audit sampling? So the standard defines the term audit sampling as something like this. Say for example, there is an entire population. Now as an auditor, I am not performing audit procedures on 100% of items on the population. Population means large mass of data. When I talk from the auditing perspective, population means entire items in the financial statements or books of accounts. So there is a huge mass of the population. There are huge volume of entries in the population, but the auditor is not performing audit procedures on 100% of items in the population. What auditor will do is he will select a small sample of transactions, and the auditor will perform audit procedures on that sample. So how they have put that definition in a technical format is application of audit procedures to less than 100% of items on the population. Application of audit procedures to less than 100% of items in the population. When I say less than 100%, it could be 10 also, 5 also, 2 also, 100, 99 also, 98 also, 95 also, whatever it could be. But auditor is not performing audit procedures on 100% of the items on the population. He is performing audit procedures to less than 100% of items on the population. Say for example, he has taken some 10%. So he is performing audit procedures on that 10% of the transactions, and depending on that procedures, he will form conclusion not just on this 10%, he will form the conclusion on the entire population. He is not verifying 100% of the population. He is applying audit procedures to less than 100% of items in the population. But on the basis of that findings, he will form a conclusion on the entire population, not just on the sample from which not just on the sample of the entire population. Like say for example, there is a class of 1,000 students, or let me give an example from the audit terminology only. In one entity, I wanted to verify purchases. Now when I say purchases, there are total 10,000 transactions. A very big company, say for example, it is a trading or wholesaling company, so they have total 10,000 purchase transactions in the year, but I am not in a position to verify 100% of the transaction. So what I have thought is, let me take a sample. I have taken 10% sample, 1,000 transactions have come. So here the population is 10,000, whereas my sample is 1,000. I will perform audit procedures on this 1,000 transactions only. Now by performing audit procedures on these 1,000 transactions, I will have some findings, I will have some observations. Now depending on that findings or observations, I will form a conclusion. I have to arrive at a conclusion. And that conclusion, I will not just form it on the sample, that conclusion I will form it on the entire population. My objective is not to form the conclusion on just a sample. My objective is to form a conclusion on entire population from which the sample has been selected. So that is what the whole objective of the audit sampling. So that's how they have even defined it. Like if you see here, application of audit procedures to less than 100% of items within a relevant population, ensuring that all sampling units will have a chance of selection to provide reasonable basis. Here comes the most important point, to draw the conclusion about the entire population. So my objective is not just to draw conclusion on the sample. My objective is to draw conclusion on the entire population from which the sample has been selected. Now, so the standard says if you want to make use of the sampling, if you want to perform audit procedures on sampling, you need to first select a sample. No, out of the entire population, I have to select a sample. Now, how to select that sample? The standard says to select the sample, we have two broad approaches. To select the sample, we have two broad approaches. So what are the two broad approaches for sampling? We have something called statistical sampling and we have something called non-statistical sampling. We have two broad approaches to the sampling. What are the two broad approaches to sampling? Number one, statistical sampling, and other one is non-statistical sampling. Sir, what is statistical sampling? It has certain characteristics, like in the statistical sampling, there will be a random selection. What there will be a random selection. Sir, what do you mean by random selection? Random selection means every item will have an equal chance of getting selected. There will not be any bias. Every item will have an equal chance of selection. So that method we call it as statistical sampling. And also in the statistical sampling, we are going to make use of the probability theories. This method is going to be little scientific. Why? Because we use mathematical concepts, we use statistical concepts, and mainly we use probability theory. And not just that, here we use mathematical concepts and statistical methods, as I've already told. And this method is very suitable in case of those populations which contain a large number of similar items. And the most important factor here is, in the case of statistical sampling, personal bias will be completely eliminated. Since I am giving equal chance of selection for each and every item, there is no scope for my personal bias here. This method is something I can also call it as objective. Unbiased method is statistical sampling. On the other hand, when I say non-statistical sampling, sir, what is non-statistical sampling? That method of sampling which does not have any of the characteristics of the statistical sampling. That means there will be no random selection. We don't use probability theory. We don't use mathematical concepts. We don't use statistical concepts. Sir, if we are not using any of this, you are telling we don't use mathematical theory, we don't have random selection, we don't have scientific methods, we don't have mathematical concepts, then how come we are going to select the sample, sir? Purely on the basis of the professional judgment. Purely on the basis of professional judgment, if we select the sample, that method of sampling we are going to call it as non-statistical sampling. So that's what they say here. It lacks the features of statistical sampling. Then how come auditor will select it? He will select it purely on the basis of personal experience and knowledge of the auditor. And this method is neither objective nor scientific. Here we are not going to use any science-based concepts, and even this method is not objective. That means it is not going to be an unbiased one. It will always be biased. Why? Because wherever I say I'm using a professional judgment, always there will be a bias. Right. Sir, two methods are there. No, statistical we have, non-statistical we have. Which one will be comparatively better between statistical sampling and non-statistical sampling? Which method of sampling is comparatively better? So if you ask me personally, I will say the method of statistical sampling is somewhat better than when compared with the non-statistical sampling. Why? Because of its characteristics, because of its random selection, because of scientific, because of mathematical theories, it is comparatively better. Does that mean auditor should use only statistical sampling? Should he completely stay away from the non-statistical sampling? Not exactly. It is completely up to auditor's professional judgment. Whether auditor want to make use of statistical sampling or he wants to make use of non-statistical sampling, that is something auditor himself has to decide, and purely on the basis of his professional judgment. He has to use his knowledge, experience and training and accordingly determine whether he will go for statistical sampling or he will go for non-statistical sampling. That is purely his choice. Then comes the next question. Sir, is sampling mandatory? Is sampling mandatory? Is there a mandatory requirement on each and every auditor to compulsorily verify the transactions on sampling basis? The answer is no. There is nothing statutorily stated. There is nowhere it was stated that auditor has to compulsorily go for sampling. It was not written anywhere. Whether auditor will go for 100% verification or he will go for sampling, that is something which auditor himself has to decide using his professional judgment. Auditor himself has to decide using professional judgment, and he will take that decision keeping various factors in mind. Like as you could see here, what factors will be considered while deciding upon extent of checking on a sampling plan, which means whether auditor will do 100% verification or he will go for sampling. That depends on which factors. These are factors he will consider, like he will consider size of the organization under audit, what is the state of the internal controls, whether the books of accounts are adequate and reliable, what is the tolerable error range, and what is the degree of desired level of confidence. So all these factors he will consider, and accordingly he will determine the whether accordingly he will take the decision. Now, what are the factors which are required to be considered while deciding an appropriate sample size? What are the factors which are required to be considered by the auditor while deciding an appropriate sample size? Sir, what do you mean by sample size? First of all, sample size means how many number of items will be there in your sample. Like for example, will your sample size be 10%? Will your sample size be 20%? Or will your sample size be 30%? Or will your sample size be 80%? So that number of items in your population, I am going to call it as sample size. Sorry, number of items in your sample, I am going to call it as sample size. Sir, should I go for bigger sample size or should I go for smaller sample size? It depends on what factors. Should I go for bigger sample size or should I go for smaller sample size? That depends on what factors. That's what this standard addresses. They have told the factors for deciding an appropriate sample size for test of controls separately and for test of details separately. So what are the factors which affect sample size for test of controls, and what are the samples which affect the sample size for test of details? Both they have given here. Let us try to address. So in case of test of controls, first factor, reliance placed by auditor on internal controls. If the auditor wants to rely more on internal controls, more sample sizes he will take. If he wants to rely less on internal controls, less sample size he will take. Yes or no? Why? Because if the auditor has decided to rely more on internal controls, he will verify more number of internal controls or not. So what kind of relationship is there here? Direct relationship is there here. So higher the reliance placed by the auditor on internal controls, more will be the verification. Tolerable rate of deviation. So it also depends on tolerable rate, how much a deviation auditor is willing to tolerate. Here there will be inverse relationship. So tolerable rate of deviation is high. That means auditor is willing to tolerate more. Auditor is willing to accept more risk. He will go for smaller sample sizes. On the other hand, auditor's tolerable deviation is very less. Auditor is not at all willing to tolerate any deviation. Then he has to go for bigger sample size. So here he will have inverse relationship. And it also depends on expected rate of deviation. If the auditor is expecting more deviation, bigger sample size. If the auditor is expecting less deviation, lesser sample size. So here you will have direct relationship. Then it also depends on auditor's desired level of assurance. If the auditor want more level of assurance, more sample size he will take. If the auditor is satisfied with lesser level of assurance, less sample size he will take. It also depends on size of the population, but they will say here size of the population will have a negligible effect. It will not have a major effect. It will have a very negligible effect on the sample size. Now, similarly, if you see the factors which are going to have an impact on the sample size for test of details, here also they have given the factors. It depends on risk of material misstatement. Higher the risk of material misstatement, larger will be the sample size. So that means what relationship is there here? Direct relationship we have. Next, it depends on relying on other substantive audit procedures. Other substantive audit procedures means analytical procedures they are saying here. If the auditor wants to rely more on analytical procedures, he will perform less test of details. If the auditor wants to rely less on analytical procedures, he will try to take bigger samples in the test of details. So it also depends on how much auditor wants to rely on other substantive audit procedures. Greater reliance on other substantive audit procedures, smaller sample size. That means here there will be a inverse relationship. Then it also depends on desired level of assurance. Once again, direct relationship, higher the level of assurance, more will be the sample size. It depends on tolerable misstatement. Here we will have inverse relationship. If the auditor is willing to tolerate more misstatement, less sample size. If the auditor is willing to tolerate less misstatement, more sample size. It depends on expected misstatement. Once again, it is a direct relationship. If the auditor is expecting more misstatement, bigger sample size. If the auditor is expecting less misstatements, lesser or smaller sample sizes. Next, it also depends on stratification. Stratification means what? Bifurcation, different characteristics. That means if you are able to bifurcate the population into subpopulations, that you can know that the sample size will be lower. For example, if the sample is having different characteristics, if you are able to stratify, if you are able to divide that entire population into subpopulations, now from each of the subpopulation you can easily select small samples. So what do they say here is appropriate stratification decreases the sample size. If you are able to bifurcate the data, if you are able to properly segregate the data, their smaller sample size will be required. If you are unable to segregate the data, you need more sample size. And here also size of the population, like they have told for test of controls, here also they are saying that size of the population will have a negligible effect. Both for Both for test of controls and for test of details, the size of the population will have a negligible effect, a very minimal effect on the sample size will be there. Clear? Next, coming to the next point. Sir, how I should perform audit procedures as per SA 530? So we are almost at the verge of completion of SA 530 also. Please pay attention. So performing audit procedures as per SA 530. Sir, how I need to perform audit procedures? So what they say here is the auditor shall perform audit procedures appropriate to the purpose. So for every item you will have a purpose. For every procedure you will have a purpose. So if you are verifying, say for example, if you are verifying bank payments, check payments, your purpose is to verify whether the payments have been authorized or not. So like that, every area of the audit will have a purpose. You should perform that audit procedures which are fit for your purpose. Sometimes what will happen is whatever audit procedures you have thought of, that will not be applicable for the item which has been selected. Like say for example, you wanted to verify checks. You wanted to verify whether all the checks are authorized or not. Check payments have taken place. You wanted to perform audit procedures to make sure that all the checks are authorized or not. There are total 1000 check payments are there. Out of that, you have taken a sample of 100. So you are taking each and every check and you are checking the signature, whether that signature is as per the hierarchy or not. You are checking. Now in that sample of 100, you got one cancelled check. You got one cancelled check. So what do you mean by cancel check? While writing the check, one mistake has happened. So that's why what they have done is they have cancelled it. But that has come into your sample. But whatever procedure you have thought, what is the procedure you have thought? You thought to verify, you wanted to verify the authorization. But in your sample, you got a cancelled check. Now, is the audit procedure, whatever you thought of, is it applicable for this cancelled check? No, that procedure is not applicable for that cancelled check. Then what the standard says is, if in your sample a item comes on which you are unable, on which the procedure which you have thought is not applicable, then what you should do is you should drop this item from the sample. You should take a replacement item. Since you can't apply the audit procedures on this item, you drop this from your sample, take a replacement item, take some another check into the sample, and on that you perform audit procedure. Able to understand? So that's what they say here. If the audit procedure is not applicable to the selected item, the auditor shall perform the procedure on a replacement item. If the auditor cannot apply designed or alternative audit procedures, sometimes what will happen is the audit procedure will be applicable. Whatever audit procedure is there, that will be applicable. But you are unable to perform that audit procedure. You are unable to perform that audit procedure. Like if you see here, if the auditor cannot apply designed or alternative audit procedures to a selected item, then it must be treated as a deviation. In the case of test of controls or in the case of test of details, it has to be considered as a misstatement. So if the procedure itself is not applicable, it is a genuine case. We will drop the item, take the replacement item. But the procedure is applicable, but you are unable to perform. Like for example, you wanted to verify the sales. You are verifying the sales. For sales, you wanted to verify whether that sale is genuine or not. So you thought that there are total 10,000 sale transactions are there. You have taken 500 sample. For each and every sale entry, you want to check the supporting documents. For each and every entry, you have to check the supporting documents. Now, while verifying, in that one such sale entry has come. You wanted to verify supporting documents, but the management is saying for that one sale entry, all the supporting documents are lost. All the supporting documents are destroyed. See, whatever audit procedure you have thought, that is applicable for the given item, but you are unable to perform. Why? Because management is saying that all the items are destroyed, all the supporting documents are destroyed. Then you have to consider this as a misstatement. If it is a test of detail, you will consider it as a misstatement. If it is a test of control, you will consider it as a deviation. Understood? Next. Then projection of the misstatement. Sir, what do you mean by projection of the misstatement? See, by performing audit procedures, I will tell you one example. Say for example, you have a total 10,000 transaction. You have a total of 10,000 transactions of purchases. From that total 10,000 transactions of population, you have selected 1,000 transactions of sample. Okay. Now on the sample, you will perform audit procedures. By performing that audit procedures, you will find some observations. Say for example, by performing the audit procedures on the 1,000 transactions, you found out some 10 misstatements. So some 10,000 worth of misstatement you have found it out. Now, this is a misstatement which you find it out by way of performing audit procedures on the sample. But out of 10,000 transactions, by verifying 1,000, you got to know 10,000 worth of misstatement, but you did not verify remaining 9,000 transactions. No. So now what you should do is you have to analyze it. If on 1,000 transactions, I am able to find a 10,000 amount of misstatement, how much misstatement could be there in the entire population. If in my sample itself I'm able to find this much amount of misstatement, how much misstatement could be there in my entire population? So that assessment, that process, we call it as projection. I hope you guys are able to understand. So if in my sample I'm able to find out these many misstatements, how many misstatements could be there in my entire population, that estimation I have to do, that process I call it as projection. That process I'm going to call it as what? Projection. So that is what they say. The auditor must project the misstatements to the population to assess the scale of misstatement. And sometimes what will happen is, say for example, I have verified the 1000 sample, and in that I found 10 misstatements. Before making the projection, what you should do is, you should identify, you should divide out of the misstatements you have identified, how much is an anomalous misstatement, how much is a non-anomalous misstatement. So let me put it this way. Total 1000 sample I have verified. Out of that 1000 sample, 10 misstatements I have identified. The total value of all that misstatements is 10,000. But before doing projection, what the standard will ask you to do is, whatever misstatements that you have identified, divide that into two categories: anomalous misstatement, non-anomalous misstatement. Sir, what do you mean by anomaly? Something which is exceptional, something which is non-repetitive in nature. Say for example, out of 10 misstatements, one is anomalous, one of a kind. This misstatement will not happen again and again. This is non-representative. Remaining 9 are non-anomalous. Remaining 9 are non-anomalous. That means they have a repetitive nature. So out of these 10 misstatements, one misstatement is anomalous, whose value is 2000 rupees, and the remaining 9 misstatements are non-anomalous, whose value is 8000 rupees. Now you tell me for which value I have to do the projection. Should I do the projection for the entire 10,000? Or should I do the projection for anomalous misstatement of 2000? Or should I do the projection for non-anomalous misstatement of 8000? I should do the projection of only non-anomalous misstatement. Why? Because when I say something as anomaly, which is non-representative, non-repetitive in nature, so there is no purpose of doing that projection. It will not happen again and again. So you have to do the projection only for anomalous misstatement. That means if in my sample I am able to find 8000 worth of non-anomalous misstatement, how much misstatement could be there in my entire population? Projection I have to do only for 8000, not for the 2000. Understood? So this is what regarding projection. And last concept here, evaluation of the sample results. Now you will perform audit procedures on the sample. By performing that audit procedures, you will have the sample results. That results you need to analyze, that results you have to evaluate. So the auditor shall evaluate results of the sample, and you should assess whether audit sampling has provided a reasonable basis for your conclusions. Has the sampling has provided you reasonable basis for your conclusion or not? That evaluation, that analysis, finally you have to do. So this is what the discussion regarding SA 530. So we have completed SA 530 also. Now next thing what we will do is, we will take up SA 540. Important standard. From here descriptive questions will come. From SA 540 descriptive questions will come. Mainly descriptive questions only will come. Standards on audit. Where is the standards on audit? Yes. Fine. So important standard, guys. This is not something which will be there at your CA inter level also. This is something which you have to learn it at the CA final level only. SA 540. This standard will be completely new for you. And as I have told, this is a standard where descriptive questions will come. Not MCQ, descriptive question will come here. Compulsory question will come. So let us try to have a quick revision of this. Okay. So what does SA 540 talk about? So SA 540 is going to talk about auditing accounting estimates, including fair value accounting estimates and related disclosures. That means this is the standard which is going to talk completely about accounting estimates. And I have this summary kind of thing also for you. So what exactly is the standard talking about? The whole subject matter of this standard is auditing accounting estimates. This standard is going to completely give the guidance as an auditor how we can obtain audit evidence regarding accounting estimates. See, we all are aware in the process of preparation of the financial statements, generally management will prepare financial statements, and in the process of preparation of financial statements, there will be various areas in the items of the financial statements where management can't measure those items with accuracy. There they need to take the help of estimates and assumptions. There will be various areas in the financial statements where management will be required to make assumptions, where they have to take the subjective decisions, without which preparation of financial statements will not be possible. Without which financial statements will not be possible. So, like for example, depreciation, it's purely an estimate. Provision for bad and doubtful debts, estimate. Valuation of shares, estimates. So, like that, there will be various aspects in the items of the financial statements where management cannot measure with accuracy. They have to compulsorily make use of assumptions and estimates. And without making use of that assumptions and estimates, preparation of financial statements is completely impossible. But if you pay close attention here, whenever we are saying that the management for the purpose of calculation, they are using estimate and assumption, obviously in that area, risk is very high. Obviously in those areas, the chances of happening of misstatements are much higher. Why? Because if you can measure something with accuracy, we can determine whether it is correct or not. But when the management has determined a figure purely on the basis of estimate and assumption, they can change their assumptions and estimates to get the desired outcome. So that's why wherever you find the accounting estimates, that is a very risky area. So that's why even the standards on auditing have also felt that in this area we need to give a specific guidance for the auditor. So that's why they have given this SA 540. Now, first of all, what is this standard dealing about? What is the objective of the standard? For what purpose the standard has been given? So this standard will help the auditor to obtain sufficient and appropriate audit evidence. The standard will help the auditor to obtain sufficient and appropriate audit evidence regarding what? Regarding whether accounting estimates are reasonable or not. See, we are not supposed to obtain evidence whether accounting estimates are correct. No one will expect that from us. We can't comment on the correctness of the accounting estimates. We can only comment whether accounting estimates are reasonable or not, whether accounting estimates are acceptable or not. That we need to obtain evidence. And also, whatever disclosures are required as per applicable financial reporting framework, whether all that disclosures are given or not. These two matters I need to obtain evidence. This is where SA 540 is going to help me out. So tell me, what are the two matters where SA 540 is going to help me out? Number one, to obtain sufficient and appropriate audit evidence regarding whether accounting estimates are reasonable. Number two, whether the disclosures regarding the accounting estimates as per the requirements of applicable financial reporting framework are given or not. So these are the two areas regarding which I need to obtain evidence. But first of all, what is a definition of accounting estimate? What is a definition of accounting estimate? They say that accounting estimate means it is an approximation. We can't measure something with accuracy. There we do what? Approximation of a monetary amount in the absence of a precise means of measurement. Something you can't calculate precisely. That's why in those areas you are going to make an approximation. That I call it as estimate. And these accounting estimates can be divided into two categories. Those accounting estimates which involve fair values and other accounting estimates. There are some accounting estimates which require fair value adjustments, whereas there are some accounting estimates which does not require any fair value adjustments. Like for example, if I have to give you a scenario, take I have to value the shares. I am conducting audit of some company. That company is holding the shares in another company. As on the balance sheet date, they have to determine what is the value of the share. Now they need to determine the value on the basis of fair value. That means if these shares are sold in the market as on that balance sheet date, how much price it will be able to fetch, that they have to determine, and at that value they have to value the shares. This is an accounting estimate where fair value adjustments are involved. So like that, we can divide accounting estimates into two categories. Those accounting estimates which are involving fair value accounting estimates and other accounting estimates. So if I give you examples of those accounting estimates which involve fair value adjustments are like this, like complex financial instruments which are not traded in an active and open market. Your client has invested in the shares of the company, that to an unlisted company. If you have to do the valuation, you have to determine the fair value. Or share based payments like ESOPs, employee stock option plans and all, and sweat equity shares. So these are the transactions which involve the fair value adjustments. Or property or equipment held for sale. Your client has kept some property for sale. Now you have to do the valuation. How that value will be determined? On the basis of fair value. Or certain assets or liabilities acquired in a business combination like goodwill and intangible assets, brand value, goodwill value. This is also something which will be determined on the basis of fair value. And transactions involving exchange of assets or liabilities between independent parties. That means barter transactions. In the case of barter transactions also, at which value you will recognize? Once again, you have to determine the fair value. So these are the examples of the accounting estimates which involve fair value. So then what are the accounting estimates which does not involve any fair value? Like for example, if you have to create a provision for debtors, if you have to create a provision for debtors, that does not involve any fair value. Out of the debtor, how much the debtor will not be able to repay, that we will determine and create a provision. Is there any fair value adjustments here? No. Inventory obsolescence, how much of your inventory has been damaged, you have to create a provision for inventory obsolescence. No fair value, nothing. Warranty obligations, you have to create a provision for the warranty obligations. No fair value adjustments. Depreciation, in the depreciation also there is no fair value accounting adjustments. And also provision against carrying amount of the investments where there is an uncertainty regarding its recoverability. Like for example, you have invested in the debentures, but there is a doubt regarding its recoverability. Now you have to create a provision for debentures. There also you will not use any fair value adjustments. Or outcome of long-term contracts or even financial obligations or costs arising from litigations and settlements. So these are the examples of accounting estimates which involve no fair value adjustments. So like this, we can broadly divide accounting estimates into two categories. Now comes the next definition, which is very, very important from the standard, which is estimation uncertainty. Sir, what is estimation uncertainty? The chance that accounting estimate can be wrong. That chance will always be there or not. See, I am using accounting estimate because I don't have precise means of calculation. That's why I have made an assumption. But whenever I have calculated something using an assumption, that assumption can always go wrong in the future. No, that is inherent. No, that is inbuilt. When I am making assumption, that risk is always there. That assumption can go wrong. So that in technical terminology, we call it as estimation uncertainty. So like if you see here, the susceptibility of an accounting estimate and related disclosure to an inherent lack of precision. The chance that there is no precision, there is no exact measurement of that accounting estimate. That means there is a chance that this accounting estimate can be wrong in the future. Say for example, there is one debtor amounting to 100 crore rupees. I created provision for 30 crores. I felt that this debtor will not be able to repay me 30 crores. That's why I created a provision. But the next year, he did not repay me 40 crore rupees. I felt 30 crores will not be recoverable. But actually 40 crores is not recoverable. My estimate has gone wrong. It is always built in the accounting estimate, that we call it as estimation uncertainty. Now, degree of estimation uncertainty. See, you tell me estimation uncertainty, if it is high, there will be high risk or low risk. If the estimation uncertainty is very high, that means if the chance of accounting estimate going wrong is very high, that areas are highly risky. On the other hand, if the estimation uncertainty is low, then it will be less risky. So there will be some items which have high estimation uncertainty. There will be some items which will have low estimation uncertainty. See, what do you mean by high estimation uncertainty? There will be some accounting estimates where the chances of actual results will be very different from the estimates. That is high estimation uncertainty. On the other hand, there will be some accounting estimates where the actual results also will be close to the estimate. There I will say low estimation uncertainty. Like if I show you some examples here, what are the accounting estimates which involve high estimation uncertainty, where the chances of your actual results and the estimate will be very wrong. The chances of your estimate going wrong are very high. What are they? Number one, examples they are saying. Accounting estimates relating to outcome of a litigation. For litigation, we create a provision or contingent liability. But actual outcome of the litigation could be very, very different. It all depends on the court proceedings. So litigations carry a high estimation uncertainty. Similarly, fair value accounting estimates for derivative financial instruments which are not publicly traded. If you are doing the valuation of investments, that too which are not publicly traded, there also estimation uncertainty is very high. Fair value accounting estimates for which a highly specialized entity developed model is used, there are assumptions or inputs that cannot be observed in the marketplace. That means you are doing the fair value calculation completely on entity model. That model will be applicable only for you. It will not be applicable for anybody else. Then also there is a high estimation uncertainty. Similarly, they have given examples of those accounting estimates where there will be low estimation uncertainty. What are the examples? Number one, accounting estimates in entity that engage in business activities that are not complex, very simple business, like a trading entity. They buy the goods, they sell the goods to the retailers. Simple business, simple provisions there. So here the estimation certainty will be very less. Why? Because whatever provision you have created, that will actually turn into reality. And accounting estimates that are frequently made, there will be some estimates which are very frequently made, like rent expense provision you will create. Every month we will do it. So there also the estimation uncertainty will be very low. Or accounting estimates derived from data that is readily available. Like for example, you are calculating the shares, but those shares are publicly traded, that those are listed in the market. So on a ready-made data, you are calculating from the stock market, you are picking the prices and doing the valuation. So their estimation uncertainty will be low. Why? Because you are taking the publicly available data. Or fair value accounting estimates, where the method of measurement prescribed by the applicable financial reporting is simple and easily applied. So that means if you come here, if the model is very complex entity developed, then estimation uncertainty will be very high. On the other hand, the method of valuation has been suggested in the applicable financial reporting framework only, and the method is very simple, then estimation uncertainty will be low. Next one, fair value accounting estimates, where the model used to measure the accounting estimate is well known or generally accepted. Not an entity specific model, it is a well known model. There also estimation uncertainty will be low. And also, if I ask you one question, between fair value accounting estimates and other accounting estimates, where estimation uncertainty will be little higher, the estimation uncertainty will be little higher in the case of fair value accounting estimates than when compared with other than fair value accounting estimates. But that doesn't mean all fair value estimates will have high estimation uncertainty. So like they say here, not all financial statement items requiring measurement at fair value involve estimation uncertainty. See, generally, as a common statement, if I have to pass, between fair value estimates and other estimates, where the estimation uncertainty will be high, generally fair value. But it is not a thumb rule that always every fair value estimate will have a high estimation uncertainty. No, there will be some fair value estimates where estimation uncertainty will be low. Like for example, I have to give you, the company is holding the shares and these shares are listed in the stock market. Now for doing the valuation of these shares also, we take fair value, but these fair value will pick from the stock market. Yes or no? So this is a fair value estimate, but the estimation uncertainty is low. Right? So that is what they try to explain here. Not all financial statement items requiring measurement at fair value involve estimation uncertainty. So ultimately, if I have to give one conclusion, sir, whether estimation uncertainty will be high or estimation uncertainty will be low, that is depending on what factors, sir. If I have to summarize it here, I can summarize into 3 factors. So degree of estimation uncertainty varies based on nature of the accounting estimate. What is the nature of accounting estimate? Is it fair value, other than fair value? Or the extent to which there is a generally accepted method. Is the method is generally accepted or not generally accepted? Or it also depends on subjectivity. Higher the subjectivity, higher will be the estimation uncertainty. So I can call this heading as factors. What are the factors which will affect the degree of estimation uncertainty? And these are examples. Accounting estimates with low estimation uncertainty example, accounting estimates with high estimation uncertainty example. Clear? So what we have revised in the standard till now, we have revised objective, we have understood definition of accounting estimate, different types of accounting estimate. We understood what is estimation uncertainty, and we have understood what are the transactions which involve high estimation uncertainty, what are the transactions which involve low estimation uncertainty. Then there is something called management bias. If you come to the next point, there is something they are trying to say, management bias. Which means, see, generally, whenever management is making an estimate, whenever management is doing a calculation, say for example, they are required to create a provision for bad and doubtful debts. Whenever they are creating a provision, they should do an unbiased provision. That means whatever exact provision is required, that much only they have to create. They should not do under provisioning, they should not do over provisioning. But sometimes there might be bias. That bias might be intentional or unintentional. What do you mean by bias? First of all, say, take the example of provision for bad and doubtful debts only. Say for example, 20% provision is enough, but the management has created 30% provision. It might be intentional or unintentional. See, unintentional means by mistake they might have done wrong assessment and they have created 30% provision. But sometimes management will do it intentionally. They want to underreport the profits. That's why they are creating a higher provision. This is clearly a intentional management bias. So you tell me, is the intentional management bias correct or incorrect? It is incorrect. There the risk is very high or low? Risk is very high. You have to be very careful or less careful? You have to be very careful. So that's what they have. That's what we have one paragraph regarding this. So if you see here, management bias. What do you mean by management bias? Lack of neutrality by the management in the preparation and presentation of information. That means management is not behaving in a neutral manner. They are showing partiality. They'll have lack of neutrality. That we call it as management biases. So if you see here, management bias in accounting estimate. See, all the financial reporting frameworks, every financial reporting framework will call for neutrality. All the standards will say management has to take neutral decisions. But since accounting estimates are imprecise, they can be influenced by management judgment. Since you don't have precise means of calculation, since they are purely assumption based, it is completely depending on management judgment. And these bias can be intentional or unintentional. If they are unintentional, okay. If they are intentional, very much problematic. Higher the subjectivity, higher will be the bias. More subjectivity is involved in the estimate, more will be the bias. And also for continuing audits, for example, if last year also you have only done the audit, last year if you got to know about any bias in the management decisions, in the current year also you have to be very much careful about it. Then management bias can be difficult to detect at an account level. See, at individual level, you can't identify the management bias. Why? Because, say for example, if the management want to show a biased decision, they will not do the bias only in one accounting estimate. They will spread across it. Like for example, if the management wants to decrease their profits for tax reasons, they will not do all the adjustments only in provision for bad and doubtful debts. They will do the wrong adjustments. They will do the wrong accounting estimates even in the inventory valuation. They will do wrong accounting estimates in creating provision for expenses. So at the account level, it is very much difficult to detect, but at the overall level, somewhere it will get reflected. So where there is an intention to mislead, management bias is fraudulent in nature. As I have told, if the management is doing wrong accounting estimates to mislead, that is definitely fraudulent in nature. Next one. Measurement objective. This I will try to summarize it, what they try to say here. See, whenever you are calculating any accounting estimate, that accounting estimate can have two measurement objectives. In some kind of accounting estimates, there the measurement objective will be to estimate the future. If you take some accounting estimates objective will be to measure the future. Whereas on the other hand, some accounting estimates, we do not measure anything relating to future, we measure only current transactions. Like for example, if you take warranty provisions, an entity is required to create a warranty provision. If the management is calculating the provision for warranty, what is their measurement objective? They are measuring the future. In the coming 1 year, how many people will claim their warranties? They will estimate the future and create a provision. So for some accounting estimates, the measurement objective will be future oriented. Whereas if you take the example of valuation of shares, if the company is valuing the shares, valuing the investments, there they are not estimating anything about the future. There they are just calculating on the basis of present data. So like that, for some estimates, the measurement objective will be future. For some estimates, the measurement objective will be current data only. So that's what they say here. If I highlight the important points here. So for some accounting estimates, measurement objective is to forecast the outcome. That means to predict the future. Whereas for other accounting estimates, the measurement objective is expressed in terms of value of current transactions. So for some accounting estimates, we do the forecast. For some accounting estimates, we use the current data only. Next. So, okay, now what is the auditor's responsibility? So we understood about all the accounting estimates now, but we did not speak about the auditor's responsibility. So what is auditor's responsibility regarding accounting estimates? So first you need to perform risk assessment procedures. So we can divide the audit procedures into two categories. First, we have to identify and assess the risk of material misstatement regarding, we need to identify the risk of material misstatement regarding this accounting estimates. Sir, how can we identify the risk of material misstatement? That's what they try to elaborate it here. So first thing, when you are performing risk assessment procedures, at the beginning, when you are trying to understand the entity, environment and its internal control, at that point of time, you need to even try to identify, is there any risk of material misstatement for the accounting estimates? At the beginning, when we try to understand the entity, environment and its internal control, even we need to evaluate, even we need to find out the risk of material misstatement resulting from accounting estimates. Sir, but how can I get to know about that risk of material misstatement? First one, you need to understand what are the requirements of applicable financial reporting framework. That means you need to understand accounting standards, Ind AS, and what they are saying about accounting estimates. First, you have to understand the requirements of applicable financial reporting framework. Then you need to understand how management identifies those transactions or events and conditions that may give rise to the need for accounting estimate. So you should go and inquire the management, sir, you are the responsibility. Why? Because see, before auditor, management is having the responsibility to make accounting estimates. So you have to go to the management and inquire them, sir, what process you follow to identify all those transactions which require you to make the accounting estimates. Yes or no? It is a responsibility of the management to identify all those circumstances which require accounting estimates or not. So go and ask the management directly, sir, what procedures you are following, what methods you are following to identify all that events and circumstances which require accounting estimates. Sir, how will I do that? How will I do that? See, here they have given. This is an extension. So obtaining an understanding of how management identifies the need for accounting estimates. So what exactly you will try to understand here? So as you could see here, first point, the management itself is having the responsibility to identify all those transactions or events that give rise to risk of material misstatement, and they are also responsible for making that accounting estimate and disclosing that accounting estimate. So before the auditor, management will have the responsibility to create accounting estimates. For that, first they need to identify which transactions or events require accounting estimates. Once they have identified, then they have the responsibility to make the accounting estimate. Right. So in order to know how the management is identifying, you have to inquire them. Sir, what I have to inquire? So I have to inquire the management whether they have engaged in new type of transactions which give rise to new accounting estimates. Or I should ask them for the existing accounting estimates whether the terms have changed. Whether any new transactions they have entered that will give rise to new accounting estimates. Or for the existing accounting estimates only, terms have changed, that I need to understand. And also what accounting policies they are following regarding accounting estimates, and what procedures they have followed in the previous year. The same accounting policies are also followed in the current year or not, or have they undergone any change, that I have to go and inquire them. And even I need to understand regulatory or other changes. Is there any change in the law and regulation which have an impact on accounting estimates, that I have to inquire. And even I have to go and inquire with them new events or conditions that give rise to the accounting estimates. So whatever it is, at the time of performing risk assessment procedures, first you need to understand the requirements of applicable financial reporting framework. Number two, you need to understand how the management is identifying those events or transactions which give rise to the risk of material misstatement, and what exactly you have to do for that. You have to do the inquiry, and what you have to inquire, that also I have told you. Now coming to the third step, in obtaining this understanding, the auditor shall make inquiries of the management about changes in the circumstances that may give rise to new or the need to revise the existing misstatement. This is just an extension of this point only. Then the ultimate decision in forming an opinion, much care has to be taken in this regard. See, since accounting estimates have a lot of impact on our opinion, so you have to take so much of care while obtaining audit evidence regarding accounting estimates. Okay, next. See, you have understood how the management will identify the events which require accounting estimate. How to understand it, that we have seen it here. Now once the management has identified all those events which require accounting estimates, now they will create that accounting estimate. You need to understand how the management is making that accounting estimates. Once they have identified all the events which require accounting estimates, now they have to create accounting estimates, no? So you should also understand how the management is creating that accounting estimate. So basically what I need to understand is, I need to understand what method is used by the management, or what model is used by the management in creating accounting estimates, and what kind of internal controls they have in the area of that accounting estimates. Whether management has taken the help of the expert, like when it comes to employee benefit accounting estimates like gratuity provision, salary gratuity provision, leave encashment provision and all, there the management will generally take the help of actuary. In case of accounting estimates relating to litigations and claims, their management will take the help of the expert lawyer. So try to evaluate whether management has used an expert and what assumptions the management has made in making that accounting estimate. Whether there has been or ought to have been a change from the prior period, what method they have used in the last year, in the current year, what method they are using, whether both are same or have they undergone any changes. And if so, if any change has undergone, how the management has assessed the effect of estimation uncertainty. If they have changed the method from the last year, how it is going to have an impact on the estimation uncertainty. So like this, once you have understood how the management has identified the events, then you need to understand how they have made the estimates. And wherever you feel that accounting estimates are leading to significant risk, that means wherever estimation uncertainty is high, that will be a significant risk. In that area specifically, you have to evaluate how management has considered alternative assumptions. So wherever estimation uncertainty is high, that will be a significant risk. There you have to pay more attention. There you have to perform specific procedures like what and all assumptions management have considered. See, when I say assumptions, multiple assumptions you can make. Why the management has stuck to this, has restricted to this assumption? What about alternative assumption? Why they have ignored alternative assumption and have stick to this assumption only? So try to evaluate alternative assumptions and whether significant assumptions used by the management are reasonable. You have to evaluate whether assumptions used by the management are reasonable and management's intent to carry out specific course of action. They have made assumption, but is the assumption realistic? Can they carry out that assumption? That also you have to evaluate. And also the auditor should develop a range within which to evaluate the reasonableness of accounting estimate. So even as an auditor, what you can do is, depending on your understanding, on your knowledge, you can develop a range that we generally call it as audit range audit range estimate, we call it. So what auditor will do is, he's evaluating provision for bad and doubtful debts. He will evaluate the industry, terms of the conditions, debtors, repaying capabilities and all. So everything he will consider, and accordingly what he will do is, after considering all the factors, he decided that okay, here the provisions could be somewhere around 10 lakhs to 20 lakh rupees. Now he will see whether actual provision is falling within that range or not. So like this, wherever estimation uncertainty is high, there you need to specifically do these steps. And finally, you have to evaluate reasonableness of the accounting estimates and determine whether accounting estimates contain any misstatements. So like this, these are all risk assessment procedures. Basically, if you ask me, all these are forming part of risk assessment procedures. Now, once you have identified the risk, whatever risk you have identified, to that you have to respond. You have to respond to the assessed risk of material misstatement by performing further audit procedures. So what further audit procedures you have to perform? Here they will try to say the list here. So the auditor shall undertake one or more of the following, taking into account the nature of the accounting estimates. So what and all he should do? Number one, he should evaluate, determine whether events occurring up to the date of the auditor's report provide sufficient evidence. So management might have created a provision as on the balance sheet date. After the balance sheet date, you are doing audit. So during the process of your audit, some advancement might have taken place regarding that accounting estimate. So try to obtain that information. And also test check the data, whatever data management has used for creating accounting estimate, test check it. Evaluate whether method used for management is appropriate. Whatever method management has used, that is appropriate or not, you have to check. Next, testing the extent to which data on which accounting estimate is based is accurate, complete and relevant. Whatever data management is using for evaluating for calculating accounting estimates, is it accurate, is it complete, is it relevant? And also source relevance and reliability of external data in case if they are using it. And also if possible, try to recalculate. You also try to do the calculation of accounting estimate once again, compare it with the management's calculation, and even test check the effectiveness of the controls. Whatever controls they are having in the area of that particular estimates, try to check the internal controls also. And along with all that, you need to even obtain written representation from the management. So regarding what I need to obtain written representation, whether they believe significant assumptions used in accounting estimate are reasonable or not, ask the management to even share the written representation also. And finally, reporting. You need to consider your reporting requirements. So as an auditor, you need to obtain sufficient and appropriate evidence whether all disclosures are required to be given as per applicable financial reporting framework have been given or not. Generally, what disclosures are required to be given by the management regarding accounting estimates is like what assumptions they have used, what method they have used, what is the basis for selection of the estimation, is there any change when compared with the last year, and the sources and implication of estimation uncertainty. Generally, these things are required to be disclosed by the management. I will check whether all these disclosures are given or not. And not just that, you need to include in your audit documentation. So you need to maintain proper audit documentation. In your documentation, you have to include the basis for auditor's conclusion, on what basis you have arrived at a conclusion regarding reasonableness of accounting estimates. And if you find any indicators of management bias, we have seen about management bias, no? So if you find any management bias, that things also you are required to document in your audit documentation. Clear everyone? So this is what regarding SA 540, very important for descriptive. So we have to intentionally little more time. Why? Because this standard is very difficult in learning, but if you understand the flow of the standard, it becomes easy for us to remember it. So this is what regarding SA 540. Okay guys, let us resume our discussion. So we have completed till SA 540. Now we have 4 more standards to cover from SA 500 series, which is 550, 560, 570 and 580. Once again, simple standards, easy standards. We can try to cover it in no time. So first we will try to complete 550, 560, 570, 580. Once we have successfully completed this, then we will proceed further and complete the 200 series. Okay, right. So let us now try to understand SA 550, which is talking about the related party transactions. From here itself, we will try to, from the chart itself, we will try to have a quick overlook. Once again, 550 important for the MCQs. So let us try to have a quick understanding of 550, which is relating to related party transactions. See guys, as we all are aware, wherever there is a related party, there is a risk actually. Why? Because you can't influence the independent party, but if someone is related with you, there is a huge scope for manipulation. So that's why wherever related party transactions are there, under Companies Act also we have so many disclosure requirements. We have dedicated accounting standards and Ind AS talking about related party transactions, and there are so many disclosure requirements given under applicable financial reporting for the related party transaction, because that is such a risky area. So even the ICA has thought that since they carry high risky area, we need to give guidance for our chartered accountants to do audit of that related party transaction. With that intention, the standard has been given. So very simply, I will try to cover it. Not that significant from the important, not that important from the examination perspective. Just 1 or 2 MCQs, if at all they come, they might come. So, and also very frequently they will not come. So I will try to just give a overview of the standard and will proceed further. So related party transactions. First of all, who is related party? As per the standard. See, at all respective places we have given definition. Under Companies Act we have a definition for related party. Under standards we have a definition of related party. So even SA 550 also has played it safe. They told that if just a minute, just 1 minute. See, I think streaming and all is perfectly fine. Okay, and just give me 1 minute. There is so many users on my network, so there might be some streaming issue. Okay, yeah. So related party. So here SA 550 has also played it safe. They told that if the applicable financial reporting framework, if in the applicable financial reporting framework, the term related party has already been defined, follow that definition. If in the applicable financial reporting framework, the term related party is already defined, follow that definition. In case the definition given in the applicable financial reporting framework is incomplete, or the applicable financial reporting framework does not define the term related party, then this standard has given one definition, then follow that definition. So here SA 550 has told one simple thing: if the applicable financial reporting framework has already defined the term related party, follow that definition only. In case if the applicable financial reporting framework did not define the term related party, or they have defined it but it is an incomplete definition, then in SA 550 they have given one definition, we have to follow it. So what is the definition given? So two persons will be considered related if one of them, if a person is having a significant control or influence over other. So if one is controlling the other, then both will be considered as related. Or another entity over which reporting entity has control. Either you are controlling someone or someone is controlling you. Either you are having influence on someone or someone is having influence on you. So that you both will be considered as related. Or another entity that is under common control with the reporting entity, either through common ownership, owners who are close family members, or common key management. Say for example, there is a company X Limited. There is another company Y Limited. Now both the companies X Limited and Y Limited are under common control. Sir, how that common control has been arrived at? This common control could have been arrived by way of common ownership. Same group of people are holding the ownership in both the companies, or both the owners of both the companies are belonging to same family, or even they both are under the common key management. Then also you both will be considered as related. So one is having the control other, or someone is having control over you, or both are under common control, then we will call you as related person. And you have to follow this definition only when the definition given in applicable financial reporting is incomplete or not given. And they have given one note point here: entities which are under common control of a state. Basically, if two entities are there under common control of the government, they will not be considered as related unless they share significant transactions or they share the resources. Then, sir, what is the nature of related party transaction? See, generally, if the related party transactions are also happening in the normal course of business, and if the related party transactions are also happening at arm's length price, then we need not worry about it. They might not carry a high risk of material misstatement. So when related party relationships might not carry a high risk of material misstatement if the related party transactions are in the normal course of business, and if they are happening at arm's length price, we need not worry about it. But in some cases, in particularly some circumstances, the risk of material misstatement is very high for related party transactions. In which circumstances, sir? Number one, when related party transactions are operating through complex relationship. There is no direct subsidiary holding relationship. It is a very complex chain of relationship. They have created shell companies and all. There the risk is very high. And also, whatever information system the client is using, that is ineffective information system. Their accounting software is ineffective. Then also risk is very high. Or related party transactions are not conducted under normal market terms and conditions. That means they are conducted under unfair terms and conditions. In these circumstances, risk is higher. Okay, so since we got to know in some circumstances the risk is very high due to related party transactions, now what are your responsibilities as an auditor? As an auditor, what will be your responsibilities? So as an auditor, you need to obtain audit evidence regarding what? Whatever accounting requirements of the related party transactions are there, whatever disclosure requirements of the related party transactions are there as given in the applicable financial reporting framework, whether that accounting and disclosure requirements have been properly given or not, whether related party transactions are properly accounted or not. If I put it into simple terms, whether applicable financial reporting framework has been met or not, I need to obtain evidence. Sir, how can I get that evidence? Very simple. First, you should understand. As an auditor, before you can verify, first you should understand, first you should know what are those accounting and disclosure requirements under applicable financial reporting framework. Then you need to obtain understanding of related party relationships. Then you need to understand which of the related parties your client is having, with that related parties what transactions have been entered into, and also to conclude finally whether financial statements give a true and fair view. So this is how you need to obtain audit evidence: by understanding accounting and disclosure requirements, by understanding related party relationships and transactions, and finally arriving at a conclusion whether financial statements give a true and fair view or are they misleading because of related party transactions. And especially when it comes to related party transactions, there are fraud risk factors also. Why? Because of fraud can be easily committed through related party transactions. You have to be pretty cautious about it. And the inherent limitations also will be very much higher in the case of related party transactions. That means the chances of audit's opinion going wrong because of related party transactions is very much higher. Why? Because sometimes management themselves will be unaware. Management themselves will not know who is the related party, who is not the related party. And also related party transactions provide greater opportunity for collusion. So that's why there is always a higher chances of inherent limitations. The impact of inherent limitations is much higher because of related party relationships. So these are your responsibilities. And one more thing, last thing, you have to maintain the professional skepticism. So as an auditor, what are your responsibilities regarding related party transaction? Number one, you need to obtain evidence regarding accounting and disclosure requirements. You have to be careful to the fraud risk factors. Number three, inherent limitations are much greater for related party transactions. Be careful about it. If you want to overcome all this, maintain professional skepticism. And how auditor can verify existence of related party transactions? What and all you can do to verify the related party transactions? So you can inspect the following documents. So what documents you can inspect? You can verify income tax returns. You can verify information submitted to regulatory authorities like SEBI and all. And you can verify shareholder register. You can check the statements of conflict. You can check life insurance policies which are acquired by your client company. You can check the investment register. You can read the contracts and agreements with the key management, and even contracts which are not in ordinary course of business. Mainly they will happen with related parties only. You have to be careful about it. And even you can go through the internal audit reports. Clear? That's all. This much is enough for SA 550. Now we will come to the two important standards, SA 560 and 570, important for descriptive as well as MCQs. So we'll try to spend some time here. So first we will try to understand about subsequent events. What are auditors' responsibilities regarding subsequent events? For that, first we need to understand what is the meaning of subsequent event as per the standards on audit. We all know what is the meaning of subsequent event as per accounting standards or Ind AS. As per Ind AS or accounting standard, they say that subsequent events are those events which are occurring between the date of the financial statements and the date of approval of the financial statements. And those subsequent events, for the accounting purposes, we can divide them into two categories: adjusting events and non-adjusting events. So this is from the accounting perspective, but we are not talking about accounting matters. We are talking about auditors' responsibilities regarding subsequent events. And those responsibilities are given under SA 560. And before we can talk about that subsequent events and auditors' responsibility, first we should know what is the meaning of subsequent event. First, we should know what is the meaning of subsequent event as per SA 560. So the standard defines something like this. Subsequent events are those events which are happening between the date of the financial statements and the date of auditor's report. Those events which are happening between the date of the financial statements and the date of auditor's report, but the fact of that subsequent event came to auditor's knowledge after the date of auditor's report. Some event has taken place between the date of the financial statements and the date of auditor's report. Some event has taken place, but you got to know about that event after you have signed the audit report. Then we call it a subsequent event. See, if you got to know some event, if you got to know about the event before the date of auditor's report only, that is not a subsequent event. There you don't need any guidance. Why? Because if you got to know about the information even before you sign the audit report, whatever action you have to take, that action you can take it through your audit report only. So when we start looking for guidance is when the date of when event has taken place before the date of auditor's report, but you got to know about that subsequent event after the date of auditor's report, then you start looking for guidance. Then what will be your responsibilities? That is where the complications are going to come in. And this standard will sort out that responsibilities, what you are supposed to do and all. Okay. And before we talk about auditor's responsibility, this standard says as an auditor, first you need to perform some audit procedures. So as an auditor, you need to perform some audit procedures. See, before you, the management is responsible for identifying subsequent events. Why? Because they are responsible for preparation of financial statements. And while preparing financial statements, they are responsible for complying with the accounting standards. So that's why before auditor, management will identify the subsequent events and do the proper adjustments. Now, as an auditor, you also should perform some audit procedures to determine whether there are any subsequent events. So what audit procedures I need to perform to identify the subsequent events? Like first one, you need to understand what procedures management has followed. Like as I have told before auditor, management is having the primary responsibility to identify subsequent events. So first you should go to the management and ask them, sir, what procedures you have followed for identifying subsequent events? You have to go and ask the management. Number two, then you have to inquire the management and those charged with governance whether they have found out any subsequent events. Then you read the minutes of the meetings of the board of directors, shareholders, which have especially taken place after the date of the balance sheet. Read the meetings. And even if any interim financial statements are available, read that interim financial statements. And even you try to obtain the written representations from the management. So basically, you should perform these procedures to identify whether any subsequent events have taken place. Now, once if you come across any subsequent events, then what are your responsibilities? Here, there could be two cases. See, generally what will happen? What is the entire process is? First, on the date of financial statements. So balance sheet date will come on 31st of March. Financial statements will be prepared. Now these financial statements will be approved. Generally, financial statements will be approved by board of directors of the company. So say for example, these financial statements are approved on 15th of April. Then they will be audited and the auditor will sign the audit report. So then what will happen is auditor will sign the audit report. Say for example, he's signing the audit report on 20th of April. Now after signing the audit report, what will happen? These financial statements, audited financial statements, which includes financial statements along with audit report, that will be circulated. That will be made available to the shareholders and third parties. So this is what the process, right? Financial statements will be prepared. They will get approved. Then auditor will do the audit, give the audit report. Then that financial statements and audit report will be circulated. This is what the entire process. See, sometimes what will happen is you will identify the subsequent event after the date of auditor's report, but before financial statements are circulated. You got to know about subsequent event here only. You got to know about subsequent event by the time you have signed the audit report. You have already signed the audit report, but you got to know about subsequent event before the financial statements are issued. This is case one. This is where you have some responsibilities to fulfill. Now, case two is such a case where you got to know about subsequent event after the date of auditor's report and even after issue of the financial statements. You got to know about subsequent events even after the issue of financial statements. That means by the time you got to know about subsequent event, financial statements are already there in the hands of the shareholders. So then what will be your responsibilities? That is covered under case 2. So case 1 says what will be your responsibility if you got to know about subsequent event before the issue of the financial statements. Case 2 says what will be your responsibilities in case if you came to know about subsequent event after the date of issue of the financial statements. You tell me which scenario is more complicated, where you need to worry more. We need to worry more. Our responsibilities will be more in case 2 comparatively with case 1. Okay, so anyhow, let us come back to our responsibilities. We'll talk about what will be auditor's responsibilities under case 1. Then we will try to understand what will be auditor's responsibilities under case 2. So we will talk about what will be auditor's responsibilities under case 1. What about the facts which came to auditor's knowledge before the issue of the financial statements? Somewhat favorable position you are into. So if you got to know about subsequent event before the financial statements are issued, first thing what should happen is you should go and discuss that matter with management. First, you have to go and discuss with the management. You have to go to the management and say them, sir, I got to know about the subsequent event. What are your views on it? Then, as a part of the discussion, determine whether financial statements need amendment. Why? Because that subsequent event could be a adjusting event or could not be a adjusting event. So if you go and discuss with the management, as a part of the discussion, you will get the clarity whether this is a adjusting event. If yes, that requires adjustment. Now, if you have decided that financial statements need amendment because it is an adjusting event, then you inquire the management whether they are ready to amend the financial statements or not. Whether they are ready to amend the financial statements or not, you have to go and inquire with them. Now, there could be two outcomes possible. Number one, management has agreed to amend the financial statements. Management told, okay, sir, we will amend the financial statements. See, if the management has agreed to amend the financial statements, good scenario, very comfortable scenario. What we will do? We will see whether really they have done the amendments properly or not. Why? Because we can't blindly rely on them. If the management comes to you and say, sir, we have done the amendment of the financial statements, will you blindly believe it? No. So we need to check once whether they have done the amendment properly or not. So you will perform audit procedures relating to amendment and you will try to obtain sufficient and appropriate evidence whether the amendment has been done properly or not. So if you got comfortable that all the evidence has been, all the amendments have been done properly, no need to worry about anything. The old audit report, whatever you have given, that will remain valid except one change. What is that change is you have to change the date. No impact on the opinion, but you will be required to change the date. Why? Because you have already given the audit report. Say for example, if you come back to this example, you have already given the audit report on 20th of April. Now the management amended. Say for example, on 25th of April, management amended the financial statements. Now these amended financial statements will be approved once again. These amended financial statements will be approved once again. Say for example, they are approved on 26th of April. But your old audit report will remain valid. But you have already given that audit report on 20th of April. No. So here the date of audit report is before the date of approval of the financial statements, which should not be a typical scenario. So that's why what you will do is the old audit report will remain all valid. Just you will change the date. What you will do is you will also change the date to 26th of April and then give the audit report. Understood? So this is what your responsibility in case if the management amends the financial statements. Will perform audit procedures, obtain evidence whether amendment is properly done or not. There will be no impact on the opinion, but we'll do one change. What we will do? We'll change the date. Sir, what if management does not amend the financial statements? This is a problematic scenario. You have got to know about subsequent event. You determine that that event needs adjustment in the financial statements. I requested the management to amend the financial statements. Management told get loss will not amend the financial statements. Now what we should do? So if the management does not amend the financial statements, here also there could be two scenarios. Scenario number one, you have signed the audit report. You have not yet given it to the management. You signed the report. You thought, for example, today you signed the report. Tomorrow you wanted to give it to the management. But before you can give to the management, you got to know about the subsequent event. I requested the management to amend it, but they are not amending. But since you have not yet given the audit report to the management, the audit report is still with you, happy, no issue, cancel the old audit report, throw it in the dustbin, give a new audit report containing a modified opinion. So if audit report is not yet given to the management, modify the opinion and give the audit report. In case if audit report is already given to the management. If audit report is already given to the management, now here there is a problem. If the management has already given the audit, if auditor signed the audit report and that audit report has already been given to the management, now there is a problem. So now what you should do? Now what you should do is first you have to go and instruct the management not to circulate the audit report. Go to the management and say them, sir, whatever audit report I have given to you, don't circulate it. Why? Because you did not amend the financial statements. No, I have to amend my audit report. I will give a modified opinion, give you a new audit report, then only circulate. Please don't circulate the audit report. Go and instruct the management. See, even after instruction also, management did not listen to you. They have circulated it. Then the standard says auditor should take appropriate action to stop the people from relying on that auditor's report. If without listening to your instructions, even after you give the instructions also, management has circulated the audit report, now you should take appropriate action to stop the reliance. Sir, what could be the appropriate action? It is completely your professional judgment. Like you can give a newspaper advertisement, you can give a update to the stock exchange, whatever it is you can do, take appropriate action. And finally, give a new audit report containing a modified opinion. So this is what your responsibilities are in case if you got to know about subsequent event before the financial statements are issued. Now comes a more problematic scenario. What will be your responsibilities in case if you got to know about subsequent event, but by the time you got to know about the subsequent event, financial statements are already issued? Then what you are supposed to do? Then what am I supposed to do is, so in case if I got to know about subsequent event after the financial statements are issued, then also the same things. First, I have to discuss the matter with the management. As a part of the discussion, determine whether financial statements need amendment and inquire whether management is ready to amend the financial statements or not. And in case if you have decided that financial statements need amendment, now first you should go and ask the management to take appropriate action to stop the reliance on the reported financial statements. Why? Because the financial statements have already reached the shareholders. No. So in case if you have decided that financial statements need amendment, just go to the management, ask them, sir, take some appropriate action to stop the people from relying on the auditor's report. Like give a newspaper advertisement or give a announcement on the website, whatever it is, ask the management to stop the people from relying on the audit report and the financial statements. In case if the management doesn't take appropriate action, then the standard says auditor himself has to take the action. So whatever it is, either the management or auditor, someone has to take the action to stop the people from relying on the auditor's report. Now, once someone has taken the action to stop the people from audit report, now once again same, if the management has agreed to amend the financial statements, here also I will perform audit procedures related to amendment. I will try to obtain sufficient and appropriate audit evidence. I will give a new audit report. Now the standard will say give a new audit report, and in that audit report I will give unmodified opinion only. Why? Because management has amended the financial statements, but now you are giving a new audit report and the shareholders already have one audit report. Now if you are giving new audit report and shareholders already have one old audit report, and also the shareholder will have one old copy of the financial statements, now you are sending a new copy of the financial statements, they might get confused. So that's why what the standard has told is, in that new report either use an emphasis of matter or other matter paragraph to highlight that effect of the amendment, so that shareholders will not have confusion. So it will not have impact on the opinion. Just in the new audit report I will include either an emphasis or other matter paragraph. On the other hand, if the management doesn't agree to amend the financial statements, then what I should do, I will give a new audit report which contains a modified opinion. Either a qualified or adverse opinion will be there. So I will give a new modified opinion and I will explain the reason for giving that modified opinion in my basis for modified opinion paragraph. Here there is no requirement to use either emphasis or other matter paragraph. You should not use it. Why? Because reason anyhow you are explaining in the basis for modified opinion paragraph. Perfect. Right. So this is what regarding the standard SA 560. Now we will come to the next important standard, which is SA 570, talking about going concern. As we all are aware, going concern is one of the fundamental accounting assumption. And when it comes to the going concern assumption, if someone tries to play with the going concern assumption, if the management tries to tamper with the going concern assumption, it will altogether have a deadly impact on the financial statements. It will cause a pervasive effect of the misstatement on the financial statements. It will cause a pervasive effect on the financial statements. So that's why, since going concern is one of the very much fundamental accounting assumption, the standard, a dedicated standard has been given to assist the auditor to help him to obtain sufficient and appropriate audit evidence regarding going concern. But first of all, you tell me, it is whose responsibility to make an assessment regarding going concern? First of all, what do you mean by going concern? Going concern means it is an assumption that entity will continue for the foreseeable future. Foreseeable future in the sense, I can say in the next 1 year. So the assumption that entity will continue for the foreseeable future, that is for the next 1 year entity will continue. There is no requirement for the entity to get closed down. That assumption I call it as going concern assumption. Now who is responsible for making that assessment? Whether entity will be able to continue for the coming 1 year, or going concern assumption is valid for them, or going concern assumption is invalid for them, who is responsible for making assessment? So the primary responsibility for making assessment regarding going concern is with the management. It is management who is responsible for making assessment regarding going concern, not auditor. So management is responsible for making an assessment regarding going concern. And how they will do that assessment, whether they will continue for the next 1 year or not, how they will do that assessment? Will they toss a coin and say heads comes going concern valid, tails comes going concern invalid? Will they do it? No. So when the management is making assessment regarding their ability to continue as a going concern, they will keep various factors in mind. Like they will consider the factors of size and complexity of the entity, what is the nature and condition of the business, are there any uncertainties like litigations and claims, and also external factors like changes in the laws and regulations. So they will consider all these factors, then they will make a decision whether entity's going concern is valid or not. Okay, management will make an assessment regarding going concern. Then what is auditor's responsibility? Agreed, management will make an assessment regarding going concern. But what is auditor's responsibility? So in order to know what is auditor's responsibility, SA 570 objectives paragraph we have to read. So objectives of SA 570 paragraph will actually say what is the auditor's responsibility. So SA 570 says that the responsibility of the auditor is to obtain sufficient and appropriate evidence regarding the appropriateness of management's assessment. Management will make an assessment regarding going concern. Now, whatever assessment management has made regarding going concern, whether that assessment is appropriate or not, regarding that, I need to obtain sufficient and appropriate evidence. So that's what they say here, to obtain sufficient and appropriate audit evidence regarding appropriateness of management's use of going concern assumption. So whatever assessment management has made, for that I need to obtain audit evidence. Now, how will I obtain that audit evidence? I will try to obtain that audit evidence by performing audit procedures. Definitely right. So if I want to obtain audit evidence, I need to perform audit procedures. Sir, what audit procedures I need to perform to obtain audit evidence regarding appropriateness of management's assessment of going concern? That audit procedures are given in the same standard. We need not go and look anywhere. In the same standard, they have told what audit procedures you have to perform. And by performing that audit procedures, you need to determine is there any material uncertainty relating to going concern. Depending on that audit procedures, we need to determine is there any material uncertainty relating to going concern. I will talk about that material uncertainty in a while now. And then finally, you have to report it in accordance with the standards on audit. Whatever your findings are there, all those findings are required to be reported as per the requirements of the standard. So 3 responsibilities of the auditor as per SA 570 regarding going concern. Number 1, obtain sufficient and appropriate audit evidence regarding the management's assessment of appropriateness of management's assessment of going concern, and determine on the basis of evidence whether any material uncertainty exists, and to report in accordance with the standard. So now you will perform procedures. So as I've told, the standard is asking you to perform some procedures. You will perform all that audit procedures. I will come to that later. What audit procedures we will perform, we will come to that later. Now, after performing all the audit procedures, whatever have been given in the standard, there could be multiple options which could be possible. There could be different outcomes which could be possible. So after performing all the audit procedures, I have arrived at a conclusion that going concern is valid, going concern is appropriate. Entity will continue for the foreseeable future. There is no requirement to wind up the company. Or other case which could be possible is going concern is inappropriate. I have got perfect evidence that going concern is inappropriate. Entity will not continue for the next 1 year. Either the financial position is very bad or they're going through pending cases. So whatever it is, I am very much certain I have evidence that going concern is inappropriate. Entity will get closed down in the next 1 year. Or there could be one more typical scenario. I might come across a situation where I find that there is a material uncertainty relating to going concern. Material uncertainty relating to going concern. That means depending on procedures whatever I have performed, I am able to conclude that whether entity will continue in the next 1 year or not, that is uncertain. That means we can't say it with clarity. That depends on some facts and circumstances which are beyond the control of the management, beyond the control of the auditor. Like for example, a company might be going through pending case. If the company wins the case, they will stay in the business. If the company loses the case, they will be thrown out of the business. So whether entity will continue for the coming 1 year or not, that is uncertain on the outcome of that litigation. This typical scenario, we call it as material uncertainty relating to going concern. So 3 outcomes could be possible. You might come to a conclusion that going concern is appropriate. Entity will continue for the future. There is no requirement to close down. Or you might come to a conclusion going concern is inappropriate, which says that entity will not continue for the next 1 year. It will compulsorily get closed down. Or you might come across a confusing state where you believe that there is a material uncertainty relating to going concern. So in each of these cases, what will be your responsibility? See, if the going concern is appropriate, then there is no report, then there is no specific requirement. We will give an unmodified opinion. Here, nothing requires a discussion. But the other two cases require discussion. So, case 2, going concern is inappropriate. You have obtained audit evidence that entity will not continue for the next 1 year. You have obtained evidence that entity will not continue for the next 1 year. Then what you will do? The standard says if you come to the conclusion that going concern is inappropriate for the entity, the next thing we need to check is whether adequate disclosure has been given in the financial statements or no adequate disclosure is given in the financial statements. If the going concern is inappropriate, the next thing what we need to check before we come to the opinion, we need to check is the entity has made appropriate disclosure in the financial statements or adequate disclosure is not given in the financial statements. Sir, what do you mean by giving adequate disclosure? Giving adequate disclosure means entity has accepted to the fact that yes, the going concern is invalid. They have valued all their assets and liabilities on liquidation basis, and that difference between the carrying values and liquidation value has been taken to the statement of P&L, and even in the notes to accounts they have clearly explained that going concern is invalid for them, they will not continue. That is what the meaning of giving proper disclosure. That is what the meaning of giving a what? Proper disclosure. That means management has valued all their assets and liabilities on liquidation basis, as if they sell their assets on the balance sheet, what value they will realize, that value they have determined, and the differential between the carrying value and this realizable value they have taken it to the statement of P&L, and clearly in the notes to accounts they have explained that they will not continue for the next 1 year. So that is what the meaning of giving adequate disclosure. See, if the management has given adequate disclosure, you tell me in that case, are the financial statements misleading? No, financial statements are not misleading. Here the financial statements are genuinely presented. So which opinion I should give? As usual, I will give unmodified opinion because the financial statements are not misleading. But I want to highlight this information somewhere in my auditor's report. Entity has done everything correctly, but I felt that this information is very fundamental to users' understanding. People might not go and read that information. I felt it is better if I highlight it somewhere in the auditor's report. Then what the standard has told is use the emphasis of matter paragraph and highlight that information. Since the information is already presented or disclosed in the financial statements, you want to bring it to the user's attention because it is very fundamental to users' understanding. So you can highlight it in the emphasis of matter. On the other hand, if you decided that going concern is inappropriate and management did not give adequate disclosure, what do you mean? What do you mean by management not giving adequate disclosure? What do you mean by management not giving adequate disclosure? Is there is the management is continuing even though the going concern assumption is inappropriate, the management still continues to show its assets on historical cost basis. So that is a case of giving not adequate disclosure. Here the standard has told you to go to the extreme and directly give an adverse opinion. Don't look any other way. Directly give the adverse opinion. Why? Because that misstatement is not just material. That misstatement is material as well as pervasive. So no need to have any second thought. Directly go ahead and give the adverse opinion. Right? So this is what regarding when going concern is inappropriate. Now there could be one more case. What is that one more case? The auditor has concluded that there is a material uncertainty. That means whether entity will be able to continue for the next 1 year or will not continue. That is highly uncertain on some events and circumstances. See, if that is the case, here also what we need to check is whether that adequate disclosure has been given for that material uncertainty or there is no adequate disclosure given for material uncertainty. If adequate disclosure has been given for material uncertainty, if proper disclosure has been given in the financial statements, that means management in the notes to accounts, they have clearly explained so and so uncertainty we are facing, whether we will continue or not, it is depending on the outcome of the pending case, that they have clearly explained. So if they have given adequate disclosure, no need to modify the opinion, we can comfortably give an unmodified opinion. But here also, even though the management has explained adequately disclosed that information in the financial statements, don't you think it is very much fundamental to users understanding of the financial statements? Yes. Generally what we should have done, if you want to highlight it, we should have used it a emphasis of matter paragraph and we should have highlighted it. But here the standard has specifically told don't use emphasis of matter paragraph, use material uncertainty relating to going concern paragraph. Use a separate paragraph. In the case of material uncertainty, if you want to highlight it in the auditor's report, don't highlight it under emphasis of matter paragraph. Instead, use a separate paragraph with the heading material uncertainty relating to going concern, and in that paragraph you want to highlight whatever you wanted to highlight it. Next, sir, what if there is no adequate disclosure? So here, straightforward, if there is no adequate disclosure, in that case, financial statements are misleading. You have to give a modified opinion. And what kind of modification? Either qualified or adverse, depending on materiality and pervasiveness. And the reason, anyhow, you will explain in basis for modified opinion paragraph. In this case, there is no requirement to use material uncertainty relating to going concern paragraph, because the reason, anyhow, you are explaining it in the basis for modified opinion paragraph. And there could be some cases where management will not share their assessment only. So as I have just now mentioned, as an auditor, you need to obtain evidence whether assessment of the management is appropriate or not. So I asked the management, sir, going concern valid or not? Management told, yes, sir, going concern is valid. Sir, did you make an assessment? Management told, yes, sir, we did the assessment. I asked them, share that assessment with me. As an auditor, I asked them, share that assessment with me so that I will verify and obtain evidence whether this going concern assumption, whatever assessment that you have done regarding going concern, is it appropriate or not? I will have a look at it. I will have a look at it and try to obtain the evidence. But the management is not sharing that assessment with you to obtain the evidence. So this is a typical case of non-availability of the audit evidence. In that case, either you have to give a qualified opinion or a disclaimer of opinion, because this is a case of non-availability of audit evidence. Understood? So once you have performed audit procedures, depending on your findings, these will be the impact on reporting. But we did not see yet what are the procedures which we are required to perform. See, after performing the procedures, depending on your findings, these reporting requirements will come. Like once you have performed audit procedures, you will have some findings, then these findings will result into these reporting requirements. But we did not see yet what are that procedures which you are required to perform. So that procedures we will try to address now. So what are that procedures you are required to perform? So here also we have divided the procedures into two categories. One is risk assessment procedure. Basically, first we need to perform the procedures to identify is there any risk of material misstatement related to going concern. Sir, how can I identify that? Let us see. The auditor shall consider whether there are any events or conditions exist that may cast a doubt on entity's ability to continue as a going concern. So as an auditor, first you need to evaluate, first you need to identify is there any event or circumstance that is creating a doubt regarding going concern. Sir, what are that examples of events or circumstances which create a doubt regarding going concern? That also standard itself has told it. And that indicators, that events or conditions which create a doubt regarding going concern, that have been divided into three categories under SA 570. So what are the three categories? Financial indicators, operating indicators, and other indicators. Sir, what are financial indicators? Like net liability position. The company is always having net liability. Borrowings are approaching maturity, but your client has no prospects to repay it. Continuous negative cash flows. Customers are withdrawing withdrawal of financial support by the suppliers, and financial ratios are very bad. Don't you think if you come across these circumstances, you will get a doubt regarding ability to continue as going concern or not? Yes. Similarly, some operating indicators like management itself wants to liquidate, or some key management has left the company, labor difficulties, they are not able to find the labor, and shortage of important supplies. The raw material which you want for your operations is in huge shortage, or altogether a successful competitor has come who is taking your market share. And other indicators like non-compliances with the laws, pending cases, uninsured catastrophes, or changes in the laws and regulations. So basically, I will try to identify whether any of these indicators are present by which create a doubt regarding going concern. Sir, how will I get to know whether these events are there or not? Simply by going and inquiring with the management. So, and by inquiring the management, in case if you got to know about any such event or condition which cast a doubt regarding going concern, then you should perform the further audit procedures. If no such event has been identified, you can stop yourself with risk assessment procedures. But in case if you identify any such event or condition, then you need to perform the further audit procedures. Sir, now what are that further audit procedures? Request the management to make the assessment. If not yet done, if the management has not yet made an assessment regarding going concern, ask the management to do the assessment. Sit with the management, discuss what are the plans for their future, analyze the cash flow forecast. Generally they will prepare the forecast, analyze that forecast, cash flow forecast, what assumptions they have used, whether that assumptions are appropriate or not. Request written representation, then analyze the profits, cash flows, etc. Read the latest interim financial statements, inquire the legal counsel, inspect the loan agreements, and even read the minutes of the board of directors meeting. So all this further audit procedures you will perform. Then you will have your observations, and depending on your observations, we are going to fulfill this reporting requirements. Understood? So this is what regarding SA 570. So we have completed SA 570 also. Now we are left with only one more standard in the 500 series, which is SA 580 talking about written representations. Just talking about what? Written representations. So let us try to discuss now this written representations related standard also. Right. So this also relatively important from MCQ's perspective. Very rarely they ask a descriptive question from here. But anyhow, we'll try to give a summary. If at all MCQs gets tested, we should be in a position to answer it. So we'll try to quickly cover this summary. So written representation. So first of all, what is the meaning of the written representation? They say that the meaning of the written representation is the written statement which is obtained by the auditor. The written statement which is obtained by the auditor from whom? From management. See, when I say external confirmation, that is a written confirmation obtained by the auditor from a third party. But when I say written representation, that is a written statement which is obtained by the auditor from the management for what? With what purpose? To confirm certain matters or to support the other evidences. So in order to confirm certain matters or to support the other evidences which you have gathered, you get a written statement from the management of the company. That written statements, we are going to call them as written representations. Like if you pay attention now, till now, so many standards we have discussed. And if you pay close attention, in each and every standard, in many standards, they have asked you to obtain written representation regarding certain matters. So those are nothing but written statements which you as an auditor obtaining to confirm certain matters or to obtain the extra evidences. Now, sir, whatever written statements which I am getting from the management to confirm certain activities, is that an audit evidence? Yes, that is an audit evidence, but the problem is it is only a supporting audit evidence. They do not provide sufficient and appropriate audit evidence on their own. So if you get the written confirmation from the management, yes, to some extent it is an evidence, but it is in the nature of supporting evidence only. You written representation cannot provide evidence on their own. That means you can't completely rely only on written representation for the purpose of evidences. So that is just a supporting evidence, that is not a evidence on its own. Why? Because if the standard has told you to rely only on written representation, my work will become very, very easy. You will not imagine that my work will become damn easy. Why? Because if I can use written representation only as a audit evidence, I will go to the management, ask the management to give me written confirmation that they comply with applicable financial reporting framework and financial statements are free from material misstatements, and I will sign the audit report and come back. But that is not the case, right? So that's why written representation do not provide evidence on their own. Now, what are the objectives of the auditor? Sir, regarding which matters I need to obtain written representation? Number one, every auditor must compulsorily get a written representation from the management that the management has fulfilled the responsibility for preparation of financial statements and they have completely provided the information to the auditor. This is must. Every auditor must get from every company this written representation. That management has fulfilled the responsibility for preparation of financial statements and they have completely provided the information to the auditor. They did not hide any information from the auditor. Confirming these two matters, every auditor for every entity, he must get the written representation. And also, if there is any requirement of other standard, like for example, in SA 570, just now as we have completed, SA 570 will ask the auditor to get the written representation from the management regarding going concern. There also you have to get it. SA 560 also they have told you need to obtain written representation from the management regarding subsequent events. That also you have to obtain. So like that, if there is any requirement from the relevant standard, you can obtain the written representation. And in all other cases, it is up to your choice in which matter you will get written representation, in which matter you will not get written representation. And whatever written representations you have got, you have to respond appropriately. And sometimes management, you request the written representation from the management, but the management is not providing the written representation, then also you need to take appropriate action. Then also you have to respond appropriately. So whether management is giving the requested written representation, respond appropriately. Management is not providing the written representation, then also you have to respond appropriately. So these are the objectives of the auditor. Next, date and period should be date and period covered by written representation. So most important thing here, the date of written representation shall not be later than the date of auditor's report. The date of written representation shall not be later than the date of auditor's report. Why? Because written representation is also a kind of audit evidence. Written representation is also a kind of audit evidence, and the process is first you will obtain audit evidence, then you will give the opinion. So that's why the date of written representation can never be later than the date of auditor's report. It should be either on or before the date of auditor's report. Next, and one more thing, the date of written representation should be as close as possible to the auditor's report. The date of written representation should be as close as possible to the auditor's report. So if you download the question bank, in the question bank there is one interesting question in the chapter. So just download my question bank, even I have kept it on the website also. So you can download the website and go through the questions of the standards on auditing chapter. I have kept some interesting questions there. There will be one question where they will say the date of written representation must be as far as possible close to the date of auditor's report. So one interesting question will be there. I would suggest you to go and refer it. Next. Fine. Management from whom written representations are requested. See, when I say management, management is a very broader term. There will be many people who are falling under the management definition. So, but from whom I will try to obtain written representation. I will not go to each and every management person and ask the written representation. Generally, I request written representation from those people who are involved in the financial statement process, or from whom I expect that they have a reasonable knowledge regarding the financial statements and items. From that person I can expect written representation. Generally, like CEO of the company, CFO of the company, or if audit committee is there, with the audit committee, generally with these people I ask the written representation. I do believe that these people, we generally believe that these people will have all the requested information. But sometimes what will happen is, regarding one matter I need some written representation. Like for example, I need written representation regarding accounting estimate. Management has created a gratuity provision. I want the management to give a written representation regarding the gratuity provision. But the management did not create that provision. I went to the CFO and asked, but CFO was not involved in the provision. Some actuary has done it. Can the CFO say, sir, I don't know about this gratuity provision. That's why I will not provide written representation. Can he say that? No. The standard says that you go to the concerned management, ask the written representation. But if the concerned management does not have the required information, it is his responsibility to go to the concerned person in the organization, get the required information, and then provide the written representation to the auditor. They simply can't wash off their hands saying that I don't have information, I will not give written representation. They can't say it. It is their responsibility to go to the concerned person, get the required information, and provide the written confirmation to the auditor. Okay, so that's what they say. Sometimes management may be required to make inquiries of others within the entity to obtain the relevant information. Like they can go to actuary, legal expert, staff engineer. These are just examples. If they don't have required information, they go to these kind of persons, get the required information, provide the confirmation to the auditor. Next, in some cases, you might be required to obtain written representation from the management to reconfirm your responsibilities. Sir, when you will get a written representation to reconfirm. Reconfirm means what? Confirming once again. That means initially you got a confirmation regarding the management responsibilities and all. But in some cases, during the course of the audit, it might be necessary for you to reconfirm the management responsibilities by getting written representation once again. When, sir? When those who signed the terms of engagements have changed. Basically, board of directors have changed. Those people who signed the engagement letter, those are not the people who are now in charge of the company. So then you might be required to get the engagement. Now you might be required to get the written representation once again from the new management. Or terms of engagement are prepared in the previous year. You have prepared the terms of engagement in the last year. Now you want to change the terms. Get the confirmation once again. Or management misunderstands its responsibilities. Initially, management gave a written representation that they are accepting all the responsibilities. But later I realized that management misunderstood their responsibilities and gave the confirmation. So just go and explain to them clearly, sort out that misunderstanding and get the written representation once again to confirm that responsibilities. And if at all any circumstances have changed, because of the change in circumstances also, you might be required to obtain a written representation once again. And last two paragraphs we have. Sometimes management will give written representation, but I will have a doubt regarding its reliability. Management will give a written representation, but I will have a doubt regarding its reliability. You tell me, generally, when I will have a doubt regarding reliability of reliability of written representation. When I have a doubt regarding integrity, when I have a doubt about integrity, I felt that management is not honest. Or when I have doubt regarding competence, I felt that management is not capable. They don't have a required knowledge of financial statements and all. So then obviously I will have a doubt regarding reliability of financial information, reliability of written representation. So when you have concerns about integrity, competence and ethical values of the management, in those cases, I will have a doubt regarding reliability of written representation. And especially when written representation management has given and evidence you have gathered when both are inconsistent, this is a very much problematic area. So if you obtain written representation from the management and you have obtained some evidence regarding that item, whatever management is confirming and whatever evidence I have got, there is a inconsistency. I need to resolve this matter. I need to resolve this matter. Auditor shall resolve this matter. Is written representation only wrong, or the evidence which I have got is wrong? I have to evaluate. See, if the evidence you have got is wrong, okay, we'll perform extra procedures and get the evidence. But if I have concluded that no, evidence is correct only, but written representation is only wrong, then I need to reassess my risk of material misstatement, consider the implications on my auditor's opinion. Even here the standard has told you to go to the extreme and give a disclaimer of opinion. Even the standard has asked you to go and give a disclaimer of opinion if you have finally decided that written representations are not reliable. So if the auditor determines that written representations are not reliable, then the auditor shall consider even modifying the opinion. Generally disclaimer he will give you. Extreme you have to take. Next, requested written representation not provided. See, in the previous case, you asked for written representation, management provided, but they are not reliable. But now this paragraph says you asked for written representation from the management, but the management is not providing the written representation only. Then what I should do? Then you have to go and discuss the matter with the management, re-evaluate the integrity of the management. That means reassess the integrity of the management and even consider modifying the opinion. If required, consider modifying your opinion. So this is what the last standard from 500 series. With this we have even completed SA 580 also. So all 500 series of the standards we have completed. Clear? Comfortable everyone? Right. So now what we will do is we will discuss 200 series of the standards. We are going to discuss now 200 series of the standards. So 240, 250, 260 and 299 we have very simple and easy standards only. And here descriptive questions are going to come. Very important from the examination perspective. 240, 250, 260 and 299. So these are 4 standards we'll try to quickly cover. Right. So we have successfully completed today 3 hours of stream, 3 hours of marathon we have completed. Yeah, we are making a good progress. So still I will continue for 1 more hour. Yes, I will continue for 1 more hour. So I will complete 200 series of the standards, and also I will try to complete audit strategy, planning and execution, like that one topic we have. Relatively small topic, easier also. Will not take much of a time. Hardly it will take some 30 to 45 minutes. So that also I will try to complete it. But before that we have to complete this 200 series of the standards. So let us try to do it. So the auditor's responsibilities relating to fraud. SA 240 is the standard which is talking about auditor's responsibilities relating to the fraud. So whenever you are conducting audit of financial statements, as a part of that audit of financial statements, sometimes you might be coming across a fraud. And as we all are aware, misstatement can happen because of 2 reasons. Misstatement can happen because of fraud also. Misstatement can happen because of error also. See, if the misstatement is happening because of error, it is not that much troubling. It is not something which you have to worry about. Right. But if the misstatement is happening because of fraud, this is something which is of very much a serious concern. Why? Because when someone has committed a fraud, they have done it intentionally with a manipulative intent, and they are trying to cheat the company with a malicious intention. So that is going to be a very major concern which you have to get worried about. So that's why if the fraud, regarding fraud, we have so many extra procedures we need to perform. We have so many responsibilities to fulfill fulfill. And even SA 240 has given a detailed guidance. They will explain you what and all are the different methods in which fraud will be perpetrated, what and all are different ways, what and all different indicators. So like that, many things the standard will try to guidance here. But one caution I would like to give here, see, when the standard is trying to tell you the techniques for committing fraud, indicators of the fraud and all, the intention is not that you will become so-called scammer or fraudster after in your future. They are teaching you all this so that you will be able to identify it. They're teaching you all this so that you will be able to identify it, not that you will go and become a scammer or fraudster. Clear? So that has been the whole intention of this standard. So let us try to get into the details. First of all, what is the definition of the fraud? So as we all are aware, we have read when we were kids, actually in the CA inter level itself, we would have read this definition of the fraud. So how to define the fraud? Fraud is something which is an intentional act. It is always done with an intention. So fraud will not happen unintentionally. Someone will do it intentionally. And it could be done by one individual or more than one individual. Either one individual can do it or more than one individual can do it. And those individuals who are committing this fraud, they can be from the management, they can be from those charged with governance, and even they can be from employees or third parties. And all of them can collude also. So someone from management, someone from those charged with governance, someone from employees, or someone, a third party outside of the organization, anybody, either they all might collude with each other and commit a fraud like the PNB scam also. So anybody can do it. And it always involves the use of deception. Deception means what? Cheating. By committing the fraud, you are actually cheating the organization. Now, why you are using that deception? What is the ultimate purpose of committing that fraud? To obtain an unjust or illegal advantage. So to get some advantage which is unjust, for which you are not entitled to, or to get some advantage which is not legal for you. So that is what the whole purpose of the fraud. So if you rewrite the definition of the fraud, this is how the definition will look like. So fraud is an intentional act committed by one or more individuals. That individuals could be among management, those charged with governance, employees or third parties, and it always involves the use of deception. And why we are doing that is to obtain an unjust or illegal advantage. Okay. Now I will say, sir, who is responsible for preventing and detecting the frauds in the organization? Say for example, there is a company X Limited. You are a chartered accountant appointed as auditor of this company. Now in this company, it is whose responsibility for prevention and detection of the frauds? So the primary responsibility for the prevention and detection of the frauds is always going to rest with the management. Because management are the people who are running the business, management are the people whom the people have trusted and invested their money in the entity. So management is having the primary responsibility to prevent and detect the frauds in the organization. So then what about auditor's responsibility? Then what about auditor's responsibility? See, the main responsibility of the auditor, even the standards on auditing also says, the primary responsibility of the auditor is to obtain reasonable assurance whether financial statements are free from material misstatements because of error or fraud. And because there are, even though he can obtain reasonable assurance, but still we know that the process of audit is suffering from some inherent limitations, because of which no matter how effectively you do the audit, still some fraud might be, and still some misstatements might be undetected. Does that mean, will the auditor not be held responsible for not detecting the fraud? Will the auditor be not responsible for not detecting the fraud? Which means if the auditor has committed the audit but he was unable to detect the fraud, will he not be punished? Will he be spared just like that? No. Will that mean he will always be punished for not detecting the fraud? No, that is also not. So whether auditor will be punished or auditor will not be punished, it all depends on whether auditor has behaved in a proper manner or not. So the standard says that the liability of an auditor for failure to detect the fraud, it exists only when such failure is clearly due to not exercising reasonable care and skill. That means if you behaved in a negligent manner, if you did not do the audit in a careful manner, if you did not exercise the proper skill while doing the audit, that's why you are not able to identify the fraud, then that failure is purely because of your mistake and you will have to face the consequences. Then only you will be held responsible. But anyhow, whether auditor will be able to detect a fraud or will not be able to detect a fraud, that all depends on multiple factors. Like, it just will not depend on ability of the auditor, it depends on other factors, like it depends on the skillfulness of the perpetrator, the person whoever is committing the fraud. It depends on his skill. If he is more skillful, very difficult to detect a fraud. If he is not that skillful, easier to detect a fraud. It also depends on frequency, with what frequency the fraud is committed. If it is getting committed frequently, somewhere it will come into our sample and we will catch him. If it is just committed once in a while, it might come into our sample, might not come into our sample. It also depends on degree of collusion. Higher the collusion, more difficult it will be to detect. It also depends on size of the amounts getting manipulated. If the fraud is committed in a very big figure, easier to detect. If the fraud is committed in small negligible amounts, difficult to detect. It also depends on the seniority of the person whoever is committing the fraud. So whatever it is, it depends on all the factors, but whether auditor will be held responsible or not, it depends on whether he has exercised reasonable care and skill or not. That he has to prove it with the help of audit documentation. Clear? Next, the frauds can be broadly divided into two categories. One is fraudulent financial reporting and the other one is misappropriation of assets. See, this fraudulent financial reporting is having other name. We also call it as a manipulation of accounts. What we can also call it, manipulation of accounts also we call it. The name itself says you are trying to show a wrong picture through the financial statements. The fraud in which the management is trying to convey a wrong picture through the financial statements to mislead the users to affect their investment decisions, that kind of fraud we call it as fraudulent financial reporting. The name itself says financial reporting. It is a process of preparation and presentation of financial statements. Fraudulent financial reporting, that means you are doing that financial reporting in a fraudulent manner, in a wrong manner, to cheat the others. You are doing the financial reporting, so that fraud we call it as fraudulent financial reporting. So it involves intentional misstatements. Either that could be omission, you are omitting some information, or of amounts or disclosures to deceive financial statement users. You are cheating the users of the financial statements. Okay, and one more thing here, when I say fraudulent financial reporting, it cannot happen unless the management involves. Without the management involvement, fraudulent financial reporting can't happen. If the fraudulent financial reporting is happening, there definitely management is involved. On the other hand, we have one more category of the fraud, which is misappropriation of the assets. Here what will happen is, here there will be damage. It is such a kind of fraud where entities' assets will be stolen, lost, damaged, or theft is happening. So it involves the theft of the entity's assets, and generally this misappropriation of assets, we expect the low level employees to commit it, not the top level management. We don't expect from them. So we expect the low level employees to commit these kind of frauds. Okay, so now next thing they say, see, you take any kind of fraud, whether you take misappropriation of assets or you take fraudulent financial reporting, for any fraud to take place, there must be three things. For any fraud to take place, either fraudulent financial reporting or misappropriation of assets, for any fraud to happen, there must be three scenarios. There must be three things present. Number one is incentive or pressure to commit fraud. It all starts with the incentive. It all starts with a pressure. If the management is trying to show a wrong picture through the financial statements, might be they are under a pressure to do it, or they find some incentive in doing it. If an employee is stealing the assets of the company, he is doing it because he might be under some pressure, or he is finding some incentive in doing it. So the starting point of any fraud to happen, either fraudulent financial reporting or misappropriation of assets, is incentive. It all starts with the incentive or pressure. But having an incentive or pressure alone will not be enough. Even there should be an opportunity to commit the fraud. What also should be there? Opportunity also should be there, like some weakness in the internal control, some lapse in the organization, some lapse in the process, some opportunity should be there. That should make the fraud possible. So first it should have incentive or pressure, then it should be supported by an opportunity. And having the pressure and opportunity alone will not be enough. Even rationalization, attitude, this third aspect talks about attitude. The person who wants to commit a fraud, or the management who wants to commit fraudulent financial reporting, they should have such an attitude where they will be able to rationalize committing the fraud. That means they should be able to justify committing the fraud. The management should be having such an attitude where they will be able to justify. That means even after committing the fraud also, they will be able to rationalize it. Such an attitude also you should have. So you take any fraud, either misappropriation or fraudulent financial reporting. For any fraud to take place, three things must be present. Number one, there should be an incentive or pressure to commit a fraud. Number two, there should be an opportunity to commit a fraud. Number three, there should be an attitude to rationalize the fraudulent acts. So like this, any fraud to happen, these three things should be there. Done. Then they elaborate here. As I have told, this standard will also tell you what are the various techniques for committing the fraud. No, so here they are telling the techniques. Like first, I will address here how misappropriation of assets can be done. How generally employees will commit the misappropriation of assets. So generally what they will do is they will embezzle the receipts. That means they will not account for the receipts. Like for example, one cashier is there, he is doing the cash sales, but some cash sales is not recording in the books of accounts. Or what they can do is they can steal the fixed assets or intellectual property. Even intellectual property is also an asset. For a pharmaceutical company, a formula for a new drug is a intellectual property. Even that also can be stolen. That is also misappropriation of assets. Or causing an entity to pay for goods and services not received. Causing an entity to pay for goods and services which are not received. That means submitting fake bills, fake expenses, booking and spending the money, or using an entity's assets for personal purposes. Company's assets are getting used for personal purposes. This is also one way of accomplishing misappropriation of assets. So misappropriation of assets can be accomplished by entities in these different ways. Similarly, how fraudulent financial reporting can be committed, for that also they are giving the techniques. Like if you see here, manipulation, they can do manipulation. Falsification, like they can do forgeries and all. And even alteration of accounting records or supporting documentation. Or misrepresentation, wrongly presenting the information. Intentional omission, intentionally they are omitting the information from the financial statements. Or intentionally they might misapply the accounting principles, like treating capital as revenue, revenue as capital, current assets are non-current, non-current as current. So they can intentionally misapply the accounting policies. Or sometimes management themselves will override the internal controls to commit the fraudulent financial reporting. So management are the people who are responsible for designing implementation of the internal control, but the management themselves might override that controls to achieve that fraudulent financial reporting. So how they can override that controls? Like by way of recording fictitious journal entries. They will record the fake entries. Or they will inappropriately adjust the assumptions, like they can play with the accounting estimates. Just now we have covered in the SA 540 accounting estimates. And either they will omit the recognition, or they will advance the recognition. That means next year expenses also they will book here, or they will delay the recognition. Current year expenses they will carry forward to the next year. Or not just conveying wrong information, even hiding the important information is also fraudulent financial reporting. Like company is going through one pending legal case, but the management did not disclose it anywhere. Fraudulent financial reporting. And engaging in the complex transactions, the management will intentionally engage in the complex transactions so that no one will understand, which will provide them an opportunity for committing fraudulent financial reporting. Or even altering the terms and records relating to significant unusual transactions. So this is how different ways in which fraudulent financial reporting can be committed. So till now we did not speak about auditors' responsibilities. The standard is decided, the standard has been given to help the auditor to talk about what are the auditor's responsibilities relating to the fraud. But if you would have paid close attention, we did not talk about auditor's responsibility till now. We only spoke about what is the meaning of the fraud, different types of fraud, how the frauds will happen, what is required for making the fraud happen. Sir, but where is auditor's responsibilities? Now we are coming to the auditor's responsibilities. Okay, sir, we spoke about all the technicalities relating to the fraud, but what about auditor's responsibilities? When it comes to the fraud, what are auditor's responsibility? The standard says 3 responsibilities. Number 1, first you need to identify and assess risk of material misstatement due to fraud. What is the first thing we need to do? We need to identify, is there any risk of material misstatement relating to fraud? So they are not asking you to directly go and find out the fraud. First they are asking you to find out, is there any chance, is there any risk of material misstatement relating to the fraud? First you have to find it out. So once you have found out the risk of material misstatement, now you have to respond to that risk of material misstatement. So basically what they are trying to say here is, first we perform risk assessment procedures and try to find out a risk of material misstatement due to fraud. Now, once you have identified the risk of material misstatement, you have to plan your further audit procedures to address that risk of material misstatement by obtaining evidence. That is the second point. To obtain sufficient and appropriate audit evidence about the assessed risk of material misstatement of fraud through designing and implementing appropriate responses. That means by implementing and designing proper further audit procedures, obtain sufficient and appropriate audit evidence. Finally, if you find out any fraud, if you suspect any fraud, or if you find out any fraud, you have to respond appropriately. So these are the three matters, three responsibilities of the auditor as per SA 240. So what are the three responsibilities? Number one, identify and assess the risk of material misstatement. Number two, respond to that risk of material misstatement by performing some procedures. Number three, respond appropriately. Report on your identified or suspected frauds. Okay, so let us come to the first objective. They are asking me to identify risk of material misstatement. Sir, but how can I identify that risk of material misstatement? How can I identify that risk of material misstatement? So first objective, how can I fulfill? So here they are saying risk assessment procedures to obtain information relevant to identifying risk of material misstatement related to fraud. So how can I identify the risk of material misstatement related to fraud? Very simple. At the beginning, when you are performing risk assessment procedures, at that point of time only you should identify, is there any risk of material misstatement relating to fraud? Sir, how can I do that? Simply go and inquire with the management and others within the entity. So go and inquire with the management. Sir, is there any fraud? Is there any chance of happening the fraud? First, you have to go and inquire. Then obtaining an understanding as to how those charged with governance exercise oversight of management process for identifying and responding to the risk of fraud. So even you have to go and understand, are those charged with governance having control over management? Are they monitoring the management regarding the fraud related activities? That you have to understand. And also, I need to understand what internal control management has established to mitigate this risk. And even I should find out, are there any unexpected relationships by performing analytical procedures? So basically, you need to perform analytical procedures to identify whether any unexpected relationships are there, which will give you an indication of fraud. So basically, 4 steps you need to perform. So first objective, you need to identify risk of material misstatement, and you can identify that risk of material misstatement by doing 4 steps. What are the 4 steps? Number 1, inquire the management and others. Number 2, understand whether those charged with governance is having a oversight over the management's responses. Number 3, evaluate what internal controls management is having. Number 4, perform analytical procedures and find out unexpected relationship. Now, after you have performed that audit procedures, you will identify the risk of material misstatement. To that identified risk of material misstatement, you have to respond. And also, this risk of material misstatement can exist at 2 levels, which we will discuss in the risk assessment and internal control chapter. The risk of material misstatement can exist at 2 levels. There could be a risk of material misstatement at the financial statement level. There could be a risk of material misstatement at the assertion level. So what do you mean by risk of material misstatement at the financial statement level? That risk which is having a potential to cause a misstatement in the entire financial statements. Whereas that risk which is having a potential to cause misstatement in only 1 or 2 specific items, that we call it as assertion level. But whatever it is, this we will try to have an elaborated discussion in the risk assessment and internal control chapter. But for the time being now, I want you all to realize that there will be 2 levels of risk of material misstatement. One is financial statement level, other one is assertion level. To both the risk you have to respond. So let us see how we can respond to the risk of material misstatement at the financial statement level. If there is a risk of material misstatement at the financial statement level due to fraud, how you have to respond to it? Very simple. If there is a chance of happening misstatement in the entire financial statements because of fraud, what you are supposed to do is, when you are selecting your engagement team, assign and supervise personnel taking account of their knowledge, skill and ability. That means in order to tackle the risk of financial statements at financial statement level, you need to have experienced staff, skillful staff you have to use for this audit. Number 2, evaluate whether selection and application of accounting policies are evaluate whether selection and application of accounting policies, particularly those related to subject to measurements and complex transactions. So basically, you need to spend more amount of time on studying the accounting policies, especially accounting policies relating to accounting estimates. There you have to pay more attention. Then after that, incorporate an element of unpredictability. Basically, surprise checks you have to perform. So if you find risk of material misstatement at the overall financial statement level, how you can tackle is, you can respond to that by assigning experienced and skillful staff, and by studying the accounting policies relating to accounting estimates, and finally doing the surprise checks. And whatever risk of material misstatement that you have found it at the assertion level, how you have to respond to it? How you have to respond to that is by performing and designing further audit procedures. So you have to properly design and perform further audit procedures like inquiry, inspection, all that procedures you have to perform to address the risk of material misstatement at the assertion level. And whatever procedures you have designed at the beginning, those procedures you might change it also. So during the course of audit, if you felt that some more extra procedures you have to perform, you can change the nature, timing and extent of audit procedures during the course of the audit. Next, and this is very important, see, they say one general point that in every organization there is always a risk that management can override the controls. In every organization this risk will be there, whether you agree it or not, this risk will always be there in the management, in every organization. Why? Because management are the people who are responsible for designing, implementation, maintenance of internal control. So in every organization, since the management are the top level people, they always have the chance, they always have the possibility of overriding of controls for their own benefits. So this risk will exist irrespective of whether you do the assessment or not. This risk will always be there in the organization. So that's why what SA 240 says is, irrespective of auditor's risk of material misstatement, whether you do the risk assessment or not, compulsorily you should perform the following procedures. Whether you do the risk assessment, see, read this terminology here. So they say irrespective of auditor's assessment of risk of management override of controls. So whether you analyze this risk or not, is there a risk of management overriding controls, whether you do that assessment or not, doesn't matter. You should compulsorily perform some procedures. Which procedures? Like you need to test the appropriateness of journal entries, whatever journal entries that are recorded in the books of accounts, whether they are appropriate or not. Review the accounting estimates, and also evaluate the business rationale for outside the normal transactions. That means if you find any unusual transactions, you have to understand what is the business logic for it. So whether you make an assessment of risk of management overriding controls or not, these three steps are very, very important. Compulsorily you have to do it. What are they? Analyze the journal entries, review the accounting estimates, and understand the business rationale or logic for transactions outside the normal course of business. And then finally you get the audit evidence. Whatever evidence you have got, that evidence you have to evaluate. So if by performing that audit procedures, if you find a misstatement that is indicative of fraud, by performing the above procedures, whatever we have discussed, if you came to know that there is a fraud, there is a misstatement which is indicative of fraud, then what you should do is, if you find that there is a misstatement indicative of the fraud, you have to consider its impact on other aspects of the audit. So you should not just satisfy by obtaining evidence from that fraud. You need to evaluate if the fraud has happened in this area, what could be its impact in other areas. Why? Because fraud might not be an isolated occurrence. It could have taken place in multiple areas. So if you find any misstatement indicative of fraud, you need to evaluate what is the impact on other aspects of the audit. Similarly, if you came to know that there is a misstatement in which management is involved, if you came to know that if the management is involved, whether that fraud is material or not doesn't matter. If you came to know even in a small misstatement also management is involved, what you should do is you should re-evaluate your risk of material misstatement. Earlier you thought management are honest people, you thought the risk is low, but now you got to know management is involved in the fraud. You need to reassess your risk of material misstatement, make changes to your nature, timing and extent of audit procedures, and also identify is there any possible collusion along with the management, whether other people have also colluded, determine it, and even consider the implications on the opinion, even consider modifying the opinion when especially you came to know management is involved. And even you should perform analytical procedures. This is common. You should study the relationship between financial and non-financial items, and from that you have to evaluate whether any fraud is existing. And sometimes what will happen is, because of some circumstances, because of fraud, you might come across some circumstances because of which you are unable to continue the audit. So circumstances that bring into question the ability of the auditor to continue performing the engagement. So because of the fraud or suspected fraud, sometimes you come into helpless situations where you are in a doubt whether I should continue the engagement or withdraw from the engagement. In that case, what you should do? So in that case, what you should do is, first you determine is there any professional or legal responsibility to communicate with the people who have made the appointment. Whoever has appointed you, go to that person and communicate with them. Or in some cases, there might be a requirement to communicate with the regulatory authorities also. So determine, is there any requirement on you to go and communicate with the people who have made the appointment, or is there any requirement to go and communicate with the regulatory authorities to resolve this issue. Even after that also, if the issue is not resolved, then you determine whether it is appropriate and permissible to withdraw. If you wanted to withdraw, determine is it appropriate and is it permissible. If you have decided that okay, withdrawal is the correct option and it is also permissible, then what you should do is you can withdraw. No one will stop you. But when you are withdrawing, follow the formalities like communicate with management and those charged with governance, and also determine is there any professional or legal responsibility to communicate your reasons for withdrawal to the persons who made the appointment or to the regulatory authorities. So fulfill all your professional responsibilities and withdraw. No one is going to stop you. Next. And apart from that, you need to also obtain written representation from the management and those charged with governance regarding which matters are that they accept their responsibility for internal control. They have disclosed to the auditor results of their risk assessment procedures, and also they have disclosed to the auditor if they got to know about any fraud or suspected any fraud, and they have disclosed to the auditor regarding any allegations of fraud. Basically, whatever information management got to know about the fraud, everything they have communicated to the auditor. Ask the management to give a written confirmation. And finally, if you find any fraud or suspected fraud, you need to fulfill your communication requirements. First, if you got to know about any fraud, you have to communicate to the management or those charged with governance. So if the auditor has identified or suspected a fraud, he shall go and communicate these matters to the appropriate level of management. And also he should also communicate these matters to the those charged with governance. And particularly if you came to know that fraud is involving the management, you have to go and communicate with the those charged with governance for sure. If you came to know management themselves are involved in the fraud, you have to go and communicate with those charged with governance, and also communicate any other matters related to the fraud. Not just communicate the fraud, provide extra information also which will help them to understand the fraud in a better manner. And in some cases, communicating with the management and regulatory authorities and communicating in the auditor's report alone will not be enough. You might be required to have a fulfill the requirements of communicating with the regulatory or enforcement authorities like MCA, RBI and all. So determine as per the terms of the contract, is there any responsibility on you to communicate the matter to regulatory or enforcement authorities? If yes, fulfill that requirements also. Sir, will it not breach confidentiality? As we are aware, yes, auditor should maintain confidentiality, but whenever there is a requirement of law or regulation that will prevail, their confidentiality you should not argue. If there is any requirement of law or regulation, there you have to fulfill your communication requirements. And then finally, you have to maintain the documentation. In that documentation, what and all is required to be included, that list has been given here. Okay. And we have one more thing here, fraud risk factors I have given here. So this is something which is just a list of points of fraud risk factors. This thing you can go through, this page you can go through it. What are the fraud risk factors for fraudulent financial reporting? What are the fraud risk factors for misappropriation of assets? Clear? Comfortable everyone? Right, perfect. So we have completed essay 240. Now we will try to quickly do essay 250. Right. So what does essay 250 talk about? Essay 250 is going to talk about auditors' responsibilities regarding laws and regulations while conducting the audit of the financial statements. Which means that, say for example, you are conducting an audit of a client X Limited. See, as we all are aware, any client, they will have numerous laws and regulations to follow. Take for example, this is a company, they might be required to comply with the Companies Act 2013. They might be, if it is a manufacturing company, they need to comply with the pollution related laws and regulations, environmental related laws and regulations. If it is a IT company, data security related laws and regulations. If it is a manufacturing entity, Factories Act and Income Tax Act, GST Act. So like that, your clients might be required to follow so many laws and regulations for their continuation, for their existence. Now, as an auditor, if you are conducting audit of some company, of any entity, what is your responsibility with regard to these laws and regulations? Whatever laws and regulations which management of your client is required to comply, regarding that laws and regulations, as an auditor, what will be your responsibilities? What will be your responsibilities regarding the laws and regulations which are applicable to your client? That guidance has been given under essay 250. But let me ask you one question here. Who do you think is primarily responsible for ensuring the compliance with the laws and regulations? To make sure that these laws and regulations are complied with, it is whose responsibility? Management, not auditor. It is the primary responsibility of the management to ensure the compliance and prevent the non-compliance. So prevention of non-compliances is the responsibility of the management. And it is whose responsibility to detect the non-compliance? It is whose responsibility to detect the non-compliance? So once again, the responsibility for detecting the non-compliances is also rested with the management only. So management and those charged with governance, they have the primary responsibility to ensure compliance, and also they have the responsibility to prevent the non-compliances and also detect the non-compliances. Now, generally what managements will do is they will follow different. It is their responsibility to implement some policies and procedures in their organization to make sure that they are complying with the laws and regulations. As I have told, management is primarily responsible for ensuring compliance with the laws and regulations or not. So to make sure that as a management, their organization is complying with laws and regulations, they implement various policies and procedures in the organization. Sir, what are the examples of such policies and procedures which a management will generally implement to ensure the compliance of the laws and regulations? The list has been given here, important from the examination perspective. So what policies generally management will keep is they will monitor their legal requirements on a continuous basis, and according to their legal requirements they plan their audit procedure, they plan their operating procedures. Then they will implement proper system of internal control, and also they will develop a document called code of control and they will distribute it to everybody. And also they ensure that their employees are trained. You have to train your employees to make sure that they are complying with the laws and regulations, and also they have to monitor and act appropriately to discipline employees who fail to comply. If at all you find any employee who is violating laws and regulations, you have to take disciplinary action. And they also engage legal advisors. That's why they have legal consultants for big companies. And also they should maintain one register of significant laws and regulations. They need to maintain one complete register of what laws and regulations are applicable for them. And in larger entities, these may be supplemented by assigning appropriate responsibilities to internal audit function. If it is a big organization, even the responsibility of checking the compliance with laws and regulations can be handed over to the internal audit team. So whatever it is a responsibility of management and those charged with governance to ensure the compliance with the laws and regulations by following these policies and procedures. But as we all are aware, standards does not talk about management responsibilities. Standards will talk about auditor's responsibility. Now, what is auditor's responsibility? First question, let me ask you. Can you expect the auditor to prevent non-compliance? Can you expect the auditor to prevent the non-compliance with the laws and regulations? No. Can you expect the auditor to detect all non-compliances? Definitely not. Why? Because auditor is not appointed to ensure compliance, or auditor is not appointed to detect the non-compliances. The primary responsibility of the auditor is to obtain reasonable assurance whether financial statements are free from material misstatements. He can't be expected to prevent non-compliances. He can't be expected to detect all non-compliances. Does that mean auditor will not have any responsibility regarding laws and regulations of the client? Sir, you are telling auditor is not responsible for preventing non-compliance, and also we can't expect the auditor to detect all non-compliances. Does that mean will auditor not have any responsibility regarding laws and regulations of the client? No, you are mistaken here. So what will be auditor's responsibility regarding the laws and regulations? That's what this standard will explain. So we can't say that audit is completely spared of any responsibility regarding laws and regulations, but what exactly are that laws and regulations, that this standard will explain. And for the purpose of auditor's responsibilities, this is standard SA 250 divided the laws and regulations into two categories. For the purpose of auditor's responsibilities, this standard SA 250 has divided the laws and regulations into two categories. I will call them as category 1 laws and regulations and category 2 laws and regulations. Category 1 laws and regulations are those laws and regulations which are having a direct effect in the financial statements. Or if I put it in very simple terms, if I have to put the technical terms, the standard says those laws and regulations which have a direct effect on determination of amounts and disclosures in the financial statements, that will fall under category 1. Like for example, Income Tax Act, GST Act, PF Act, Bonus Act. So these are the laws and regulations which are having a direct effect on determination of amounts and disclosures in the financial statements. They will have a direct impact on the financial statements. So those laws and regulations will fall under category 1. Whereas category 2 laws and regulations are other laws and regulations. Those laws and regulations which don't have a direct effect on determination of financial statements, but still compliance with them is required to avoid the major penalties, or they are fundamental to continue the business. Like for example, if you take Child Labor Act. See, Child Labor Act doesn't have any direct impact on the financial statements. Does that mean companies can stop complying with the Child Labor Act? No. Why? Because if they don't comply with the Child Labor Act, what will happen? Either they have to pay penalties or they might be required to close the business. So those laws and regulations will fall under category 2.
So for the purpose of auditor's responsibilities, SA 250 has divided laws and regulations into two categories. Those laws and regulations which have a direct effect on determination of amounts and disclosures, and other laws and regulations. Now what the standard says is, with respect to category 1 laws and regulations, the auditor shall obtain sufficient and appropriate audit evidence. When it comes to category 1 laws and regulations like Income Tax Act, GST Act, PF Act, Bonus Act, when it comes to these laws and regulations, the auditor should treat them like any other financial statement item and perform all the audit procedures and obtain sufficient and appropriate audit evidence. So it is the responsibility of the auditor to obtain sufficient and appropriate audit evidence regarding category 1 laws and regulations. But when it comes to category 2 laws and regulations, if you perform specified audit procedures, it will be enough. Like if you take an example of Child Labor Act, you need not perform in-depth audit procedures. The standard has prescribed certain specified audit procedures. If you perform that specified audit procedures, your responsibility will come to an end. And if you find any non-compliances by performing your procedures, you have to respond appropriately. So three objectives of the auditor as per SA 250. When it comes to category 1 laws and regulations, try to perform in-depth audit procedures and obtain sufficient and appropriate audit evidence. When it comes to category 2 laws and regulations, you have to perform specified audit procedures. Depending on that procedures, whatever your findings are there, you have to respond appropriately. Understood? Then now they talk about what audit procedures are required to be performed regarding laws and regulations. Now they give a detailed structure what exactly the auditor is going to perform. So first one, when you are performing risk assessment procedures, here also they have divided audit procedures into two categories, risk assessment and further. So when you are performing risk assessment procedures, at the beginning, when you are understanding the entity, environment and its internal control, you should also obtain understanding of legal and regulatory framework. Basically, you should understand legal and regulatory framework. What are the laws and regulations which are applicable for your client? You should understand it. And also you should understand how the entity is complying with that framework, how the management is complying, what steps they are implementing to comply with that framework. That also you need to understand. When performing risk assessment procedures, these two things you have to understand: legal and regulatory framework and how the entity is complying with them. Then, sir, you told for category 2 laws and regulations, you have to perform specified audit procedures. No. Sir, what are that specified audit procedures? Here they are saying simple procedures. But these specified audit procedures are restricted only to category 2 laws and regulations. So what are that specified audit procedures for category 2 laws and regulations? Very simple. With regard to category 2 laws and regulations, just you have to go and inquire with the management and those charged with governance, and you have to inspect the correspondence with the relevant licensing or regulatory authority. Basically, any notices have been received from licensing or regulatory authority, that correspondence you have to check, and certain laws require particular attention. Like those laws which have impact on going concern, they might require particular attention. That's all. If you perform these specified audit procedures regarding category 2 laws and regulations, your responsibility is over. Nothing else you are required to do. Just inquire and inspect the correspondence. And you should remain alert to instances of non-compliances. If you find any instances of non-compliances, you have to remain alert to it, and even you should obtain the written representation. You have to even obtain what? Written representations from the management. So this is what the procedures generally you have to perform regarding laws. And particularly if you identify a non-compliance or if you suspect the non-compliance, few more extra procedures you have to perform. See, this is what prima facie we will do. Generally we will do this everywhere. But in case after doing this general procedures, in case if you identify non-compliance or if you suspect the non-compliances, then you need to perform this additional procedures. What are that additional procedures? Number one, you need to understand the nature of the act. Which act has led to this non-compliance, that you have to understand. And you have to evaluate what is the effect of that non-compliance on the financial statements. If you particularly identify non-compliance or if you suspect a non-compliance, you need to understand because of which act this non-compliance has happened, and even you have to evaluate what is the effect of this non-compliance on the financial statements. And also the auditor shall discuss the matter with management, and if the management or those charged with governance do not provide sufficient information, then the auditor might consider the legal advice. If you identify or suspect non-compliance, first you will go and discuss with management and those charged with governance. If they are not giving you all the required information, then what you can do is you can consult a legal advisor. You can go and obtain a legal advice. And if sufficient information about suspected non-compliance cannot be obtained, even after obtaining legal advice also, if you are unable to obtain audit evidence, then the auditor might consider modifying the opinion. And what kind of modification? This is also a case of non-availability of audit evidence, either a qualified or disclaimer of opinion you are supposed to give. Okay, so this is what additional procedures which you need to perform when non-compliance is identified or suspected. Then coming to the next part, reporting. Now comes the reporting. Finally, after performing all the audit procedures, if you have identified the non-compliance, what and all reporting requirements you have to fulfill? Very simple. You have to report the non-compliance to those charged with governance. First thing, you have to go and report that non-compliance to those charged with governance. So if the auditor believes that there is a non-compliance, you have to go and communicate with those charged with governance. Sir, what if those charged with governance themselves are involved in the non-compliance? If low-level people have committed non-compliance, I will go and communicate with those charged with governance. Sir, but what if those charged with governance themselves are involved in the non-compliance? Then the standard says, determine whether any next higher level of authority exists. Is there any next higher level of authority in the organization about those charged with governance? If there exist, go and communicate with that next higher level of authority. Generally, there will not be. So that's why they say the next point, where no such higher authority exists or auditor is confused whom to report, in those cases try to obtain the legal advice. So if low level people are involved or management is involved, go and communicate with those charged with governance. If those charged with governance themselves are involved, determine whether any next higher level of authority exists. If any higher level of authority exists, yes, go and report. If no such higher level of authority exists, you have to go and communicate obtain the legal advice. Next, and not just that, even you need to report the non-compliance in the auditor's report. That means even you need to consider the modification of opinion. So if you have concluded, that means you have sufficient and appropriate audit evidence that there is a non-compliance and it has not been adequately reflected in the financial statements. So you obtained audit evidence that there is a non-compliance and this non-compliance has not adequately been disclosed in the financial statements, then you have to give either qualified or adverse. Which means that if there is a non-compliance, but if it has been adequately disclosed in the financial statements, no need to give modified opinion, you can give unmodified. Only when there is a non-compliance and it has not been adequately reflected, then you give either qualified or adverse. On the other hand, in some cases, I might not be in a position, if I am unable to obtain sufficient and appropriate audit evidence, whether there is a non-compliance or there is no non-compliance, in those cases, since it is a case of non-availability of audit evidence, I will give either qualified or disclaimer, depending on materiality and pervasiveness. And then finally, reporting non-compliance to regulatory and enforcement authorities. In some cases, just communicating with the management or those charged with governance or communicating the non-compliance in the auditor's report alone will not be enough. Even you might be required to report that non-compliance to the regulatory authorities also. It depends on engagement to engagement basis. If there is any such a requirement, you have to fulfill that reporting requirements even with regulatory and enforcement authorities also. Clear? And they say whatever procedures you have performed, whatever evidences you have gathered regarding that laws and regulations, all that should be forming part of your audit documentation. Clear, everybody? Right. Okay. Right. So I think I have to end it with the 200 series today because it's already been 1:30. Yeah, so we'll end it with the 200 series. In the tomorrow session, we will do audit strategy, planning and program and quality control. That will do it in the tomorrow session. So we have two more standards to be covered. That two more standards will cover and wind up the session for today. Two are simple standards only. No need to worry at all. One is a joint audit, just like that we can complete it. And the other one is also 260. These days we are seeing the questions from 260, not as a direct question, but it will be linked actually. 260 is linked at multiple places, so that's why 260 I am explaining it here. So 260 talks about communication with those charged with governance. So what are the matters? Right. So 260, SA 260 talks about the various matters which are required to be discussed with those charged with governance. See, during the course of the audit, So during the course of the audit, there are various matters which are required to be communicated with those charged with governance. Now this standard is such a consolidated place where they will tell you all those matters at different instances or what are all those which are required to be communicated with those charged with governance. Okay, so let us try to have a quick look at it. Right. Fine. See, before we can understand what are the matters which are required to be communicated with those charged with governance, since we are coming this across this term, those charged with governance at various places, it becomes necessary for us to know who are those charged with governance. So they have given the definition of the term. Who are those charged with governance? Basically, those people who are having the responsibility for overseeing strategic direction. Those people who provide the strategic direction in the sense where the company's funds should be invested, whether the company's profits should be distributed or not, where they have to expand, which new business they have to enter, which new location they have to open. So these are kind of strategic decision. Those people who are overseeing, those people who are looking after this strategic direction, or those people who have the obligations relating to accountability. That means if something goes wrong, someone should come forward and take the responsibility on their shoulder, no? So those people who have the obligation relating to accountability, like for example, if some company does wrong, their owners will be taken to the custody, right? So those people who have the accountability, who are dealing with the obligations relating to accountability, and those people who are responsible for overseeing the strategic direction, who provide the strategy to the company, and those who are facing the responsibilities relating to accountability, those people we call them as those charged with governance. See, basically, who will come here is top level managements will come here. In companies, it is very difficult. In companies, it is very difficult to identify those charged with governance, because in the case of a company, both those charged with governance and management, both the roles will be played by board of directors only. In many companies, there is a very confusion here. Why? Because in companies, board of directors only will take up the execution responsibility, and they are only the ultimate owners of the company also, because they only provide the strategic direction also. So that's why especially in the corporate form of structure, in many entities, both the roles of those charged with governance and management, both the roles will be played by board of directors only. Right. So whatever it is, these are the people who are falling under those charged with governance. Now, what are the objectives of the auditor? As per SA 260, they say that as per SA 260, as an auditor, you are required to fulfill some objectives. What are they? Number one, you have to communicate with management your responsibilities. You have to communicate with not management, you have to communicate with those charged with governance. What are your responsibilities as an auditor? And also you have to communicate with them overview of planned scope and timing of the audit. So two things you are required to communicate mainly. First objective, go to the management, go to those charged with governance, communicate with them what are your responsibilities. As an auditor, what are your responsibilities? You have to communicate with them. Second one, you have to go to those charged with governance and communicate with them a overview. Give them overview of planned scope and timing of the audit. What is your overall plan? What is your overall scope? So give them a overview of planned scope and timing of the audit. Number two, not just you communicating. If required, you need to obtain relevant information from those charged with governance. It should be a two-way communication, not just you are communicating. If you require any information from those charged with governance, it is your responsibility to get that relevant information. And not just that, you have to provide them with timely observations during the course of the audit. If you have any significant findings, if you have any significant observations, in a timely manner, even those observations are required to be communicated with those charged with governance. And finally, by doing all this, you should promote a effective two-way communication. Why? Because without effective communication with those charged with governance, our audit will be troublesome. Our audit will be very troubling. Why? Because we need cooperation. If you have to do the audit in a seamless manner, in a smooth manner, if you expect your audit to run smoothly, you need cooperation. So that's why promoting promoting an effective two-way communication will help the audit smooth. So four objectives of the auditor as per 260. Number one, communicate with them responsibilities of the auditor and also overview of planned scope and timing of the audit. Number two, obtain relevant information from them. Number three, communicate with them with the timely observations and promote a two-way communication. Now they elaborate in a detailed manner. Sir, you are telling I have to communicate my responsibilities. What exactly I have to communicate? That they say here. So what exactly I need to communicate regarding my responsibilities is, so you have to communicate that as an auditor, you are responsible for forming and expressing an opinion. You have to tell them that as an auditor, your main responsibility is to form and express an opinion. And you should also say one more thing, that audit does not relieve the management or those charged with governance of their responsibilities. So tell them that, sir, my responsibility is to form and express an opinion, but because of audit, your responsibility will not get reduced. As a management and those charged with governance, you are responsible for preparing financial statements, you are responsible for implementing internal controls. Just because I am conducting an audit, there will be no reduction of your responsibilities. You will not be relieved of your responsibilities. You have to let them know it. So this is what specifically you need to communicate regarding your responsibilities. Then you need to communicate about overview of planned scope and timing. No, sir, what exactly I need to communicate regarding planned scope and timing of the audit? So you have to communicate with those charged with governance an overview of planned scope, timing of audit, including communication of significant risk. And you have to be very careful here. You should not discuss a detailed audit plan and scope. Why? Because that will make your audit ineffective. Only overview you have to share. That's why they use the phrase overview of planned scope and timing of the audit. Next, this now coming to the third point, they are telling that you need to communicate with them all your timely observations. No, so timely observation means these matters, whatever significant findings from the audit are there, all that findings you are required to communicate. Like what are the qualitative aspects? If you want to communicate regarding qualitative aspects, not on numbers, some accounting policies and all, you want to speak about them, you can go and communicate with them. Inappropriateness of accounting policies, if you find that any of the accounting policies inappropriate, it might be acceptable as per applicable financial reporting framework, but if you feel it as not acceptable, that is not appropriate, you can go and communicate with those charged with governance. Or if you face any difficulties during the course of audit, communicate with them. Unless all of those charged with governance are involved in the management, that means if management and those charged with governance, both the roles are played by two different people, then whatever matters you have communicated with management, communicate once again with those charged with governance, and whatever written representations you have requested from the management, request all that written representations from those charged with governance also. And what are the circumstances that affect the form and content of your auditor's report? Like if you want to give a modified opinion, go and communicate with those charged with governance. If you want to include a key audit matter, communicate with those charged with governance. If you want to include an emphasis of matter, communicate with those charged with governance. If you want to include an other matter paragraph, go and communicate with those charged with governance. As per SA 720, you want to include other information paragraph, go and communicate with those charged with governance. And other significant matters as per professional judgment, not just the above, all other matters as per your professional judgment. And there is one more thing, especially in the case of listed companies, it is mandatory that auditor should communicate with those charged with governance regarding their independence requirements. Mandatory. So as per in the case of listed companies, it is mandatory for the auditor to communicate with those charged with governance regarding the independence matters. So what exactly you will communicate regarding independence is, you have to say that your engagement team, your firm, your network firm, everybody has complied with the ethical requirements. You have to let them know, you have to communicate with them that your engagement team, your firm, your network firm, everybody have complied with everybody have complied with independence. You have to communicate with those charged with governance. And also you should communicate with them the relationships that might affect independence, like what are the audit services you are providing, apart from audit what non-audit services you are providing, and what is the fees for audit and non-audit services which could have an impact on your independence. This all we will see in the professional ethics in a detailed manner. So basically independence related requirements you have to communicate, like what audit services you are providing, for which of the entities you are providing non-audit services, what is the fees for audit service, what is the fees for non-audit service, whether the audit service fees is more than non-audit fees or not. So all these council guidelines are there. So you have to communicate all these requirements with those charged with governance in the case of listed entities. Sir, how the communication process should happen? As we all know, generally communication should happen in a written format. But they say that in the listed entities they have compulsorily told in writing. In other cases, if you feel oral is inadequate, then do the communication writing. And we all know that communication in oral format will always be inadequate. So it will always be better in all the cases to do a written communication. And whatever matters you have communicated with those charged with governance, everything should be included in your audit documentation. Clear? Next. So now we have one more last standard for today to discuss, which is SA 299. You guys are all well versed with it, which is talking about joint audit. Simple standard. Just hardly 10 minutes it will take for us to revise. We'll revise the essay 299. We'll wind up the session for today. Thank you guys. Being a Sunday, still people are staying on live watching. Your efforts will definitely pay you off. Right. So we'll discuss one more last standard. We'll revise one more last standard for today. After that, we'll wind up for today. So which is talking about joint audit of the financial statements. So first of all, what do you mean by joint audit? When an audit of a single entity is done by more than one auditor, or if I put it in simple terms, when more than one auditor, when I say more than one auditor, more than one audit firm actually. See, if a firm is having multiple partners and if that firm is appointed as an auditor, that we don't call it as joint audit. When I say more than one auditor, more than one audit firm. So when more than one auditor is appointed for the same entity, for the same financial year, and also for the same scope of work, for the same entity, for the same financial year, and also having the same scope of work, if more than one person is getting appointed, that audits we call it as joint audits. So basically, if you look at the audit report of the Reliance, at the end of the audit report, you will find the partners from two different audit firms assigning the audit report. That means the Reliance company, for doing the company audit for the same company for the same financial year, they have appointed two audit firms for conducting the audit. Similarly, if you look at the audit reports of many banks, you will find the audit reports being signed by many partners on behalf of many audit firms. That means those entities for the same financial year, for the same scope, for the same entity, they have appointed more than one auditor. So those kind of audits, we call them as joint audits. Now the question is, sir, why people will go for joint audit? Why the companies are why the companies will go for joint audit? Why the companies will go for joint audit is because they are finding so many advantages in it. Sir, what will be the advantages of having joint audit? Like as you could see, expertise will be shared and there will be mutual consultation. Those joint auditors can have a mutual consultation among themselves and that will improve the quality of the service. Like as you could see here, better quality of performance, workload will get reduced on each auditor, and overall client will become happy because he will get a improved service, and even it will promote a healthy competition among the auditors, and even quality and speed of the work will get increased. And even you can use the auditors having different experiences at the same time simultaneously for a single entity. But as we all are aware, when one work is done by multiple people, there will always be disadvantages also. So not just advantages, this joint audit is also coming with so many limitations or disadvantages. The main problem is superiority complex. That means people might develop ego complexes. So joint auditors might have a feeling that why I should listen to the other auditor, why I should share my work with him, why I should cooperate with him. That superiority complexes is a major problem which will be a major obstacle to the work. Not just that, this joint audit will not be suitable for small entities. Why? Because it will be very expensive. And lack of coordination. Joint auditors might not coordinate with each other, which will overall reduce the speed of the work. And even because of others' mistake, you have to face the consequences. There will always be a doubt that because of others' mistakes, you might have to face the consequences. And even some common areas will be there which everybody will ignore. And even audit fees has to be shared. Previously, if you are a single auditor, you used to enjoy the total audit fees. Now joint audit the company has opted for, you have to share your audit fees with other joint auditors. Next, okay, now what is the mechanism of the work? Sir, when more than one auditor has been appointed, how the audit will happen? See, for example, Reliance has appointed two auditors, two audit firms. Does that mean each audit firm will do audit separately, and will there be two audits happening for a single entity? The answer is no. When joint auditors are appointed, generally what will happen is those joint auditors will share the work among themselves on suitable basis. They will divide the work among themselves on suitable basis. Sir, on what basis they will divide the audit work, sir? They can divide the work on multiple basis. They can divide it on the basis of assets, liabilities, incomes, and expenditure. On the basis of geographical areas, they can divide. On the basis of period of the financial statements, they can divide, or even on the basis of identified units also they can divide it. So whatever may be, whenever they are dividing the work, they need to prepare one document in which they have to clearly explain which person has done which work, which person's responsibility is which work, that they have to clearly document it, and all the joint auditors must sign it. Okay, now, okay, sir, they are dividing the work among themselves. Then what about the responsibility? What about the responsibility? So SA 299 says that each joint auditor will be held responsible only for the work which was allocated to him. Like say for example, Reliance Industries Limited joint auditors, they have divided the work on the basis of period of the financial statements. First joint auditor first 6 months, second joint auditor next 6 months. Now each joint auditor will be held responsible only for the work which was allocated to him. Say for example, if joint auditor A is taking care of April to September transactions, he will be held responsible only for April to September transaction. And joint auditor B is looking after October to March transaction. This joint auditor will be held responsible only for the misstatements not detected in the month of October or March. So generally, each joint auditor will be held responsible only for the work allocated to them. But however, the standard says that there are certain areas where all the joint auditors will be held collectively responsible. There will be a joint responsibility in some matters. So there are certain matters where every joint auditor will have equal responsibility. What are those matters? Number one, if there is any undivided work, if some work is not divided among any of the joint auditors, if something wrong happens regarding that work, every joint auditor has to face the consequences. Or if some decision has been taken by all the joint auditors, if that decision has been gone wrong, then also everybody has to face the consequences. Or matters which are brought to the notice of all the joint auditors. If there is one matter, say for example, one joint auditor is there, he found one mistake, but he did not keep that mistake to himself. He communicated with all the joint auditors, but none of them have taken the action. Then also everybody will face the consequences. If you don't know the matter, that's why you did not take the action, the law will spare you. But if the matter has been brought to the notice of all joint auditors, but none of them have taken the action, then also all the joint auditors have to face the consequences. And also presentation and disclosure of the financial statements as required by applicable financial reporting framework. This is also the responsibility of all the joint auditors. And also for giving the audit report as per the relevant statute, this is also the responsibility of all the joint auditors. That means if something goes wrong in any of these areas, all the joint auditors will be held collectively responsible. Okay, we have seen responsibilities. Now what about reporting, sir? Sir, if joint auditors are there, will joint auditors give separate audit reports? No. Say for example, 14 joint auditors are there for SBI. Do you think all the 14 joint auditors will give separate 14 audit reports? No. See, generally what will happen is all the joint auditors, once they have completed the audit, they will sit together, discuss all their observations, discuss all their findings. They will arrive at one common opinion, and that one common opinion will be expressed through a single audit report. Generally, all the joint auditors will arrive at one common conclusion, and that one common conclusion will be expressed through a single audit report. But sometimes what will happen is there will be differences of opinion. Say for example, out of this 14 joint auditors, 13 joint auditors are saying unmodified opinion, one joint auditor is saying modified opinion. Sir, if there is a difference of opinion, should the person who is having a difference of opinion, should he go with the majority? The answer is no. SA 299 says if there is difference of opinion, no need to go with the majority. Then what will happen? Then what will happen is let them give their own audit reports. These 13 joint auditors will give a single audit report containing an unmodified opinion. This one joint auditor will give a separate opinion containing a modified opinion. And now these two reports will be given to the management. Management will circulate both the reports to the shareholders. Now which report shareholder has to rely? That is completely shareholders choice. But whatever it is, there is no requirement to go with the majority. You can give your separate opinion through a separate audit report. Then, and also a few more things to say here. Few more things to responsibility we have seen. Yeah, dependence on the joint auditor. See, can each joint auditor rely on the other joint auditor's work? Yes, joint auditors are entitled to rely on other joint auditors' work even without verification. You need not doubt the other joint auditor's capability. Why? Because he is also equally capable like you. So as a joint auditor, you can rely on the work of other joint auditor even without any review. Next one. Now this comes the next part. What are the special considerations when joint audit is happening? What are the special considerations you have to keep in mind? So here they say that it requires engagement part while planning the audit. The engagement partner and engagement team from all joint auditors should participate in the planning. All the engagement team and all the members of the engagement team and engagement partner from all joint auditors should participate in the planning of the audit. They should establish one joint strategy. They should not have different strategies. They all should have one joint overall audit strategy. And in developing audit plan, so all the joint auditors should collectively develop the audit plan. And in that audit plan, they have to identify the division of areas, which person will do what work that they have to identify. They have to ascertain the reporting objectives. They have to consider all the factors those are significant in engagement team's efforts. They have to consider results of preliminary engagement activities, and even they need to determine nature, timing, and extent of resources. See, these are all common. These are the factors which we do in the normal audit also. So if you look at the audit strategy planning and program chapter, so there you will find what factors are required to be considered while establishing audit strategy. Same factors we will consider even in the joint audit also, but only difference is in a normal audit single auditor will do it. In the joint audit all the joint auditors will collectively consider all of this in their planning decision. And then finally each joint auditor should assess the risk of material misstatement, and they have to and communicate with other joint auditors, and the joint auditor should discuss and document among them nature, timing and extent of audit procedures what they are going to perform regarding specific and common areas. So watch what every auditor will do, that also they have to document. And then finally they will get one common engagement letter. They will not get different engagement letters. They will get one common engagement letter, and they will get one written representation, one common written representation from the management. And as I've told, on whatever basis they are allocating the work, that should be put on a paper, and that work allocation document should be signed by all the joint auditors. That's all. So this is what SA 299 is all about. So with this we have completed 200 series of the standards also. So we have completed 500 series, we have completed 200 series of the standards. Clear?